Hey traders, welcome back to the audiobook, Trade Like an O'Neill Disciple, the Ultimate Insider's Guide by Gil Morales and Dr. Chris Katcher, built on the legacy of the legendary William O'Neill himself. If you've made it this far, you're serious about leveling up your trading game, and today's chapters, they're packed with some of the most powerful tools and mindset shifts in the entire book. Chapter 6, Riding the Bear Wave. Get ready to flip the game. This chapter teaches you how to attack down markets with sharp strategies for selling stocks short and profiting while others panic. Chapter 7, Dr. K's Market Direction Model. Ever wonder how pros know when to step on the gas or hit the brakes? Dr. K breaks down his signature timing model, a game changer for navigating the markets with confidence. Chapter 8, Our Bill of Commandments. These aren't just rules, they're your trading Bible. Morales and Katcher lay out their hard-earned commandments for discipline, risk control, and survival in the market jungle. Chapter 9, In the Trenches with Bill O'Neill. Real stories, raw lessons. Get an inside look at what it was like learning from the master himself. Think of it as your backstage pass to trading greatness. Chapter 10, Trading is Life. Life is Trading. This one's deep. It's not just about trading tactics, it's about living the trader's mindset every day. If you want to thrive, this chapter shows you what it really takes. If you're enjoying this audiobook, don't forget to hit that subscribe button, smash that like, and share this with your fellow traders. Let's grow this trading community together. You ready? Let's dive straight into Chapter 6, Riding the Bear Wave. And trust me, you're not going to want to miss this.
Chapter 6, Riding the Bear Wave. Timely Tools for Selling Stocks Short. In essence, our short-selling philosophy is the mirror image of our upside bull market philosophy, where we seek to capitalize on the huge upside price moves in the big stock leaders of any bull market cycle. For us, short selling is simply playing the second half of what we can think of as a stock's life cycle. Young, entrepreneurial companies start their life cycles off with a bang as strong fundamentals, new products and services, and dynamic new industry conditions help them to gain a strong institutional following as mutual funds, pension funds, hedge funds, and other large institutional investors take positions in the stock. Systematic and sustained institutional accumulation of a leading stock drives the stock price inexorably higher, resulting in your classic O'Neill-style, big, winning stock. As the company matures and conditions change, such as the emergence of newer, more efficient, competing technologies, processes, or concepts, the flow of institutional money into the stock will inevitably slow. In some cases, the company merely becomes a slow-moving, underperforming, has-been. In other cases, and those that typify the kind we are most interested in, that institutional money flow can reverse very sharply as the institutional investors that piled into an innovative, entrepreneurial young company on the upside quickly begin to pile out. When institutions begin exiting their sizable positions in such a manner, a former leading stock can come under severe, sustained distribution that sends the stock plummeting ever lower and completes the stock's life cycle. More than 5 years have passed since How to Make Money Selling Stocks Short was published. This chapter can be considered, at least for Gil's part, the first update to that work, though the book very much remains an excellent primer on O'Neill-style short-selling methods. While this chapter can stand on its own, we recommend that How to Make Money Selling Stocks Short be read as an introduction to this chapter. While that book focuses primarily on the use of weekly charts to illustrate short-selling techniques, the point where the rubber meets the road is, in fact and in the reality of real time, on the daily charts. Exactly how and where one sells a stock short is critical in being able to capitalize on a prime short sale opportunity, and this chapter expands on the precise timing of short sales using daily charts. In addition, we will discuss some new ideas in short sale chart formations and setups, which add to our arsenal of topping formations that provide the necessary structure to our short selling methods. Previously, our universe of viable short sale setups consisted of the standard head and shoulders H and S type of formation and its derivative, the late-stage failed base, LSFB. The golden rules of short selling. There are 6 basic principles and rules that govern our short selling activities and provide the philosophical foundation upon which our O'Neill-style approach to short selling is built. We refer to these as the 6 golden rules of short selling, and they refer primarily to what sorts of stocks we seek to short with respect to leadership status and liquidity. When we seek to short them, how we handle stop-loss points on short positions, and how we establish profit-taking rules. Obviously, when the big stock leadership in any bull market begins to top and roll over, this has macro implications for the general market and usually signals the onset of a bear market. By definition, the leadership that led the market on the upside will often lead it to the downside as money flows out of the stock market during a bear market. Therefore, we want to focus on short selling in those few names that were big, winning stocks, and that had huge price moves in the immediately preceding bull market. In a bear market, what has gone up the fastest often has the best chance of coming down the fastest. So we can establish our first two golden rules of short selling. 1. Sell short only when the market is in a clear bear market trend and as early in the bear market cycle as possible. If you are shorting late in a bear market, after the market has been trending lower over many months, you may very well be late to the party. Short selling very late in a bear market can be catastrophic, so beware of this. In particular, if the market has come down significantly off its peak, and everyone around you is talking about selling the market short, then be especially attuned to the contrarian implications of such a bearish preponderance. 2. Focus on those big stock leaders that had huge upside price moves in the immediately preceding bull market phase, and that are showing significant topping signs. This means you will likely only be dealing with a relatively small universe of proper short-selling candidates. As we will see later in this chapter, major topping formations, such as a head and shoulders top, can take 8-12 weeks or more after their absolute tops to develop. Some can take longer, and in some exceptional cases can take only a scant few weeks before a stock literally appears to blow out of the sky. The critical point in most short-selling cases is that bullish sentiment in a former big winning leader is often very persistent in the stock. From a psychological perspective, this makes perfect sense, since human nature is pretty much what it is and has always been. Investors who missed the big rocket stock and never bought it as they watched it go higher will see it start to break down off its peak for the first time and want in on the missed opportunity. Brokerage analysts may come out and recommend the fallen leader as a strong buy because it is seen as cheap after the sharp price break off the peak. In this manner, residual bullish sentiment in a former leader will persist in bringing money into the stock and bouncing it back up within its pattern. It takes time to wring out all of the bullish sentiment in a stock, which is why most short sale candidates take 8-12 weeks or more to set up properly before they break to the downside. In most cases, larger cap stocks with a broad institutional following will take longer to break down, while relatively smaller stocks can tend to break down much more quickly, usually within 12 weeks of their price peaks. 3. Seek to short former, big leading stocks 8-12 weeks after their peak price following a major upside price run. In most cases, big stock leaders will be fairly liquid traders with average daily trading volume well in excess of 1-2 million shares. In general, we prefer a minimum of 2 million shares in average daily trading volume for our short sale candidates. Stocks that trade a few 100,000 shares a day should generally be avoided, unless an investor intends to deal in much smaller position sizes relative to one's account equity. We also impose an absolute maximum position size for stocks trading less than 1 million shares a day at less than or equal to 0.5% of the average daily trading volume. Therefore, for a stock that trades 300,000 shares a day, an appropriate maximum absolute position size of 1,500 shares or relative position size of 5% of one's account equity, whichever is less, is recommended for less than the most seasoned short sellers. Stocks that trade only a few 100,000 shares a day are quite thin and hence subject to very rapid price run-ups, which can cause a great deal of damage, even if your position size is relatively small. Therefore, golden rule of short selling rule 4 is 4. Only sell short stocks that trade a minimum of 1-2 million shares a day, and preferably more. In general, avoid thinly traded stocks as short sale candidates, as risk can correlate inversely to a stock's trading liquidity. Stop losses on short positions should range around 3–5%. If you are down 3% on a position, and the stock is trading above average volume as it rallies from your short sale point, it is best to implement the 3% threshold for your stop loss with the idea that the stock can always be reshorted if the rally suddenly fizzles out. Also, if a stock you are short generates a pocket pivot type of upside buy signal, you can often just cover the stock right there. Otherwise, if the stock is rallying weakly, a 5% stop can be used, sometimes 3% more if so desired. Stops on short positions are still dependent on one's position size, personal psychology, and risk tolerance. One way to handle stops is to use a reverse layering technique by peeling off portions of the position as a short position rallies against you. Say 1/3 of the position when it is 3% above your short sale price, another 1/3 when it is 5% above, and the last 1/3 once the stock has rallied 7% past your short sale price point. Other permutations of this strategy might be half the position at 3% and the other half at 5%, or half at 5% and half at 7%. As you gain experience in short selling, you might find a particular permutation of stop-loss policies that works best for you. But whatever the case, it is extremely important to always have a clear exit plan and point for any short position that is taken. Standing in the way of a sharp rally through indecision or hesitation, what we refer to as freezing up, can be very dangerous. Hence, Golden Rule 5 states, 5. Set stop losses at an average of 3–5%, using the tighter 3% stop if the stock begins to rally against you on strong, above average volume. A layering technique can also be used by peeling off and covering portions of the position as the stock rallies against you a series of specified percentage thresholds, such as covering 1/3 at 3%, another 1/3 at 5%, and the final 1/3 at 7%, or any other permutations. Stops are dependent upon personal psychological preference and risk tolerance, so short sellers should try to determine what works best for them in real time. Because stocks will often have sharp upside rallies within their macro downtrends, it is wise to set reasonable profit objectives for any downside move you expect a stock to make once you have taken a short position in the stock. In most environments, profit targets should be 20–30%. If you find that short positions are breaking closer to 15–20% before rallying and wiping out your profits, then you can adjust this, or again use a layering technique where you cover half the position when it is showing a 15–20% profit and the remainder when it is showing a 20–30% profit. Alternatively, the 20-day moving average can sometimes be used as a guide for a trailing upside stop on any short position that is showing a decent profit. Once a stock has broken down from a proper short sale setup and topping formation and has been in a downtrend for at least a few days to a few weeks, the 20-day is often a useful reference point for a legitimate upside turn and rally in a stock, and hence offers what can be a nearby trailing stop. In Figure 6.1, we see First Solar, Inc., FSLR, as it broke down from a large, wide, loose, and improper late-stage cup with handle type of formation. Note the loose and very long handle with very few tight weekly price closes. This is the macro formation from which FSLR topped in late 2008. In Figure 6.2, we can see FSLR's breakdown in detail on its daily chart. The stock breaks support along the lows of the handle at around the 250 price area, which corresponds to the weekly chart in Figure 6.1, which is the macro view. After FSLR breaks decisively through this support zone in the lows of the handle, it stages one rally back up toward resistance and the 250 price area. Because 1. The stock did not move above the intraday high of the first day that it closed above the 20-day moving average, and 2. The move up into the 20-day also corresponded to solid resistance at the 250 price area and the lows of the handle. This would not be considered a cover point necessarily. However, notice that the move from 250 down to 200 represented a 20% profit. Roughly, so part or all of the position could have been covered there. nicely illustrating the implementation of the 20-30% profit objective rule. The stock could have then been reshorted on the move back up to the 20-day moving, and the lows of the handle, which represented stiff potential resistance at the 250 price area. Note that as FSLR came down to the 100 price level, it bounced once and then retested that 100 low by coming down to a point just below it, setting up an undercut and rally situation, which also provided a potential profit-taking short covering point. Watching for lows that are retested and undercut can be useful in determining when to cover part or all of a short position, as it is very common for stocks to fake out shorts by undercutting a prior low, whether near term within the last week or two or intermediate term, several weeks to a few months, which is seen as a breach of support that is simply too obvious to work. Hence, stocks will have a tendency to undercut and rally as they trend lower. Watching for such undercuts can help determine when a short position should be covered in part or in total. From this, we derive Golden Rule 6-6. Once a short position is showing a profit, set a downside profit target objective of 20-30%, or use a layering technique, covering half the position once a 15-20% profit is showing, and the other half at a 20-30% profit. Alternatively, once a short position is showing a good profit, one can use the 20-day moving average as a guide for a trailing stop. If the nearest moving average above the stock's current price is the 50-day or 200-day moving average, then they can be used in place of the 20-day moving average line. Watch also for undercuts of prior lows as potential rally points at which all or part of the position can be covered. Short sale setups. The key to successful short selling lies in waiting for the proper window of opportunity to open. This requires waiting and watching as potential short sale formations that begin to form complete their chart patterns. There are three primary short selling setups that we use: the head and shoulders top, the late-stage failed base, and the punch bowl of death double top. Each has its own unique characteristics, but sometimes patterns can overlap and can therefore be interpreted as a hybrid of two or even all three of these formations, as we will see later in this chapter. Ultimately, the exact shape and label we assign to a particular topping formation is less important than the actual price-volume action within the pattern that indicates the stock is very likely under systematic and sustained distribution. One feature that each of these topping formations and short-selling setups have in common is a sharp downside price break and breakdown on massive volume, which occurs right off the peak of a sharp upside price run of several months or more. Heavy volume selling off the top after a sustained uptrend usually signals the first wave of distribution in a former market leader, and it is at this point that such a stock should be placed on one's short-selling watch list, as it potentially continues to form some sort of valid topping formation. Screening for stocks with heavy volume price breaks on a daily and weekly basis is the most effective way to catch potential short sale targets as they initially come under distribution. Keep in mind that in not all cases will a price breakdown off the peak in a former leader result in the stock building an overall topping formation. Leading stocks can and often do simply correct and build new chart bases from which they begin new price advances. It is possible to build elaborate screens that identify head and shoulders formations, but this is not necessary. Keeping a watch list of broken leaders that have had big volume sell-offs off the peaks of big price runs in the immediately prior bull market phase is sufficient. The head and shoulders formation. The basic mechanics of a head and shoulders topping formation are best illustrated with the picture-perfect textbook example of Crocs, Inc. Crocs in 2007-2008, figure 6.3, one of the few true poster children of the head and shoulders topping formation. The prerequisite for any short sale setup and topping formation is a substantial prior price run, such as Crocs' 13-month upside romp through late 2006, and most of 2007. In October of 2007, Crocs was slammed off its absolute price peak on massive selling volume, as figure 6.3 shows. The stock then bounced to form a single right shoulder that briefly rallied above the 40-week, 200-day moving average before breaking down again. Note that the right shoulder forms below the left shoulder in the head and shoulders formation, which is the optimal configuration as it indicates severe weakness in the stock. As well, the left shoulder can represent a stiff area of resistance if the right shoulder forms below it in the pattern. Once the head and shoulders formation has filled out, it is possible to draw a neckline along the lows of the left shoulder, head, and right shoulder. In Croc's case, the neckline slopes downward and hence is a descending neckline. This is also an optimal configuration, as a downslipping or descending neckline is much weaker than a neckline that is flat or upward sloping, ascending. Initial downside breaches of the neckline can often result in fakeouts as the stock turns and rallies briefly. Note that when Crocs finished forming its right shoulder, it broke down through its neckline. But after spending 3 weeks below the neckline in January 2008, it turned and rallied back up into its 10-week 50-day moving average before rolling over again and breaking down through the neckline for good. Because breaches of support within topping formations are often too obvious, and because they often occur as gap downs on the daily charts, something that is not detectable on the weekly charts, we prefer to short stocks as they rally weekly into logical resistance or a moving average line, such as the 50-day or 200-day moving averages. Figure 6.4. To get an idea of how these formations coincide with the general market, let's first look at another example of a head and shoulders topping formation, this time in Garmin Limited, GRMN, that occurred at the exact same time. In GRMN's 2007 weekly chart, Figure 6.5, we can see the head and shoulders formation set up similar to Crocs with the initial big upside price run, the end of which is signaled by the huge volume price break off the peak. GRMN was an interesting case because the left shoulder in the formation also had a sharp price break off its peak in the 120 price area peak on very heavy volume, so that by the time GRMN broke off the peak of the head in the formation, evidence of the stock's weakness was beginning to stack up decisively. This distribution in the left shoulder and the head made GRMN a prime short sale target as the market began to top in late 2007. Following the second price break off the peak, which finished forming the head in the formation, GRMN began to work on its right shoulder as it rallied back above its 10-week, 50-day moving average on declining volume. This is the point at which we want to watch the stocks rally for signs that it is running out of gas as it rallies on declining volume. By examining the daily chart of GRMN, Figure 6.6, we can see the rally in mid-November 2007 that took the stock back above the 50-day, 10-week on the weekly chart, moving average in early December. As GRMN reached what would become the peak of the right shoulder, daily trading volume declined precipitously, as can be seen on the chart. Volume on the peak day was less than half of average daily volume for the stock, a strong sign of declining demand for the stock on the rally. In most cases, when volume on a rally within a right shoulder gets to 35 to 40% below average or lower, around 1/3 to 1/2 of average daily volume or less if you eyeball it on the chart. We call this a volume dry-up day, which can be shortened to the acronym VDU, but we prefer to call it a voodoo day. When it occurs, the odds of the stock giving way to the downside as it runs out of gas begin to increase, particularly if selling volume begins to increase sharply following the weak volume up days in a rally bounce. In most of the best examples, a very light volume up day right around the peak of the right shoulder will mark the end of the rally, as the stock will roll over to complete the right shoulder. Notice also that once GRMN starts to decline off the peak of the right shoulder, it drops below its 50-day moving average, but still manages to rally a couple of times back up into the moving average on light volume, before rolling over altogether and plunging through the neckline of the head and shoulders, as I've delineated on the weekly chart of GRMN in Figure 6.6. The timing of short sales also coincides with the action of the general market. It is important to understand that the head and shoulders formations of both Crocs and GRMN did not form in a vacuum. They topped and formed their short sale, set-up formations as the market itself was building its top. Figure 6.7 shows the Nasdaq Composite Index in late 2007 as it built its overall top before plunging lower in early 2008. By comparing Figure 6.7 with the daily charts of Crocs, Figure 6.4, and GRMN, Figure 6.6, you can see that both stocks initially peaked out right at the exact same time as the Nasdaq Composite Index. Once the Nasdaq Composite had broken down off its late October 2007 price peak, this initial decline was followed by nearly 2 months of backing and filling, which also coincided with Crocs and GRMN building the right shoulders within their overall head and shoulders topping formations. How topping patterns form is largely a function of the general market and usually peaks in the right shoulder of a head and shoulders topping formation, coinciding with peaks in general market rallies that occur after an initial break off the peak, just as Crocs and GRMN built their patterns in a manner that is very much in synchrony with the Nasdaq Composite, e.g., the general market. Short sale target stocks that may be building right shoulders in an overall potential head and shoulders topping formation must be watched within the context of the general market, as the two are inexorably linked. Crocs and GRMN were big leaders during the bull market rally of 2007, and when the general market topped in late October 2007, it was no surprise that these stocks topped as well. The examples of Crocs and GRMN illustrate quite well the head and shoulders template that encompasses all the critical characteristics one should look for when identifying a head and shoulders top. While these were both examples of head and shoulders formations with one right shoulder, you will run into stocks that form more than one right shoulder, but this is often a function of the general market as it continues to back and fill before breaking down further, as well as the stock's institutional status. Big cap favorites can take longer to break down, but normally, as a stock forms 2 or more right shoulders, it will typically break down through the neckline in the pattern at some point that coincides with the market starting a new down leg in an overall bear market. For example, while stocks like Crocs and GRMN topped with the market in late 2007, larger cap favorites like Apple Inc., Apple and Baidu Inc. Baidu continued to build topping formations from which they broke down in September 2009, nearly a year after the October 2007 market top, as the market began a second major down leg in the 2007-2009 bear market, Figure 6.7. After the initial break off the peak in late 2007, we can see the backing and filling phase in the last 2 months of 2007, before the first real down leg of the bear market took Crocs and GRMN with it. Another phase of backing and filling through most of 2008 finally ended with a second major down leg that began in September 2008. This was the point where another wave of leaders began to break down from their topping formations, which is typical of most bear markets, Figure 6.8. Leading stocks will begin to come apart and break down on each successive down leg during a bear market. This is a very important concept to keep in mind as we discuss the other topping formations and setups that we look for in our short sale operations later in this chapter. The market offers optimal windows of opportunity with each major down leg within an overall bear market, and it is critical that investors remain patient and vigilant in order to come in on the short side just as the market is starting another down leg, and the optimal window of opportunity is opening. Monsanto Co. MON, in 2008-2009, Figure 6.9 is an interesting head and shoulders example that formed in the midst of the bear market following the top in October 2007. Note that MON did not top with the market in October 2007, but instead continued higher as it nearly doubled in price by the summer of 2008 during what was actually a bear market rally within the overall 2007-2009 bear market environment. Eventually, however, MON began to form a head and shoulders topping formation after peaking in June 2008. Although it is not labeled on the chart in Figure 6.9, you can see the high volume price break off the peak in June that defines the right side of the head in the formation, after which MON forms 2 right shoulders, roughly, and then finally breaks down through its neckline at the exact same time that the market begins its second major down leg in the bear market. In Mon's daily chart, figure 6.10, we can see that right around the peak of the first right shoulder, the stock showed 3 up days where volume was 45%, 54%, and 63% below average daily trading volume, indicating that demand for the stock was potentially drying up. The stock then breaks down through its 50-day moving average down 19.5% to the neckline of the head and shoulders formation. As we discussed previously in this chapter, the first break through the neckline is usually a fake-out, as it sucks in shorts and natural sellers before undercutting the neckline and then turning and rallying. In this case, MON rallied back up to a point just above its 50-day moving average to form the second right shoulder in the pattern. Note that as the second right shoulder began to form, Mon's 50-day moving average had crossed below its 200-day moving average, corresponding to the 10-week moving average crossing below the 40-week on the weekly chart, a bearish, black cross. If an investor had successfully shorted MON off the peak of the first right shoulder as upside volume was drying up, the first breakdown to the moving average would have yielded a quick profit, and the ensuing rally could have been monitored for a potential failure point. Typically, stocks forming right shoulders will rally to a point just above the 50-day or 200-day moving averages, at which point a reversal back below the specific moving average, whether the 50-day or 200-day, can be shorted. After forming the peak of the second right shoulder, MON breaks down to its neckline again, hovers around for a couple of days before splitting wide open to the downside. Relatively smaller stocks like the Crocs and GRMN examples will tend to break down faster, often only forming one single right shoulder in the head and shoulders formation, while very large cap leader favorites like a MON can form 2 to 3 or more. Ultimately, however, the final breakdown will occur at the same time as a new down leg in a continuing bear market, so it is imperative to conduct short sales in synchrony with the beginning of a new market down leg. Late-stage failed base, LSFB, setups. The second primary short sale setup and topping formation is the late-stage failed base, LSFB. A corollary to the head and shoulders top that is usually seen more frequently than the head and shoulders formation, but which can also be seen as part of a head and shoulders formation, as we shall see a little bit later in this chapter. The LSFB, as we call it, forms when a stock breaks down from a late-stage base, which can happen after a failed breakout attempt, or with the stock simply falling out of bed from a late-stage base formation. As always, the pattern will have a big upside price run preceding it. After a long price run, each successive base that a leading stock forms on the way up becomes more and more obvious. When a stock finally builds a very late-stage base, usually the third or later base formed on the way up, and after the initial breakout that began the price move several months earlier, it becomes very obvious to the crowd, which is then set up to be fooled. When the LSFB gives way to the downside, it can often do so very rapidly, but just as often can break down through a major moving average, such as the 20-day or 50-day line, first and then back and fill several times as it rallies back up into the moving average before splitting wide open. In the most ideal example, SunPower Corp. Aspira in 2007, figure 6.11, was a late-stage, V-shaped cup with handle formation that failed very rapidly. Aspira weekly chart shows that the breakout attempt from this cup with handle formation occurred on light weekly volume as the stock stalled out and reversed to close at the very low end of the weekly trading range. 2 weeks later, the stock pierced the 10-week 50-day moving average and plummeted to the downside in rapid order, losing over 50% of its value in just about 3 weeks. As always, the daily chart figure 6.12 gives a much better picture of how the breakout failure occurs, and we can see that the initial V-shaped cup with handle base formed after the stock had put in a climactic type of price run into the peak on the left side of the cup. After the cup forms a handle, the breakout day comes on just average volume, making it suspect, and the ensuing days roll over as volume actually dries up. For 7 days, the stock drifts down toward its 50-day moving average, before bursting through the moving average on very heavy volume and moving sharply lower. In this case, shorting the immediate breach of the 50-day moving average would have been the proper entry point. The stock plummets rather quickly from that point, pausing for 3 days in a short, inverted bear flag, what we also like to think of as walking the plank. The 3rd day in the plank, or inverted bear flag, volume dries up to a very low 36% below average, a voodoo day. Using a stop at the prior day's high, it would be possible to add to a short position in the stock at this point. SPRA did not waste any time making a beeline right through its 200-day moving average to the downside, where it finally stabilized for several weeks underneath the 200-day line. SPRA would have given a very quick 25–30% profit, which is where our profit rules might come into play and cause us to cover our short on this basis, which would obviously be premature given the extent of the additional downside that actually ended up occurring. The key here is to assess the velocity of the breakdown, so that if it is extremely weak to the downside as it collapses on heavy volume, one can use the 10-day moving average as an upside stop. Notice how SPRA 10-day moving average trails just above it on the way down once the stock breaks the 50-day moving average. Big stock, fertilizer play Potash Corp. Saskatchewan Pot is an interesting example of a late-stage failed base that eventually morphs into a head and shoulders formation, figure 6.13. Focusing on the LSFB, however, gets you into the stock on the short side a lot sooner. After breaking out from a late-stage 5-week base in June 2008, POT drifts higher on declining volume before pulling back to its 10-week, 50-day moving average, which it tests for the next 3 weeks before finally failing and breaking down toward the 40-week, 200-day moving average. A final rally up into the 40-week line occurs just as the 10-week line crosses below the 40-week line, a bearish black cross, before the stock splits wide open, literally blowing apart in 4 weeks. While the weekly chart of POT makes it look rather easy, the daily chart figure 6.14 paints a slightly different picture as it demonstrates how persistence is necessary in successful short selling, as well as waiting for the exact right moment to short the stock. POT's initial breakout from the 5-week late-stage base was actually a short trendline breakout that occurred on reasonably strong volume. The stock actually looked very strong as it pushed higher on several higher volume up days, but eventually this all gave way as the stock descended back down toward the trendline breakout and the 50-day moving average, corresponding to the 10-week moving average on the weekly chart, figure 6.13. In figure 6.14, we can follow the numbers as we track the stock's steady but somewhat stubborn breakdown. 1. A very low bounce occurs off the 50-day moving average and rallies to a point just above the 20-day moving average. A retest of the 50-day moving average briefly looks successful at 2, for 1 brief day before the stock breaks down again. At this point, it appears that some support at 3 is coming from the 5-week base from which POT had previously broken out as the stock seems to rally right out of thin air and back up into the 50-day moving average at 4 on below average volume. Note that the next day the stock actually touched the 50-day moving average on intraday basis, and that volume was very light, showing that the stock ran out of upside fuel at that point. POT broke down hard from there before finding support at the 200-day moving average, where it rallied up into and around the 20-day moving average, which we would use as a reference for a trailing upside stop. Note that POT was unable to clear the 20-day line on any volume at 5, which is a voodoo day with volume coming in at 44% below average on the day. The stock then broke down again through the 200-day moving average before rallying once more into the 50-day moving average in a violent rally that accompanied a similar violent rally in the general market. If we take a chart of the S&P 500 index and label it 1 through 6 as we have in figure 6.14, we come up with figure 6.15, which gives a good idea of how POT's breakdown was correlating to the general market action. In fact, POT was breaking out of its 5-week late stage base about 2 weeks after the actual top in the S&P 500. As the market continued to move lower throughout most of June 2008, POT's price action reflected this as its breakout began to fail, and the stock flailed around its 50-day moving average, as we saw in Figure 6.14. You can also see how the little twists and turns in POT from points 1 through 4 correlate to some degree with the twists and turns of the general market. The movement from points 5 to 6 most certainly was a function of the general market, and the jagged break and final 2-day jack up rally into point 6 in POT's daily chart clearly mimics that seen in the S&P 500 chart. The window of opportunity opens wide at point 6. We cannot stress the importance of monitoring the general market when stalking your short sale targets in individual stocks. In most cases, stocks topping patterns can be seen to move in synchrony, at least to some degree, with the general market. As was mentioned earlier, short sale setups and topping patterns can overlap, and in more than a few cases, we observe a combination of topping patterns that occur as pieces of the overall topping process. Research in Motion RIM in 2008 is an excellent example of at least 2 topping formations overlapping. To illustrate this, we begin with the RIM daily chart, Figure 6.16, which shows 2 distinct patterns up around the top between early May and late August 2008. The first breakout occurs right at the very peak of RIM's long-term upside price move in mid-June from a 4 to 5 week base formation. The breakout quickly rolls over into the end of June and breaks to the downside. It was likely not possible to enter a short on the gap-down breakout failure given that the stock was already extended to the downside and well through the 50-day moving average. However, when it comes to short selling, opportunity can often knock more than once, even twice, within a stock's overall topping phase. As we see in Figure 6.16, RIM recovers to some extent to form a short cup with handle formation with a handle that is moving straight across rather than drifting slightly lower as is preferred in a proper cup with handle formation. See O'Neill's How to Make Money in Stocks, 4th edition. Notice that as the stock finishes the handle, it wedges up just a bit, logging a voodoo volume signature as trade declines 36% and 37% below average on these 2 days, respectively. This breakdown in late August coincides with the market's breakdown at the same time, as we can reference back to in Figure 6.15. The weakness in the late-stage cup with handle formation is accented by the heavy volume gap down in late June that marks the right side of the cup in the formation. The rally coming back up into the handle on the right side of the cup shows a general pattern of declining volume as the stock progresses into the end of the handle and flashes 2 voodoo days right at the end, just before it begins to break down sharply. This is where the stock can be shorted. What is most interesting about RIM, however, is its hybrid combination of 2 LSFBs teaming up to form an overall head and shoulders topping formation with a pinhead that consists of the breakout from the 5-week late-stage base up to the stock's ultimate peak in June, and then the 1-week decline that marks the breakout's official failure. The handle in the ensuing cup with handle formation forms the right shoulder of the head and shoulders formation, which eventually pierces the neckline and plummets to the downside, as we see in Figure 6.17. RIM points out the importance of focusing on weak price volume action within the pattern, looking out for potential voodoo volume signatures within wedging little rallies or consolidations rather than obsessing over the precise shape and label you want to give the pattern. Short sale setups all have some basic characteristics that can be summed up as follows. 1. A big prior price run-up of several weeks to several months. 2. A high-volume break off the peak that takes the stock below a critical moving average, such as the 50-day or 200-day moving averages. And 3. A series of weak rallies back up into the moving averages where we seek to find optimal short sale points based on the voodoo day concept. Punch bowl of death, POD setups. Late-stage bases that fail and set up as LSFBs can often occur from cup with handle formations that are wide and loose. When these cups begin to get more than 50% deep, in what is essentially a rapid price breakdown from a peak price that follows a prior huge price run-up, they become something more than mere cups. What they become, quite frankly, are punch bowls. Hence the short sale setup and topping formation we refer to as the punch bowl of death or POD formation. The basic concept behind the POD formation is a rapid price run-up in a hot leading stock followed by an equally rapid price decline of more than 50%. When the stock declines so sharply, investors who miss the first run to the upside see the stock as extremely cheap, driving the stock up rapidly back up to its prior highs, giving the impression of a giant double top, cup, or as we refer to it, punch bowl. The problem with a second priced run-up to the right side of the punch bowl is that it is simply too rapid to be sustained, and so it breaks down very quickly from that point. As in the example of Ariba Corp. ARBA in Figure 6.18, a high-volume failure of the peak of the punch bowl's right side marks the beginning of the final decline. ARBA demonstrates this as the POD failure occurs with the stock breaking the 10-week 50-day moving average on very heavy volume. Several rallies back up into the 10-week line occur before one last rally precedes a final break through the 40-week 200-day moving average, after which the stock plummets precipitously. In most cases, a POD should be of a short time duration, anywhere from 28 to 40 weeks or more, but often the shorter the better. ARBA has a 26-28 week long POD formation in the example shown, but in longer POD formations, such as we will see in Charles Schwab Corp. Schwa. The formation can be a year in duration, but should also have a very sharp run up the right side of the punch bowl. It is the rapid run up to old highs in a former, beaten-down leader that is the critical characteristic in any POD that determines whether the formation is sustainable and hence prone to failure. Long, rambling punch bowl-like formations with gradual slopes up the right side of the formation are not what we are looking for in a POD. As the daily chart of ARBA shows, Figure 6.19, the mechanics of shorting a POD failure are very familiar since they do not differ very much from what we've seen in our previous discussions of the head and shoulders and LSFB setups. Essentially, a breakdown from the peak of the right side of the POD occurs on heavy volume as the stock breaks through the 50-day moving average, until it finds support at the 200-day moving average and rallies back up into the 50-day moving average at point 1. Another test of the 200-day is followed by another rally at point 2 right into the 50-day moving average, and this rally occurs on a number of below-average volume days. Both points 1 and 2 would serve as logical short sale entry points, and profit-taking rules would likely have you covering around the 200-day moving average, and then shorting the second rally into the 50-day moving average at point 2 on the chart. In this example, the rallies pushed right into the 50-day moving average and were halted in their tracks at the line. In other cases, as with head and shoulders and LSFB short sale setups, the stocks often will rally to points just above the 50-day moving average after the initial breakout failure off the right side of the POD. Charles Schwab Corp. Schwa. In 1999-2000 is an example of a longer-term POD that is nearly a year in duration, Figure 6.20. In this case, the stock displays a necessary characteristic for such a long-duration POD formation to be valid as a short sale setup, and that is the very rapid, 4-week price run-up on the right side of the 1-year-long punch bowl. This rally closes in new high-price ground on a weekly basis, before immediately gapping down the next week and beginning a rapid descent that takes the stock down about 40%. Had Schwa instead rambled higher, slowly climbing up the right side of the punch bowl, it would likely not have had a sharp break off the peak. The rapid run up the right side does not allow for any consolidations that would weed out weak hands and bring in strong hands as the stock builds a base, moves up, builds another base, and moves up in a slow-moving ascent. By running up so sharply, the stock creates a lot of weak hands who are now seeing a big profit in the stock they bought lower in the POD and are likely to sell, as well as catching some overhead supply from the left side of the formation from investors who bought near the peak in March 1999. For these reasons, as well as the action of the general market which topped in March 2000, Schwa's POD failure worked very well on the short side. The daily chart of Schwa, figure 6.21, shows the rapid ascent up the right side of the POD and the subsequent breakdown back through the 20-day moving average on the downside. This results in a very sharp breakdown to the 50-day moving average, at which point the stock bounces violently back up into just above the 20-day moving average. The stock backs down below the 20-day moving average, and the third day up around the 20-day moving average flashes a volume dry up, VDU, or Voodoo volume signature, as trade drops to 34% below average. This is the point at which to short the stock. Later on, once the stock drops below the 50-day moving average, rallies up into the 50-day line to become shortable, as we see on the very far right of the daily chart in figure 6.21. Another example observed at the same time, and which played out very similarly to Schwa, but which we do not show here, was America Online, AOL, in 1998-2000. We leave it to the reader to investigate AOL, at one time TWX following the merger with Time Warner Co., on their own. During the 2007 general market rally, otherwise dull shipping stocks, that is, the stocks of companies that put stuff on big boats and move them around the globe so consumers around the world can get their stuff, became all the rage as the group launched on a massive upside price run. The leader of the pack at that time was Dryships, Inc., Dries, which had a tremendously steep upside price run through most of the year, figure 6.22. When the general market topped in October 2007, the shippers, as one of the big darling groups in the bull rally, topped with it. Dries and its shipping brethren all collapsed, plummeting over 50% from their bull market price peaks, as we see in Dries' weekly chart. In January 2008, however, the stock found a bottom, retested it once on the weekly chart, and then took off on a steep 8-week run up the right side of the POD. Interestingly enough, Dries has a sharp, climactic type of run at the end of the rally up to the peak on the right side of the POD, which is potential topping action that should be watched for as a stock comes up the right side of a POD. This can provide a clue that is useful in developing conviction to short the stock once you see the first high-volume reversal at the peak on the right side. When viewed on a weekly chart, Dries' short sale setup looks almost exactly like a POD that was formed by Reading Railroad in 1907. Copyright issues prevent me from showing that chart here, but it is fascinating to see the exact same pattern work the exact same way, even though they occurred 100 years apart. But then, as O'Neill and his predecessor like to say, the stock market is simply human nature on parade, and as long as human psychology remains the same, we can expect that the same chart patterns and setups, whether on the long side or the short side, will continue to reappear both now and into the indefinite future. After running rapidly up the right side of the POD, Dries quickly flames out as it reverses on very heavy volume, breaks down below its 10-week 50-day and 40-week 200-day moving averages, and then proceeds to bump up into both of those moving averages for the next 11 weeks before blowing apart completely as the general market broke down in September 2008. Refer to figure 6.15. You can see in figure 6.23 that Dries looks very similar to ARBA and Schwa on the daily chart, reversing sharply on huge volume right off the peak of the right side of the POD, crashing down through first the 20-day moving average before rallying up into the 20-day line twice with volume drying up sharply on 2 voodoo days right at the line, as the daily chart shows. The second rally up to the 20-day moving average reversed as volume that was 40% below average indicated a severe lack of demand for the stock at that point, and so it gapped down the next day as volume picked up meaningfully. Once the stock breaks down through the 50-day and 200-day moving averages, those moving averages become reference points for short sale points as the stock rallies twice up into its 200-day moving average before rolling over again in early July 2008. One of the things working against the POD at the peaks are the mad rushes to the upside that characterize both the left and right peaks of the POD formation. The first one on the left side results from a normal but sharp bull market-related rally in the stock, usually a stock that is considered one of the hot leaders of any particularly bull market phase. The second rush up the right side of the POD occurs so quickly, without ever taking time to shake out weak hands and bring more strong hands into the stock, so that the wild run becomes unsustainable. Dry's run up the right side of the POD gets so out of control that it culminates in a climactic type of 5 to 6 day run to the peak before the stock reverses back to the downside. The stock is often shortable on the first high-volume reversal off the peak on the daily chart, but once it breaks, the 20-day moving average rallies back up into the 20-day line and can be used to short into as they come up on weak volume, certainly like the voodoo volume signature days seen at the 20-day in the Dry's example. Another instructive punch bowl of death short sale setup can be found in Apple Inc. Apple, during late 2007 into September 2008, which actually began forming its POD top with a late-stage failed base LSFB short sale set up in late 2007, as we see in the weekly chart, figure 6.24. During the period in which Apple formed its POD top, other big stocks of the bull market that ended in late 2007, like Baidu Inc., Baidu, and First Solar FSLR, formed POD tops of their own, roughly in synchrony with Apple. We leave it to readers to investigate those on their own and instead focus on Apple. Following the late-stage failure in late 2007, early 2008, Apple's stock price was cut nearly in half in 6 short, brutal weeks. It then bottomed after 12 weeks and turned to the upside, scampering back toward the 200 price level in a mere 8 weeks. This made the entire POD a short 20 weeks in duration. Apple was a big stock favorite in the immediately prior bull market, and so it spent a lot of time bouncing between its 50-day moving average and resistance at the 180 price level on the upside, and the 200-day moving average on the downside, before finally giving way and splitting wide open in conjunction with the market break in September 2008. We will split the view of Apple's price volume action during 2007-2008 on the weekly chart, figure 6.24, into 2 daily charts for a more detailed look at how Apple broke down on both the left and right sides of the punch bowl. Figure 6.25 shows the breakdown from the late-stage cup with handle formation Apple formed in late 2007, moving higher even after the general market had topped in late October 2007, before it finally topped in late December. Note that once Apple broke down through both the 20-day and 50-day moving averages, it only spent another 6 days backing and filling as it wedged up into its 50-day moving average on weak volume. The rallies into the 50-day line were the optimal short sale points and put you in position to benefit from the ensuing sharp break to the downside that extended into February of 2008. It is interesting to note that the breakout day for Apple came on voodoo volume that was 56%, less than half, of average daily trading volume for the stock. This was a clear sign of a lack of demand for Apple as it cleared to new highs and failed to hold the highly publicized 200 price level. Apple's move into the 200 price level was reminiscent of Jesse Livermore's comments regarding his play in Anaconda Copper back in 1907, when he said, "It was an old trading theory of mine that when a stock crosses 100 or 200 or 300 for the first time, the price does not stop there, but goes a good deal higher, so that if you buy it as soon as it crosses the line, it is almost certain to show you a profit." When Anaconda Copper cleared the 300 price level for the first time in 1907, Livermore observed the action in the stock. "I figured that, when it crossed 300, it ought to keep on going and probably touch 340 in a jiffy." Anaconda, however, did not act as it should, and Livermore noted that Anaconda opened at 298 and went up to 3023, 3024, but pretty soon it began to fade away. I made up my mind that if Anaconda went back to 301, it was a fake movement. On a legitimate advance, the price should have gone to 310 without stopping. If instead it reacted, it meant that precedents had failed me and I was wrong. And the only thing to do when a man is wrong is to be right by ceasing to be wrong. Edwin Lefevre, Reminiscences of a Stock Operator Illustrated, 101. A modern-day example of Anaconda Copper. Apple could not clear the 200 price level in late December 2007, and that action was further confirmation of its bearish, topping action, and the stock began to break down rapidly. Once Apple had broken down into the February 2008 lows, it began to turn in March and rallied back up in an 8-week rush into the right peak of the POD formation, figure 6.26. Note that as Apple came up to the peak, upside volume was below average, while two above-average selling spikes hit the stock on the way up. The stock made a little double top right around the 190 price area, with weak 36% below average volume on the second top. Once Apple began to fail off the right side of the POD, it took several weeks before it completely broke to the downside at the same time that the general market broke in September 2008. The last gasp rally that Apple logged when it pushed up into logical resistance at the 180 price level was the optimal spot to begin shorting the stock. Note also that there is a little wedging, e.g., up on the day with very light volume, day with volume 45% below average, a voodoo volume signature. Shortly thereafter, the stock begins to roll over and busts through all of its moving averages in a matter of days, as the general market began a very sharp down leg in September. It is important to note that short sale reference points occurred throughout the backing and filling phase that began in late June and continued until the stock split wide open in September. In most cases, light volume moves up into or just above a key moving average or a logical area of support, such as the 180 price level in Apple's daily chart, were the best spots to short shares of Apple in 2008. Some of the most rapidly rewarding POD formations to play can be those that occur in very hot IPOs, such as the solar stocks in 2007-2008. Hot IPO merchandise can often start flying off the shelves when a particular theme catches the investing community's eye, such as the internet stocks in 1999, 2000, or the solar stocks in 2007-2008. Often, hot IPO stocks that go straight up have a nasty habit of coming straight down, particularly if they are coming in on the tail end of all the excitement over a particular theme, such as Trina Solar TSL was in 2007, figure 6.27. TSL had a great move from its initial IPO date in late 2006, but after that it had several failed breakout attempts from what were essentially IPO POD type formations, in that they had the straight up and then straight down, followed by straight up again. Look, that typifies these unsustainable, speculative rocket moves in such stocks. TSL's weekly chart in figure 6.27 actually shows two shortable POD formations, a double POD rarity. These are both very short patterns of about 8 weeks and 12 weeks, respectively, and both pods have a right peak that is characterized by a high volume reversal week on the chart. If we break this down into two separate daily charts for each POD formation, figures 6.28 and 6.29, we see that the mechanics are roughly the same as we've seen in the prior POD examples of Arba, Schwa, and Apple that we've discussed previously. The first POD that TSL formed is shown in figure 6.28, and again we see the high volume reversal right off the right peak of the POD, marking the end of the stock's upside rush. This is then followed by a series of jerks back up into the 32 price level that start to define a clear area of resistance. On the third and fourth, rallies up into and around the area defined by the 20-day moving average and the 32 price level resistance. Volume begins to lag, and the stock becomes shortable at this point. The breakdown is very rapid from that point. The breakdown off the right side of the POD that TSL formed in figure 6.28 led to another wild, upside rally. But in this case, the stock pauses to form a handle through most of October 2008, figure 6.29. When it tries to break out, the high-volume reversal off the peak of the right side of the POD rears its head yet again in this example and clocks the stock, knocking it straight down through its 20-day, 50-day, and 200-day moving averages in a matter of 3 days. The stock then rallies weekly back up into the 50-day moving average before breaking down and gapping lower. You can here see why taking profits when a short sale position becomes extended to the downside is critical in handling these types of plays. After the sharp gap down in mid-November TSL, it then rallies back up into the 50-day and 200-day moving averages before it finally flashes a low-volume voodoo day at the peak of a rally into the end of December 2007 and then rolls over altogether. Other examples of IPO pods during the solar stock craze of late 2007 are Yingli Green Energy IJ and LDK Solar Limited. LDK, which readers can study on their own. The punchbowl of death short sale setup and topping formation can be a very rewarding one, particularly if a short seller is able to identify the rush up the right side of the POD and wait for the first high-volume reversal day to short the stock off the right peak. Some very quick, sharp profits can be gained thereby, as the examples we've discussed have demonstrated. But once the stock has broken down off the right side, there are numerous areas and points where the stock can be shorted again, as one campaigns it on the short side. Shorting rocket stocks. A high-probability short-selling method we've discovered, which is unrelated to the normal types of short sale situations we look for in the head and shoulders, late-stage failed-based, and punchbowl of death short sale setups, is what we call exploding rocket stocks. Rocket stocks are defined as hot stocks that move at least 4.5 times from their high-volume launch point, which usually occurs on a breakout from some sort of consolidation on volume that is greater than twice the normal average daily volume. The 4.5-fold move generally occurs in 4 weeks or less, as these stocks launch like nuclear rocket stocks. But after launch, nuclear rockets eventually blow apart, and history has shown that these rocket stocks do the same, usually within a few weeks after their launch. Thus, ample profit opportunities abound by going short at the right time, and the time value can be enormous. Rocket stocks are shorted after their high-volume climax run as they break below any day's intraday low, which generally is the first sign that the climax top is at its end. While this is a risky, more volatile technique, the reward is that the odds are fantastic. 95.7% of all rocket stock short sale setups from 1991-2008 were profitable, and 84.2% of all rocket stock short sale setups fell at least 50% off their absolute price peak on the rocket ride. Knowing this, it can be advantageous to pyramid your short position as the stock continues to fall to potentially 50% from its peak. The risk is that the 4.3% of stocks that don't work will hit their sell stops, which we place at the absolute high of the pattern. Thus, you will know your exact risk in percentage before placing the trade, and there it is imperative that you size your positions accordingly. Your stop might be quite a distance from where you initially shorted the stock, so that 15.8% of the time, expect to have to hold a position that could go against you by more than 17% before becoming profitable. But the upside is that this means that 84.2% of the time your position will go against you by less than 17% before you reap a substantial profit. While these percentages can be tough to sit through, knowing that 95.7% of these patterns are profitable, with 84.2% of them being substantially profitable, should greatly help your confidence. It is safest to cover your position once the stock has fallen 50% from its peak, since most stocks fall at least 50% from their peak, before staging a potentially large rebound. For potentially higher profits, you can cover half your position and wait to see how the stock behaves before covering the other half. Also, for stocks that move up at least 6.5-fold from their launch point price, 65 of 66 rocket stocks that we studied fell at least 50% from their peak. If we include the examples from the climax top in March 2000, the tally increases to 73 of 77 rocket stocks that fell at least 50% from their peak. Note, for 2009, the Black Swan year, most of all the junk off the bottom stocks that went up in price at least 4.5 times did so over a period of more than 4 weeks, so these would not qualify as rocket stock short sale candidates. Remember that we are looking for nuclear rocket-powered thrust. Thus, stocks that qualify are those that streak higher in price at least 4.5 times in usually 4 weeks or less. Such behavior is rare. Thus, there are typically only a couple of such stocks that behave this way in any given year. But when you do spot such a stock, your risk-reward is extremely favorable. That said, obtaining a proper borrow from your broker in these stocks, which tend to be thinner, smaller names, is not always easy, and we have found that we are only able to borrow such stocks for short selling for half the stocks that show up as rocket stock short sale candidates. When the setup is right, and the stock shares can be borrowed for shorting, we have found that such situations can almost be like free money. Let's look at an example of a rocket stock set up in Interdigital, Inc. IKE, during 1999-2000, figure 6.30. In highly unusual situations, after a stock has moved up at least 4.5 times its launch price in 4 weeks or less, a stock might settle down, tighten up, and move sideways in a constructive manner, which is what we are initially looking for in a proper launch point for the stock. Note that if a stock trades sideways for more than 2 weeks, such as IKE did from late November 1999 to early December, then its launch point price is reset. Thus, after this November-December consolidation of more than 2 weeks' duration, IKE's launch point is reset to 10.94 from 5.44, the high of the prior consolidation that the stock hit about 2/3 of the way through November 1999. Once the stock tops, the first day down off the peak is your reference day, using the low of that day's trading range as your trigger for the short sale. In the IKE example, this would have been triggered on the second day following the peak, when it dropped below the intraday low of the first day off the peak. Keep in mind that with these rocket stock setups, we are looking for massive thrust, and this thrust can occur with low-price stocks. So while the price of the stock may be well under what we would ever consider buying, history shows that such stocks offer excellent short sale setups, and such stocks will attract massive levels of volume from their launch point, so that getting the stock borrow in order to legally initiate your short position is possible. Table 6.1 shows the statistics for 6 rocket stock short sale setups observed between 1998 and 2004, including the IKE example discussed previously. Even though big gains can be made in a short time, and the odds are greatly in your favor, keep in mind that the amount of room you may need to give such a short sale setup might be more than you are normally used to giving. So position size accordingly so that you don't get shaken out of your position prematurely. Conclusion. As we've seen in the numerous examples in this chapter, short selling can provide a source of quick profits in a bear market. However, playing the short side of a bear market is inherently more risky than playing the long side of a bull market because bear markets tend to have sharper upside jerks within their overall downtrends, which can run in short sellers who come in late on a stock's decline. Timing your short sales properly, waiting for that proper window of opportunity to develop in conjunction with a breakdown in the general market, is even more important than when buying stocks on the long side of a bull market. Investors who have little experience short selling should start out with only small capital commitments relative to their overall portfolio value, say 5–10% maximum. As one gains great experience, one can decide whether one is comfortable taking larger positions. Stay smart from the start. Chapter 7. Dr. K-Tikes Market Direction Model. It may seem decidedly un-O'Neill to consider using a market direction model, essentially a systematic program for generating valid buy and sell signals for the general market indices. While a market direction model may seem like a timing model, we do not ascribe that term to it, since it does not adequately describe our approach in using such a model. A market direction model, in contrast to a timing model, should be used as a critical tool in understanding when you are in a bull market, favorable to taking long positions, or in a bear market, favorable to taking short positions. In this chapter, we will discuss the refinements that we have incorporated along with basic O'Neill concepts of upside market follow-throughs and downside market distribution days to produce what we consider to be the refined framework of a market direction model, and hopefully clear up some of the confusion surrounding the precise price-volume action that characterizes potential turns and reversals in the direction of the general market direction. Readers who have further questions should contact Dr. Chris Kasher at chris@macainvestors.com or can refer to the website www.virtueofsilfishinvesting.com. Timing the market. A timing system must start by containing internal logic that makes sense. Then the system can be built around this internal logic. This is where many years of market experience are necessary. This avoids the black box situation of overfitting data where data is fit to predict the past, but has little to no predictive value on the future. Unfortunately, so many timing systems available on the internet for a subscription fee lack internal logic, but manage to boast high theoretical returns because they have overfitted their past data. Such systems are great at predicting the past, but fail when tested under real-time market conditions. This is perhaps why such skepticism abounds when the words timing model or timing the market are mentioned. But just because most timing systems do not work does not mean all timing systems do not work. We highly recommend Robert Capel's book Bulls, Bears, and Millionaires, Dearborn Financial Publishing, 1997, where the author and Mike DeVere discuss the perils of model design and overfitting data. I have been timing the markets real time, under fire since 1991, the first successful year where I strongly outperformed the major U.S. market averages. My model is a statistical formalization of price-volume action of the NASDAQ Composite and S&P 500. I developed a set of rules that guides this model and has guided my trading over the years. It is largely responsible for my long-standing track record, as verified by the Big Four auditor KPMG, and for the degree of my exposure to the market on the long or short side. My model keeps me on the right side of the markets as it excels at catching intermediate-term trends near their starting points. It has never missed a major drop in the market, including the sudden precipitous drop in October 1997, and has always gotten me on board near the beginning of major bull markets, including the challenging year of 2009, when it signaled a major buy on March 12, 2009. That said, sideways, choppy markets are the model's weakness, and drawdowns are almost always the result of such erratic market behavior. Fortunately, such periods are rare. Incidentally, my model was inspired by the M in William O'Neill's ConSlim, the fourth edition of his book classic How to Make Money in Stocks, McGraw-Hill Companies, 2009, that discusses ConSlim in detail is now available, and I highly recommend it, even if one has read earlier editions. ConSlim screens for stocks that have the characteristics winning stocks tend to share before big price moves, and the M is the market timing portion of ConSlim. There has been much confusion over the years about what constitutes a proper distribution day and a proper follow-through day. In the years we worked as portfolio managers for Bill O'Neill, we noticed a degree of confusion even within our group of top-performing portfolio managers that were trading Bill's investment capital. When Bill and I gave investment seminars, we would frequently get asked to give further clarification on distribution days and follow-through days from those who read about the two concepts in how to make money in stocks. Part of the confusion comes from the many possible permutations concerning price-volume action, including the shape of the price bar, where it closes in relation to the prior day, the day on which the follow-through day occurs, and how much the NASDAQ Composite or S&P 500 has to fall to initiate a follow-through day count, among other possible issues. The other part of the confusion may come from not having exact rules. For example, some may assert that a day like August 28, 2009, is not a distribution day because the market indices did not fall at least 0.2% on the day. This creates confusion since it does not take into account the shape of the price bar, because in fact that day had a long upside tail. If you have a long tail on higher volume, and the NASDAQ Composite closes about even, this is a distribution day since the index tried to move higher earlier in the day but eventually closed at the low end of the range. The shape of this day, therefore, would define it as a distribution day. The intraday rally attempt was met by selling, requiring the index to fall at least 0.2% before calling a distribution day without taking into careful consideration the shape of the price bar and close seems illogical. Another part of the confusion comes from high-frequency trading algorithms, which can increase volume on the downside during corrections and pullbacks, leading to false sell signals. Filtering out this type of trading volume results in fewer false sell signals. While this can somewhat improve results, it is important to note that sell signals in timing systems, including one that filters out such high-frequency trading volume, were largely unprofitable on the short side in 2009, mainly because the overall trend of the market was up. Likewise, buy signals in timing systems were largely unprofitable in 2008 on the long side because the overall trend of the market was down. That said, a good timing system will profit well on true signals while losing little on false signals. Thus, even during challenging periods, a timing system's true signals should more than make up for the small losses from false signals. And over the entire cycle, typically 3 to 5 years, an excellent timing system should clearly outperform the major market averages. Distribution days. A distribution day can be thought of as a trading day where there is more selling pressure than buying pressure on that given day, as evidenced by increased volume combined with negative price action. Either a down day or a day where the index shows signs of reversal and/or churning. If enough distribution days, usually 5, occur within a short time frame of typically 20 trading days or less, then a sell signal is generated. Volume must be higher than the prior day's volume to qualify for a distribution day, but the closing price does not necessarily have to be lower than the prior day's closing price. For example, if the stock has a long upside tail, closing less than 0.1% higher on the day and in the lower 25% of its daily trading range on higher volume, then that would be a distribution day. An example of this type of distribution day is shown in Figure 7.1. Also, if a stock makes little price progress on substantially higher volume on any given day, this can also indicate distribution in the form of churning, a situation where more selling than buying is occurring, but the selling is masked by the fact that the day's closing price closed slightly higher than the closing price the day prior. That said, make sure the big volume is not due to options expiration or index rebalancing, such as occurred on September 18, 2009. Figure 7.2. Had this been a day where volume was not skewed by the monthly options expiry or periodic index rebalancing, then we would certainly view it as a distribution day. However, because volume may have been skewed by an options expiry on this particular date, it has to be viewed with some skepticism since the market did finish up on the day. If the market had closed down, with a long daily range showing material volatility on the day, then the potentially skewed volume would have to be taken for what it is, a down day on heavier volume, hence a distribution day. In the case of churning with a very narrow daily price range, as in Figure 7.2, this is less clear. Thus, we are less inclined to see it as a negative day in and of itself. Of course, confirming or disconfirming action over the next few days can help clarify the action on an options expiration day, such as our example in Figure 7.2. You could also have a situation where the day is lower on higher volume than the prior trading day, yet it is not a distribution day, because it closes in the top half of its daily trading range for the day, and also closes down less than 0.1%, as Figure 7.3 illustrates. On March 8, the Nasdaq Composite closed down on heavier volume, but because it closed down minus 0.04%, and because it closed well in the upper half of its daily trading range, it was not a distribution day. In some cases, this action can actually be viewed as constructive. At the very least, this type of distribution day where the stock has a wide daily range and closes in the uppermost part of the daily range is not in fact a distribution day. We would also view a day where the daily trading range was very narrow, or tight, and the index closed down less than minus 0.1%, as not being a distribution day. We find the minus 0.1% downside minimum requirement for a distribution day to be more reliable than using minus 0.2%. Bear in mind that we are not trying to be controversial here. That is simply what the statistical work shows. One important point in our discussion of distribution days is that we only use the Nasdaq Composite Index to count distribution days. This is because over the past several years, we have noticed an increasing number of false sell signals from the S&P 500, which, while often having smaller gains in uptrends or smaller losses in downtrends than the Nasdaq Composite, still carries more noise within its pattern and thus more risk by way of generating more false signals. For the same reason, and also due to the narrowness of the index, I do not use the Dow Jones Industrial Average, which is an index of only 30 big-cap stocks, which more often than not do not adequately represent the leadership in any bull market. Follow-through days. A follow-through day is a buy signal that usually occurs after the fourth day of a rally attempt. O'Neill used to define a follow-through day as a move of more than 1%, the threshold level, on one of the major market indexes on higher volume than the prior day on the fourth through seventh days of a rally attempt off the bottom. This rally attempt, by definition, occurs after the Nasdaq Composite, or S&P 500, has suffered a correction. The rally count begins on the first day the index closes higher after making new lows, but can also begin on the day the index actually closes at a new low, but the close is mid-range or higher on the day, indicating potential supporting action off the lows. For example, the mid-range close on massive volume on October 8, 1998, figure 7.4, which might otherwise be considered a big distribution day since the index did in fact close down more than minus 0.1% on heavier volume, should actually be considered the first day of a rally attempt, and hence the first day in the rally count. When the index closes mid-range with very heavy volume, it should almost always be viewed as accumulation, not distribution. In very rare instances, a follow-through day can occur on the third day of the rally attempt, but all 3 days must be up on increasing volume such as January 15 to 17, 1991, on the Nasdaq Composite, or the prior 3 weeks must be relatively tight such as the weeks leading up to the follow-through day on January 5, 1987. Threshold levels. The threshold level represents the minimum percentage gain that either the Nasdaq Composite or S&P 500 must be up, often on the 4th through 7th days of a rally attempt off the lows, though this is not an absolute requirement to qualify as a follow-through day. These levels seldom change as the Nasdaq Composite and S&P 500, but at various times, O'Neill has adjusted this to 2% or 1.7% based on his perceived volatility in the indexes. When the indexes have demonstrated over a period of many weeks that their volatility has changed, then O'Neill has more or less eyeballed the required threshold level to adjust for increased or decreased volatility. Adjusting threshold levels for index volatility is correct, in our view, and statistical studies of market volatility and follow-through days over history indicate that the optimal threshold level remained at 1% for both indices from 1974 to 1998, then increased to 1.7% from January 1998 to December 2002, due to the evident increase in volatility in the months leading up to January 1998. This volatility stayed at a high level over this period until 2003, when the threshold level was readjusted again to 1.4%. It is important to note that the threshold level is not always the same for both indices, either. In January 2004, it was 1.1% for the S&P 500, as this index was showing clear signs of reduced volatility, while the Nasdaq Composite's threshold level remained at 1.4%. In 2008, when the market's volatility increased again sharply, the threshold level was increased again to 2.1% for the Nasdaq Composite Index and 2% for the S&P 500 Index. Currently, as of this writing in early 2010, the required percentage increase for the Nasdaq Composite and S&P 500 indexes to qualify as a follow-through day, their threshold levels, is at 1.5% for both indices. Therefore, currently, and keep in mind that this will be adjusted if and as market volatility changes in the future, our definition of a follow-through indicates that the Nasdaq Composite or S&P 500 indexes must be up at least 1.5% on increased volume from the prior day, often on the 4th through 7th days of a rally attempt off the bottom. Fail-safes. Should the model issue a false signal, fail-safes have been built into the model to minimize drawdowns. This would explain why the maximum drawdown over the model's entire 35-plus year run is just minus 15.7%. Yet the model's average annual return between July 1974 and December 2009 is plus 33.1%. Systematic versus discretionary. The model's back-tested returns from July 1974 to December 2009 were plus 33.1% annually, with a maximum drawdown of minus 15.7%. These theoretical returns were achieved by going 100% the Nasdaq Composite Index on a buy signal, going 100% short the Nasdaq Composite on a sell signal, or going to 100% cash on a cash signal. The signals are purely systematic, so there is no position sizing or override. The Nasdaq 100 Index, QQQQ, ETF makes an excellent proxy for the Nasdaq Composite, but note that the QQQQ did not exist prior to 1999. Thus, for consistency, we continue to use the Nasdaq Composite as the benchmark for calculating the model's performance based on its systematic signals. The discretionary portion of the model allows for discretionary override, should there be ample evidence to override the systematic signal. There is also discretion with respect to which ETF instrument is used. With 2 times and 3 times leveraged ETFs available for trading these days, leverage can be implemented or adjusted based on the use of such ETFs. This discretion is based on the strength of the signal, so that, theoretically, a very strong buy signal might cause us to buy a 3 times leveraged index ETF, such as the SPXU, for example. Chart examples. What follows are some actual buy and sell signals generated by the model along with our commentary. We have included the most challenging years of our trading careers, namely 2008-2009, so you can see how the model functions when fully challenged by difficult market conditions. We have also included the difficult period known as the crash of 1929-1930 to show how the model functions in an entirely different era using the same systematic rules. These charts should help give you a clearer understanding of the various types of follow-through days, FTD, and distribution days, DD, that can occur. Readers who have further questions should contact Dr. Chris Kasher at chris@machainvestors.com or can refer to the website address www.virtuofsilfishinvesting.com. A few notes about the charts. Black tick marks correspond to distribution days, unless the black tick has an explanation saying it is not a DD. B corresponds to a buy signal, S corresponds to a sell signal, and N corresponds to a neutralization of the immediate prior signal, whether buy or sell. Buy signals are neutralized during the trading day once the Nasdaq Composite trades below the lower of the following. 1. The low of the buy signal day, or 2, in the case of a gap up, the closing price the day before the gap up buy signal day. Of course, if a sell signal occurs, the buy signal is neutralized. If the Nasdaq Composite has hit new intraday highs for at least 5 trading days since the buy signal, then reverses, the buy signal is neutralized once the close of the day on which the buy signal occurred is exceeded on the downside. Sell signals are neutralized during the trading day once the high of the sell signal standby day is exceeded on the upside, or if a buy signal occurs before then. Once a number of distribution days are reached within a brief period, usually 5 in a rolling 20-day period, the model goes to sell signal standby. Once the low of the sell signal standby day is exceeded to the downside, the model issues a sell signal. After a buy signal, there may be distribution days that had accumulated before the buy signal day. Thus, a new sell signal standby could be issued if the next distribution day occurred within the 20-day rolling time frame period. To reduce the number of false sell signals, the model cannot go to sell signal standby on the first distribution day after the buy signal is issued unless that distribution day went below the low of the day on which the buy signal occurred. Market Direction Model Analysis 2009, First Half. We can follow the model's interpretation of the market action in Figure 7.5, the first half of 2009, as follows. 1. March 12 equals third day of rally attempt for Nasdaq Composite, which in this case and as in most cases is too soon. However, this is the 5th day in a rally attempt for the S&P 500 and thus counts as a follow-through day. The threshold level of 2% for the S&P 500 or 2.1% for the Nasdaq Composite is met. 2. April 22 equals churning days are unusually high volume days with little price progress and thus qualify as distribution days. Volume here is not large enough to count as a churning day, thus this is not a distribution day. 3. April 30 equals not a distribution day because it closed greater than 0.1% above prior day's close, and the upper tail of the daily price range is not long enough. 4. May 6 equals not a churning day despite the high volume and little price progress, thus not a distribution day. The lower tail of the daily price range was long enough. Market Direction Model Analysis 2009. Second half in Figure 7.6, the model interpreted signals during the second half of 2009 as follows. 1. June 26 equals not a churning day despite the high volume and little price progress, thus not a distribution day. The high volume was due to the Russell indices being reconstituted, which caused people to move into and out of stocks that were added or dropped from the various Russell indices, thus artificially boosting and skewing the overall volume. 2. August 28 equals distribution day, because the index closes down less than 0.1% above the prior day's close, and in the lower 25% of the daily trading range, giving it a long upper tail. 3. September 16 equals the S&P 500 index is up plus 1.53%, even though the Nasdaq Composite is only up plus 1.45%. Thus, the plus 1.5% threshold level requirement is met on at least one of these two indices. 4. September 18 equals churning days are unusually high volume days with little price progress, and thus qualify as distribution days. Churning days also tend to have wider intraday price ranges. This was thus not a churning day and therefore not a distribution day. Volume was artificially high due to options expiration. 5. October 6 equals the rally attempt count was not reset because the Nasdaq Composite Index corrected less than 6%. Thus is still in its original rally attempt and qualifies as a follow-through day. This is an example of an unusual situation where the follow-through day occurs well past the 7th day of the rally attempt. 2009 Commentary. The year 2009 was what William O'Neill himself called the most challenging year of his career, a career that spans over half a century. It was a year led by junk-off-the-bottom job stocks, while the more quality names often floundered. Many technical indicators that had worked for many years stopped working in 2009, since 2009 was the year of the Fed funny money market manipulations, as the Federal Reserve, in concert with central banks around the globe, injected huge amounts of liquidity into the financial system while holding interest rates near zero. Every time a correction seemed imminent in 2009, the market would stabilize and turn back up to new highs, as it ground its way higher in a choppy, whipsawed uptrend. Even the Decision Moose market timing site run by William Durlam, which has a sound track record, wrote the following in their January 15, 2010, weekly summary. Looking back, 2009 was the worst year I can remember for the Moose plus 1%, especially relative to the S&P plus 26%. Of the last 4 non-cash switches post-2008 crash, 2 T-bonds and gold were losers. 1 EP was a winner, and the latest ILF is flat to slightly underwater. It shows how government intervention can distort normal market activity by truncating trends and causing price spikes, bonds, and collapses, gold. It also shows how extremely volatile price action can render an intermediate-term trend following mechanism virtually useless in the short term. www.decisionmoose.com/uploads/2010.01.15 PDF. Table 7.1 shows top-performing trend following funds whose portfolio managers have been celebrated in Jack Schwager's Market Wizards books, Michael Koval's book Trend Following, and the highly successful Turtles investors. The Turtles were spawned from market wizards Richard Dennis and William Eckhart, who embarked on a program to prove that individuals who had the proper psychological characteristics could be taught to trade profitably. In the process, many of the individuals they trained went on to become highly respected and successful traders in their own right. As you can see from the table, many had a tough time in 2009, despite their prior exemplary track records. William O'Neill used to tell us that new bull markets always are around the corner. The window of opportunity will open once again. One just has to have patience and not take one's eye off the ball. That said, our Market Direction Test Fund, which we began with actual money on June 1, 2009, finished the year up nearly 30% after fees, and is up 53.8% after fees as of May 31, 2010. Despite the many false signals generated in 2009, the Dr. K market direction model made significantly more profit in correct signals than losses it took in false signals. This is due to a fail-safe that is built into the model, as I discussed earlier. The first highly profitable signal for the market direction model in 2009 was in gold. Gold had a perfect setup, breaking out on September 2, 2009. Figure 7.7. A breakout equivalent to earlier pocket pivot and standard base breakouts in gold seen in September of 2007, just before the yellow metal went on a sharp upside price run. Using the discretionary portion of the model, whereby we use the strength and context of the buy signal to determine which ETF vehicle to use, leveraged positions were taken in gold and gold-related instruments, such as the Market Vectors Gold Miners Index ETF GDX and the GLD. The model also did well in July on the long side in the Nasdaq Composite and S&P 500 indices when it took positions in the 2x leveraged Nasdaq 100 Index ETF QLD and the 3x leveraged S&P 500 Index ETF UPRO. Thus, during the June 1, 2009 to December 31, 2009 period, the model did very well the few times it was right, which more than offset the far more frequent times it was wrong. However, each false signal resulted in relatively tiny losses when it was stopped out. Thus, the market direction model fund was able to finish June 1, 2009 to December 31, 2009, up nearly plus 30% after fees. Note that in the FAQ section, which follows later in this chapter, there is a discussion of the hypothetical performance the model might have had in 2009 by going 100% long or 100% short, the 3x leveraged Dirksen Technology Bull ETF, TIB purely on buy, sell, or neutral signals issued by the systematic model. During the test period from the March 12, 2009, follow-through day to August 24, 2009, the date the calculations were made, a return of plus 90% could have been made, while keeping in mind one would have had to sit through a drawdown of 18.4%. Figure 7.12. Market Direction Model Analysis. 2008, first half. The first half of 2008 is shown in Figure 7.8. The numbers in the figure correspond as follows. 1. January 2 equals buy signal is neutralized intraday as the Nasdaq Composite Index moves below the closing price of December 20, 2007, before the gap-up day on December 21, 2007. C. A few notes about the charts at the start of this chart example section. Because today is the 5th distribution day in a rolling 20-day period, the model issues a sell signal standby. The next day, January 3, the model issues a sell signal as the Nasdaq Composite moves below the low of the standby sell signal day. 2. May 14 equals distribution day, because index closes up less than 0.1% over the prior day's close, and in the lower 25% of the daily price range. Market Direction Model Analysis. 2008, second half. Figure 7.9 shows the Nasdaq during the second half of 2009, with the model interpreting the action as follows. 1. May 16 equals distribution day, because closes down 0.19%, more than 0.1%. 2. June 12 equals not a distribution day for two reasons. 1. Closed in top 3/4 of day's trading range, and 2. Was up more than 0.1%. Nevertheless, the prior day's sell signal standby went to sell signal today since its intraday low had been broken. 3. September 25 equals not a follow-through day because neither the Nasdaq Composite nor the S&P 500 meets the threshold level of 1.5. 4. October 10 equals sell signal is neutralized on this exceptional day of record volume that closed in the top half of the day's trading range. Market Direction Model Analysis, 1929-1930. Figure 7.10 shows the Dow Jones Industrials in 1929-1930, with the model's interpretation of the action as follows. 1. September 25, 1929, equals not a distribution day because the daily price range has a long lower tail and the index closes down less than 0.1% on the day. 2. October 15, 1929 equals the model goes to sell signal standby, even though it is the first distribution day after the buy signal. This is because the index went below the intraday low of the buy signal day. See a few notes about the charts at the start of this chart example section. 3. January 16, 1930 equals the model does not go to sell signal standby because it is the first distribution day after the buy signal. See a few notes about the charts at the start of this chart example section. 4. April 11, 1930 equals this is churning on high volume and is therefore a distribution day, stealing the model's secrets. Even if some were able to reverse engineer the model and utilize it on a wide-scale basis, it should not affect the predictive nature of the model. Even if a large number of people were to buy or sell on the basis of the model's signals, there should be no effect given the massive number of highly liquid ETFs in existence, and this model is but a tiny grain of sand in a sea of ideas. The model is not a black box, thus a programmer would have a difficult if not impossible time programming the model into a computer. The rules used are subject to the quality of prior price/volume formation of the Nasdaq Composite and S&P 500. Thus, even though the rules are hard and fast for the systematic model, they still depend on this quality characteristic. Being able to size up quality is based on 20-plus years of experience in analyzing charts in detail since 1989. This nature of quality is perhaps best explained by way of analogy. In the years I worked with William O'Neill, his uncanny ability to interpret the innate quality of a base is nearly unmatched. I equate this to his decades of experience analyzing charts. For example, the difference between a great base, a good base, a marginal base, and all the degrees in between is contextual, and programming a computer to see the subtle differences would be quite the challenge if not impossible. Of course, a computer could be programmed to isolate specific charts that fit general characteristics, then those charts could be sifted through in more detail by human effort. But then, properly built stock screens already do much of that work. Timing model fact. Over time, I have found the most instructive way to teach is by the Socratic method, namely, by vigorous question and answer format. Here are the most common questions I have received over the years with respect to my Dr. K market direction model, Dr. K MDM. Should you have additional questions, please email me directly at chris@makainvestors.com or go to www.virtusilfishinvesting.com, as the existing queue and a file will be updated regularly. Should I expect returns similar to those achieved by the model? Keep in mind the model's returns are theoretical prior to June 1, 2009, and that high returns come with drawdowns that you may find are outside your comfort zone. Thus, choose 1 times, 2 times, and 3 times ETFs, depending on your risk tolerance. The market direction model is up plus 53.8% from June 1, 2009 to May 31, 2010. 1 year's returns in a test fund using actual money, with exposure to the market less than half the time. In a separate account that is not using actual money, I wanted to see how my system held up against a volatile instrument such as the 3 times technology ETF TYH, going 100% long on buy, 100% short on sell, and 100% cash on a neutral signal. Such instruments did not exist until the last year, so this gives big opportunity for profit that did not exist before. From June 1, 2009 to May 14, 2010, it is up plus 183.9%, and as of May 31, 2010, it is up plus 215.1%. Of course, due to the highly aggressive nature of this account, drawdowns as high as minus 18.5% were not unusual, but that is the price to pay to get to plus 215.1%. Note, had you been using a 1 times ETF, your gains would be roughly 1/3 of those shown, but so would your drawdowns. Thus, the worst drawdown recorded by the model is minus 15.7% in 1999, based on the Nasdaq Composite, which is, by definition, a 1 times vehicle. Also note, the long-term returns of plus 33.1% from July 1970 for January 2010 are based on the Nasdaq Composite, a 1 times vehicle. If one were to have invested in ETFs such as TYH that were roughly 3 times the movement of the Nasdaq Composite had they existed then, returns would be roughly 3 times the amount, but, more important, so would be the drawdowns. Figure 7.1 should give you an idea of how the model works. It capitalizes on trends when the signal is profitable as denoted by the moniker. Then a fail-safe mechanism kicks in to limit losses if the signal is false. For nearly 2 decades, the model has been a big driving force to our trading success as it keeps us on the right side of the market. The model's returns of plus 33.1% per year for the systematic portion date back to July 1974. The last few years have been highly challenging due to sideways, choppy, often trendless markets. That said, the model was still able to outperform with a plus 17.3% per year return going back to January 2005, beating the major indices and the top timing sites, and actual returns were greatly enhanced by buying top-quality stocks in top industry groups on buy signals, especially during mid-late 2006 and late 2007. Furthermore, a plus 51.9%, 17.3% X3 return could be achieved since the birth of 3 times ETFs, such as TYHTYP, that make good proxies for 3 times the Nasdaq Composite. In other words, such instruments tend to return 3 times what the Nasdaq Composite would return. That said, a plus 90.2% return could have been achieved from TYHTYP since the March 12, 2009 follow-through buy signal through August 24, 2009. The date the study was done, see FAQ below. Keep in mind you would have had to withstand a minus 18.4% drawdown on the way to plus 90.2%. For those with lower risk appetites, there are also the 2 times ETFs such as QLD QID and 1 times ETFs such as QQQQPSQ. In addition, keep in mind that results above do not include commissions, taxes, dividends earned, or money market interest earned while in cash from a neutral signal. And always remember, past results are not indicative of future performance. What are the strengths of the model? I see 5 key strengths. 1. The model has substantially outperformed the Nasdaq Composite and S&P 500 over every market cycle going back 35 years. From July 1974 to December 2009, returns are 33.1% per year. The model excels in catching intermediate-term trends, whether up or down. 2. The model has a self-protection mechanism, which keeps its drawdowns to a minimum. This self-protection mechanism results in more false signals, but typical losses on a false signal are just minus 1% to minus 1.5%. This results in a highly favorable risk-reward ratio, well outperforming the markets in every cycle going back to 1974. Its worst drawdown in its entire 35-plus year run was minus 15.7%. The Nasdaq Composite, by comparison, had a minus 78.4% drawdown. 3. The model buys the fundamentally strongest stocks at pocket pivot points and breakout pivot points when the model signals a buy. The website www.virtuofselfishinvesting.com provides stock suggestions so you can make potentially larger gains, since we all want to achieve that brass ring 100% return in a year's time if the market allows. 4. The model buys inverse ETFs or shorting ETFs when the model signals a sell. 5. The model uses 2 times and 3 times ETFs to boost returns, especially in this challenging environment. What are the weaknesses of the model? I see 2 key weaknesses. First, trendless volatile markets are the most difficult. This would include periods such as 1. May 4, 2009, July 10, 2009, 4 false signals in a row. 2. February 1999, August 1999, 5 false signals in a row, a profitable signal, then another 5 false signals in a row. This resulted in the model's largest drawdown of minus 15.7% in its 35-plus year run. As you can see in the performance figure above, the drawdown during this period is still small relative to the overall performance of the model. The Nasdaq Composite, by comparison, had minus 78.4% as its worst drawdown. Interestingly, I achieved my highest return for 1999 in both my personal account of plus 451% and my O'Neill firm account of plus 566.1%, because I went long the right stocks on buy signals. As an aside, my returns in my personal account were significantly higher than plus 451% because I did not invest money earmarked to pay for taxes that year, but kept it in my trading account. Thus, at a total tax rate of plus 50.5% federal, state, etc. My starting capital base that year, as well as for 1997, 1998, and 2000, was significantly less. However, there was no way using normal accounting standards that KPMG, who did the verification, could account for this. My higher return that Kevin Marder cites in his book The Best Conversations with Top Traders M. Gordon Pub. Group 2000 accounts for this. Increased volatility seen in 2009 has shown false signals to lose typically between 1.5 to 2.5%, instead of the normal 1 to 1.5%. Case in point, actual results from March 12, 2009 to August 24, 2009, the date this study was done, which experienced 2 uptrends and a period of trendless volatility, where the system had 4 false signals in a row. Figure 7.12 shows this graphically. As you can see, using TYH yielded a plus 90.2% return from March 12, 2009 to August 24, 2009, which is stellar. However, you had to endure 4 false signals, which totaled to a minus 18.4% drawdown on the way to being up plus 90.2%. Had you traded a 1 times EF instead, such as QQQQ, which is a good proxy for the Nasdaq Composite, you would have made a plus 27% return, but with just a 6.6% drawdown. You must decide your own personal risk tolerance. Keep in mind the model has outperformed every market cycle back to 1974, as well as January 1929, December 1932, and has had only 2 down years, 1993 and 2007, in its 35-plus year run. It has averaged plus 33.1% annually, July 1974 to December 2009. The second key weakness is that, on very rare occasions, the model may still issue a sell signal even though top-quality stocks are breaking out of sound bases. This occurred in March 1996 when stocks such as IOM broke out. I started buying such stocks, overriding the sell signal from my model. Fortunately, such times are extremely rare. Ultimately, when it comes to stock selection, let the stocks tell you what to do. If enough good names are breaking out of sound bases, start buying. If the names you hold are hitting your sell alerts, sell without question. How can I use this site to boost my returns since we are living in such challenging times? Returns can be boosted by going long or short, 2 times or 3 times leveraged ETFs that serve as good proxies for the Nasdaq Composite. Since many ETFs highly correlate with each other, there are many to choose from, including EWZ Brazil, FXI China, and India MSCI ETF, which is traded on the Singapore Exchange, and www.verdwafsilfishinvesting.com provides suggestions on which ETFs are likely to outperform. However, if you wish to stay as close as possible to the Nasdaq Composite, the best ETFs would be the 2 times leveraged bull and bear Nasdaq 100 Index ETFs, the QLD and the QID, and the 3 times leveraged Direction Tech bull and bear ETFs, the TYH and the TYP. You can also do what I've done since 1991, the first year I was able to handily beat the U.S. market averages. Buy top-quality stocks in top industry groups when my model signals a buy. It has been shown that in 2009, the market behaved abnormally. The best-performing stocks were low-grade, junk-off-the-bottom, job stocks, while higher-quality slim-type stocks completely underperformed. However, buying the highest-grade stocks at pocket pivot points in normal breakouts such as Shanda Interactive Games, SNDA, NetEasecom Entes, Baidu, Inc., Bidu, Green Mountain Coffee Roasters, Inc., GMCR, and STEC, Inc. STEC in March, April, and May 2009 would have produced solid returns. Don't create bad habits of buying junk just because the market is temporarily askew. How has the Dr. K market direction model done against some of the best timing sites in the internet? We calculated the performance of 2 of the best performing timing sites that have been on the internet for at least 5 years. The top performing sites, as tracked by TimerTrack, show 23 sites that have track records at least 5 years or longer. I omitted sites with shorter lifetimes since there have been a few that have been around since mid-2008, made massive gains on the short side, but the inherent logic of their system is suspect such that these models may underperform the markets once the highly unusual black swan period of 2008-2009 ends. Following are the total returns, not annualized, over the prior 5 years as of June 2009. Upon closer investigation, it seems many sites with 5-year or longer track records could not beat the markets, which should not come as a surprise. And the top 2 performers shown in the next table had stellar returns in 2008, which catapulted them to the top of the list and skewed their annualized returns to what you see in the next table. However, prior to 2008, their returns were less than impressive. Based on their annualized in addition, the maximum drawdowns in the Dr. K market direction model were lower, so the model beat the top 2 timing sites tracked by Timer Track on both an absolute return basis and on a risk-reward basis. Keep in mind that these 2 sites have logged signals real-time with Timer Track, whereas the model's signals are theoretical, but are largely responsible for my long-term audited track record as an investor in individual stocks for 2 decades. That said, the model's theoretical returns are based on my having bought 100% Nasdaq Composite. QQQQ is a good proxy on a buy signal. Shorting 100% Nasdaq Composite PSQ is a good proxy on a sell signal, and moving to 100% cash on a neutral signal. After examining Timer Track, I then focused on 3 sites I believe have sound long-term track records: Timing Cube, Decision Moose, and Investors Business Daily IBD Big Picture Market Commentary. IBD is an excellent resource I still use to this day. I focused on roughly the last 4.5 years, January 2005 through July 2009, which represent the most challenging period to timing models. These years were fraught with much sideways, trendless action as well as numerous false price volume signals in 2007. Mike Scott, a former engineer who is now a full-time individual investor and a notable market research and data wizard, showed me his spreadsheet of IBD's market calls all the way back to 1994. The big picture column began in 2003, but he painstakingly went through old issues of IBD to ascertain changes in market direction given by the paper. Next, I show IBD's returns going back to 1994 as well as over the prior 4.5 years when the big picture column was running. Here are the results of top-performing sites for the most difficult period, the prior 4.5 years. This comparison was made in August 2009. Reasons why the systematic portion of my model outperformed IBD's big picture market calls. It is important to keep in mind IBD is not putting out their market calls as a timing model for ETFs. Readers use IBD signals typically as follows: to buy the right stocks on a buy signal, to possibly tighten sell stops on a market under pressure or equivalent signal, and to keep stops tight and not buy any new stocks on a sell signal. IBD's big picture daily column should be read each day, and I believe IBD is the finest financial newspaper in the world. The Dr. K MDM results are based on having bought 100% Nasdaq Composite. QQQQ is a good proxy on a buy signal. Shorting 100% Nasdaq Composite PSQ is a good proxy on a sell signal, and moving to 100% cash on a neutral signal. Of course, results can be further improved by individual stock selection on buy signals. My model has a self-protection mechanism that limits losses regardless of price-volume action. The systematic portion of my model has no discretionary intervention. I learned over the several years I worked with William O'Neill that the market can fool even the best. I figured if someone with Bill O'Neill's market experience could get whipsawed in his market calls during challenging periods, perhaps it is better to stick with the set of systematic rules that have statistically proven themselves based on actual price-volume action of the major indices. Bill always said opinions don't matter, just the facts, and price-volume is as factual as it gets. That said, my model does have a discretionary component that I added in mid-2009. My intuition says the discretionary component can further boost the returns of the model, which is wholly systematic. But opinions do not matter, including my own. Time will tell whether my discretionary intervention can enhance my model's systematic returns. Even though I have great confidence in my abilities, I cannot assume I am immune to what caused whipsaws in O'Neill's own market calls during challenging periods. Sidebar: Here is where Bill O'Neill is one of the best, if not the best. He jumps on the stocks with huge potential near the beginning of a new trend, then pyramids his winning positions. This makes all the difference in performance and accounts for the years in which he has achieved triple-digit returns. The model has no gray area of what constitutes a distribution day or a follow-through day. The timing method that he discusses in his book caused some confusion among many followers of his methods. Some have asked, what if the day finishes higher by a small amount but has a shooting star tail? How do you define a distribution day caused by churning? How many distribution days over what time period are necessary to signal a sell? What is the percent threshold required for a follow-through day? Is it still a follow-through day if the volume is well under average but is still higher than the previous day? And so on. Why has the Dr. K market direction model done so much better over the long 35-year time frame from 1974 to 2009 compared to the past few years? The past few years have been extremely challenging for timing systems. These years were fraught with much sideways, trendless action as well as numerous false price volume signals in 2007. That said, there are ways to boost your return in these challenging times. Returns can be boosted by going long or short, 2 times or 3 times ETFs that serve as good proxies for the Nasdaq Composite. Since many ETFs highly correlate, there are many to choose from. However, if you wish to stay as close as possible to the Nasdaq Composite, the best ETFs would be the 2 times QID QLD and the 3 times TYH TYP. See the discussion on the returns the model would have achieved using the TYH during 2009 in the FAQ. What are weaknesses of the model of this chapter? Some market timing websites show huge returns. What should I watch out for? When you check the seemingly impressive returns on a timing site, here are very important questions you should ask. How has the site performed on an annualized basis since January 2005? Most all sites fall short here. The past few years have been most challenging to timing sites. Some sites that show high returns overall are due to making abnormally huge returns in 2008, while making only mediocre returns in 2005, 2007. Such inconsistent returns are likely to cause an ulcer. How many switches are made? Some sites switch 75-100 plus times a year. This drives up commission costs. Has the site switched its strategy midstream? Read the fine print. Some sites report high annualized returns, then show that the strategy was optimized midstream. In other words, they modified their strategy midstream, but their reported returns are skewed to reflect the best possible results. They may also skew their results by reporting returns as if the whole run were live, when in reality, it was only live since the modification to their strategy was made. The total return is massive. Ignore total return. It is meaningless. Total returns are often massive and therefore easily boggle the mind. For example, the model's plus 33.1% annual return since July 1974 would give a total return of 2,560,467%. Stated another way, $1 would have become $25,605. With enough time, the power of compounding is powerful indeed. Our book, How We Made Over 18,000% in the Stock Market in 7 Years, was titled that way because that huge percentage is intriguing to the potential reader. But this massive percent should be broken down into annualized returns, which make more sense. 18,000% averages out to plus 110.5% annually over these 7 years. As an aside, my annual returns were actually higher than plus 110.5%, because I did not invest money earmarked to pay for taxes each year when I was trading the markets, but kept it in my trading account, thus, at a total tax rate of plus 50.5%, federal, state, etc. Back in 1997-2000, my starting capital base each year was significantly less. However, using normal accounting standards, there was no way that the accounting firm of KPMG that performed the verification could account for this. My return of 70,000%, as cited by Kevin Marder in the book he co-authored with Mark Dupy, Conversations with Top Traders, accounts for this. Does the website show theoretical signals going back many years, but its live signals are less than a year old? This situation would apply to the timing model that appears on www.virtusilfishinvesting.com. This is the first time that the model's timing signals have been made available to the public. Do your due diligence. Check to see if the creator of the model has any prior performance track record or otherwise that demonstrates a high level of competence. Googling the name of the person who created the model can be an effective way to find information to get a clearer picture. In addition, keep in mind that some sites may boast high theoretical returns over a long period. It is essential to know if they possibly overfit the data to create those high returns. As discussed earlier in this chapter, overfitting occurs when excessive attention is paid to past data while failing to account for the system's predictive value going forward. This is a common trap that affects many timing systems, which is why so many fall short. The system may yield impressive results over a historical 20-year period because the parameters were fit to maximize profits over that period. But going forward, the returns will fall short because the system was overfit. What is discretionary intervention, and how does it apply to this model? While the primary force behind my model will be systematic since it has proven out over the years as a guide to my trading, I will on some occasions issue a sidebar discretionary signal to alert the www.Virtu Selfish Investing.com member. Again, while my intuition says such discretionary intervention should improve the systematic results, I hold to my original thought. I figured if someone with O'Neill's extensive market experience could get whipsawed during challenging, trendless markets, perhaps it is better to stick with the set of systematic rules that have statistically proven themselves based on actual price/volume action of the major indices. O'Neill always said opinions do not matter, just the facts, and price volume is as factual as it gets. Examples of discretionary intervention include enough leading stocks breaking out of sound basing patterns, such as we saw in March 1996 when stocks such as IOM were breaking out to new highs. A huge confluence of reliable secondary indicators showing either strength or weakness in the markets, which runs counter to the current direction of the model. Highly unusual one-time news events that are forward-looking that could override the systematic model. Should I use the systematic or discretionary portion of the model in my own trading? The systematic portion has the 35-plus year historical advantage. The discretionary portion has the advantage of position sizing and the occasional override. In practice, position size depends on the strength of the signal. I will give an example here that was a loser to illustrate the challenges of working with the model. It would be easy to give any of the many examples that were profitable, but I've always believed that more learning comes from challenging situations. Thus on the week November 9, 2009, by signal, I only bought a 50% position in QQQQ. As distribution days continued to mount, my model found itself on a standby sell signal. Once the sell signal was triggered on November 19, 2009, I immediately switched to a 30% position in FAZ, which is the 3 times leveraged Direction Financial Bear ETF. I switched into FAZ because the financials had lagged the major indices for months, and a 30% position in the FAZ is effectively a 90% short position in the XLF, the SPDR Financial ETF. I then bought an additional 30% position in FAZ once the Nasdaq Composite Index broke below the lows of November 19, 2009. Once new lows were made again on November 27th, I bought a 30% position in TYP, the 3 times leveraged inverse ETF called the Direction Tech Bear that is also a good inverse proxy for the Nasdaq Composite Index. It will rise when the Nasdaq falls. I decided to diversify into TYP, even though I was most bearish on the financials given the fundamental backdrop of the United States economy at the time. But I did not want to be too heavy in any one triple leveraged ETF. Having this 90% position in triple leveraged inverse ETFs put me at an effective 270% short exposure, and an average cost below where I had bought the 3 positions. Thus, I had reasonable cushion. In practice, investors can decide whether to work off the discretionary portion using leveraged ETFs, or the plain Jane systematic portion where the model simply goes 100% long or short the QQQQs if it is not in cash. Also note that after November 27, 2009, the market turned back up yet again as so-called quantitative easing by the Federal Reserve continued to help the markets move higher, a recurring theme since March 2009. After November 27th, the model's self-protection mechanism kicked in, which reversed profits but protected capital, so that losses were contained to less than 3%. What if I am only able to act on signals at the open of the following trading day? For signals that are issued either intraday, some users will only be able to act on the signal at the open the next day. In practice, this should balance out since on some days, the market may have moved lower, giving such users slightly better entry points than users who bought intraday, and other days, the market may have moved higher, giving such users slightly worse entry points than users who bought intraday. How can I know that your rules that guide your model will continue to work? The rules the Dr. K market direction model follow are not our rules, nor Wall Street's rules, but the market's rules. They represent statistically significant results culled from the major market averages going back more than 20 market cycles, back to the 1920s, as well as studies done on how the behavior of leading stocks and secondary indicators affect the market. We are in a highly unusual market environment, and with the advent of high-frequency trading and the like, a few question whether price-volume action and trend following are still applicable. My answer is a resounding yes. As mentioned earlier in this chapter, the market direction model TM is up plus 53.8% from June 1, 2009 May 31, 2010, in a test fund using actual money, with exposure to the market less than half the time. In a separate account that is not using actual money, I wanted to see how my system held up against a volatile instrument such as the 3X Technology ETFTYH, going 100% long on buy, 100% short on sell, and 100% cash on a neutral signal. From June 1, 2009 May 14, 2010, it is up plus 183.9%. And as of May 31, 2010, it is up plus 215.1%. The bottom line is that trends still occur even in these highly unusual times. Just ask Michael Koval, who wrote the excellent book Trend Following, which contains in-depth interviews with successful long-time trend followers John Henry, Bill Dunn, and Ed Seykota. And yes, while such noted trend followers have been encountering difficulty since 2009, they are no stranger to steep drawdowns, and in their 25-plus-year careers have always more than recovered, thus maintaining the integrity of their long-term track records. In their careers, there have been periods where trend following and price/volume action was declared dead, but what makes them unique is they continue to apply their systems through thick and thin, knowing the markets will always trend again. The key in creating any model is to be completely objective and listen to what the market is telling you as you study the data. The ego and the need to be right have no place in the world of model building. Once you have decided to use a model to guide your trading, thoroughly understand its weaknesses so you don't end up abandoning it. As prior examples of this, too many trend followers had declared trend following dead at junctures when the market stopped trending, such as 2004-2006. 1993, 1994, and 1976-1977. As 200 years of market history has shown, trends will occur often enough to keep the likes of William O'Neill, Ed Seykota, John Henry, and Bill Dunn gainfully employed. Is the systematic portion of your market direction model a black box in that it is computer programmable? This is only partially true. Some of the rules I have built are not black box but subject to the quality of prior price/volume formation of the Nasdaq and S&P 500. Thus, even though the rules are hard and fast for the systematic model, they still depend on this quality characteristic. Being able to size up quality is based on my many years of experience in analyzing millions of charts since 1989. This is perhaps best explained by way of analogy. In the years I worked with William O'Neill, his uncanny ability to interpret the innate quality of a base is nearly unmatched. I equate this to his decades of experience analyzing charts. For example, the difference between a great base, a good base, a marginal base, and all the degrees in between is contextual, and programming a computer to see the subtle differences would be quite the challenge if not impossible. Conclusion. The rules the market direction model follow are not my rules, nor Wall Street's rules, but the market's rules. They represent statistically significant results culled from the major market averages going back more than 20 market cycles, as well as studies done on how the behavior of leading stocks and secondary indicators affect the market. The key in creating any model is to be completely objective and listen to what the market is telling you as you study the data. The ego and the need to be right have no place in the world of model building. Once you have either built a model or use a model to guide your trading, thoroughly understand its weaknesses so you don't end up abandoning it. Too many trend followers, as one example, had declared trend following dead at junctures when the market stopped trending, such as 2004-2006, 1993-1994, and 1976-1977. As 200 years of market history has shown, trends will occur often enough to keep the likes of William O'Neill, Ed Seykota, John Henry, and Bill Dunn gainfully employed. Chapter 8. Our Bill of Commandments. When we talk about the 10 Commandments of Bill O'Neill, it is important to understand that we do not mean commandments that were issued directly by him, like Moses coming down from the mount with 2 stone tablets etched by the hand of God. For us, these commandments are more subjective, in that what we are referring to is a compilation of some of our favorite but less obvious rules and principles for life and the markets that Bill O'Neill conveyed to us on a daily basis, outside of what is found in his books and seminars. Our trading diaries are filled with scores of essential lessons that we have found can apply to life as easily as they apply to the stock market. Anyone who has spent over 50 years in an industry that sits at the hub of global enterprise, as Bill O'Neill has, will have certainly learned a few things about dealing with people, dealing in business, and dealing with all the moving parts of life in general. For the purpose of passing such information on to the reader, we find it simplest to distill these down to some basic ideas, concepts, rules, and principles that we can simply label the 10 Commandments of Bill O'Neill. Misconceptions. As well, there are many misconceptions and myths about O'Neill and his organization that we find preposterous, particularly those that are promulgated for the sole purpose of bringing the man and his methods down. A lot of it is born of envy, but most of it is just plain and deliberate ignorance of who and what O'Neill is. For example, in the midst of the grimness of the 2000-2002 dot-com bubble-bursting bear market, a professional portfolio manager was asked on financial cable TV when he thought the brutal bear market would finally come to an end. His response was immediate and contemptuous. This bear market will be over when that Momentum Investors newspaper, Investors Business Daily, goes out of business. In most cases, ignorance is bliss. But in this case, ignorance was little more than ignorance, as such a statement reflects a profound misunderstanding of Bill O'Neill and the O'Neill Organization, which includes not only Investors Business Daily, but also the institutional investment advisory and research firm of William J. O'Neill Plus Company, Inc., a nationally recognized and ranked publications firm called O'Neill Data Systems that prints much more than just chart books, and several other, smaller and not so smaller sister companies. If you were a portfolio manager at William O'Neill Plus Company, Inc., as we were at that time, you knew that the last thing that would ever happen during the bear market of 2000-2002 would be IBD going belly up. The O'Neill Organization consists of many different businesses, some of which, like the nationally top-ranked printing firm of O'Neill Data Systems, were strong cash cows, and so if any of the other organizations had a lean year, there were plenty of well-run enterprises elsewhere in the organization to pick up the slack. We can also tell you that the internal portfolio management group, which was essentially responsible for managing the organization's capital, also did very well. Bill O'Neill himself attests to this by writing in his book, The Successful Investor, that our internal money management group operating from our data analysis holding company produced a 13.56% net return in the 5-year period ending June 2003. It is clear that unless you can beat Bill O'Neill in the market, you cannot beat him in business, and where others may be forced to fold up their operations when profitability goes on vacation. O'Neill has the wherewithal and mix of complementary businesses to outlast the difficulties of down economic and market cycles, as well as the financial challenges of taking on startup ventures such as IBD was at one time. When we hear someone use the term momentum investor to describe Bill O'Neill, the investment firm of William J. O'Neill Plus Company, Inc., or Investors Business Daily, it is always meant in a pejorative sense, almost as a convenient shorthand for dismissing, discounting, and diminishing O'Neill and his methods. By using this pejorative sense, O'Neill's detractors imply that he advocates the mindless buying of high-octane stocks as they streak ever higher. In our view, nothing could be further from the truth, and we offer the following example as proof, one of the countless numbers of examples going back more than 25 market cycles, nearly 100 years. In 1999, one of the biggest winning stocks of that market cycle was Qualcomm, Inc. QCOM, shown in Figure 8.1. After a 14-month period of sideways consolidation as highlighted in Figure 8.1, QCOM broke out of a cup with handle formation and launched on a tremendous price run. At the time of purchase, QCOM is not exhibiting any real momentum per se, as it is only just starting to emerge from a long-term consolidation. At this point, the company is also showing huge earnings and sales growth, strong profitability, compelling products, and materially significant institutional sponsorship. When all the ducks are lined up, both fundamentally and technically, the stock is purchased. While there are prescribed add points on the way up, there is certainly no mindless momentum investing going on, as if how fast the stock is going up is the only criteria for purchasing the stock in the first place. If momentum investing means buying strong fundamental stocks with a large institutional following as they emerge from a proper consolidation or sideways range, and then capitalizing on the ensuing huge upside price move, then so be it. Otherwise, as Bill O'Neill would say, the portfolio manager who referred to IBD as that momentum investor's newspaper is all wet, surviving by keeping ego in check. With over 50 years of experience, O'Neill is, by sheer definition, a senior survivor of the professional investment business, and in the process he has seen many other professional investors and investment firms come and go. Most of the failures he has witnessed in the investment industry were caused by excessive ego and the dangerous psychological effect that sudden wealth can have on people who have a tendency to simply get carried away with money and themselves. Money is certainly capable of becoming the root of all evil, as it can lead an individual down unsustainable paths of self-indulgence. Because of this, the taste of significant and material success in the markets, as we discussed in Chapter 3, can absolutely be fatal. With more than 50 years in the business, O'Neill has more than a few stories to tell regarding the lessons of investment excess and folly. We recall several of these stories, such as the one about a broker he knew at Hayden Stone, a smart kid out of Yale who had bought a lot of big growth stocks in the 1960s like Brunswick and American Photocopy, and had made a lot of money. But when they started coming down, he began to proclaim his infallible approach as a newly declared long-term investor. To put it simply, he rode all these hot stocks all the way up, and he rode them all the way down, and in the process put himself out of business. Another fellow Bill knew as a broker was a guy who borrowed $150,000, a lot of money in the early 1960s, to leverage himself up into Solitron, a big high-tech glamour stock in the 1960s. The stock hit 275 and topped. He held it all the way down from 275 to 8, losing his job, losing his wife, and having a stroke after going bankrupt. These are lessons about what happens to those blinded by initial success with a stock, or in the market in general. In June of 1999, Bill pointed out the photo of Steve Case, CEO of .com Wonderkind Stock America Online AOL, which was making the rounds in the financial print media. The photo showed Case coming out of a government building after giving his testimony with respect to antitrust actions the U.S. government was pursuing against Microsoft, Inc. MSFT. Case had a big, smug smile on his face. Nobody understand human nature as well as Bill O'Neill, in particular when it came to the managements of certain companies who can get carried away as a result of their heady success. O'Neill recognized the telltale signs of overconfidence, which can lead some top corporate managers to become overextended and full of themselves. O'Neill correctly predicted that AOL's best days were likely behind it, and after making another retest of its highs in late 1999, AOL declined from a high of 267.76 in December of 1999 to 24.31 at the bear market lows in 2002, saving itself from the ignominy of the affair by buying out and changing its name to Time Warner, Inc. In 2000, a move that turned out to be ill-considered but not uncommon for a management that had taken on a false sense of omniscience and omnipotence. Bill O'Neill's approach to the business has evolved from his perception that in order to survive in this business, and even in life itself, one must maintain perspective and not get carried away with one's success and the trappings of wealth. He understands the pattern of psychology and behavior that ensues after one makes a lot of money in the markets. Once traders find they cannot duplicate this magic wealth creation feat immediately and at will, since it takes a nicely trending market to make such huge gains, and thus requires the market's cooperation, they resort to riskier trades, a conversion to long-term investing or leveraging schemes to maintain the growth of their wealth and expanding pattern of conspicuous consumption. In this manner, the organization reflects this ethic. The O'Neill campus, where Data Analysis, Inc., Investors Business Daily, William O'Neill Plus Company, Inc., O'Neill Securities, Inc., and the other O'Neill sister companies are located, is rather modest and Spartan. We used to joke that the big status symbol for one's office at O'Neill was not getting new carpet, but getting new duct tape to repair the rips in your old office carpet. All joking aside, you will not find a Google like habitat where extravagant and self-indulgent perks are an intrinsic part of the environment. You come to work for Bill O'Neill to learn how to make money in the markets, and lots of it, not to get a daily massage or have your laundry done. This frugal behavior is born from O'Neill's depression baby sensibilities, as well as an underlying wisdom and long-term understanding of how otherwise rational and successful investors become prey to the various ego and vanity-related psychological pitfalls of the investment business. And it is not as if O'Neill doesn't advise making one's stock market profits real by occasionally rewarding oneself with a new car, just don't make it a Ferrari, or some other recognition and reinforcement of a successful stock market investing expedition. But balance and modesty are always called for, and the lessons that O'Neill teaches in this regard are lessons that all investors and traders should heed. In many ways, the United States could learn a lesson here as well, since the financial crisis of 2009 was a symptom of the country getting carried away with the unsustainable concept of liberty and free money for all. The First Commandment. The first commandment among the many rules and principles applicable to life in general and stock market investing in specific that we heard many times from Bill was never get carried away with yourself. The basic idea is that one should remain impervious to the illusions and trappings of wealth, as they often lead one to become carried away to the point where excess of one sort or another ultimately leads to one's demise. This is critical. Despite avoiding failure and demise as a result of his experience in understanding the root causes of such common investor afflictions, there have been many who take a certain smug sense of satisfaction in trying to predict Bill O'Neill's demise, albeit with little luck. The comments of the portfolio manager cited at the beginning of this chapter, who predicted that the brutal 2002 bear market would end, when and only when Investors Business Daily had gone out of business, turned out to be quite wishful in their ignorance and inaccuracy, but are in fact not too uncommon. When you are successful, you can often become the target of another negative human emotion, envy. One example of this type of envy occurred when we had heard a rumor that O'Neill had taken a hit in semiconductor hot stock Cymer, Inc., SIME. Supposedly, the big break in the stock, figure 8.2, had caused big losses for O'Neill, and this was seen as potentially deleterious. If any of this was true, you would have known it by talking to Bill, who never loses focus no matter what the market throws at him. As it turned out, whatever losses that may or may not have been sustained in SIME didn't seem to have any effect on O'Neill, since even if it was a big hit, it was probably nothing greater than he had ever seen before and come back from in his long career. To this day, we still don't know whether this was true or just another rumor put out by those who had a sad desire to see O'Neill fail. But what we do know for sure is that 2 years later, O'Neill and his stable of internal portfolio managers, of which we are proud to have been a part of at the time, were putting up quadruple-digit percentage gains in the market. The Second Commandment. The ability to come back from periods of difficulty with courage and persistence is embodied in O'Neill's Second Commandment. Never operate from a position of fear. If you are fearful in the markets, either as a result of taking a recent loss or some other mistake, or even as a result of being nervous about the level of risk you are taking, then you are putting yourself in the position of making an unclear and hence incorrect decision. Either adjust your position to eliminate the fear, or come to the realization that if you are chronically fearful in the markets, then you have no business investing in them. This principle of always operating from a position of strength was also manifested in O'Neill's approach to business. As a firm, we were probably unique in that since we were so intimately tied to the stock market, we used it as a forecasting tool for our own business. When the market topped and a potential bear market began, we knew that the market was beginning to discount an economic slowdown. When this would occur, O'Neill would often order a 10% cut in each firm department's expenses, allowing the firm to get out ahead of a business downturn and actively place itself in a position of strength, prepared to deal with the oncoming economic train wreck. Operating from a position of strength also means having no debt, and so the firm did not rely on any debt in its operations. Cash flow was king, and with the regular and successful ventures into the stock market by the internal portfolio management team, the firm stayed well ahead of the game. Operating from a position of strength, therefore, also necessitates that if one is in a position of weakness, then that position must be corrected immediately so that the principle is adhered to. The third commandment. O'Neill deals with detractors and critics by turning their negativity into a positive. When it came to naysayers and backbitters, O'Neill simply invoked what we have labeled O'Neill's third commandment, and that is that you learn more from your enemies than you do from your friends. In typical O'Neill fashion, a negative is turned into a positive, and criticism from third parties is seen as little more than a potential learning experience. In fact, this rule embodies a certain level of truth in that it is your enemies who scour you and your activities, looking for any little flaw they can blow out of proportion to serve their ends, which is to bring you down. In the process, however, they can help to reveal areas where you may have a weakness or flaw, a deficiency, as O'Neill loved to say. Meanwhile, you can always depend on your friends to only see the best in you, which for those seeking self-improvement is not very useful. As a critic, O'Neill loved to play the role of the benevolent detractor, ignoring your successes, and instead focusing on picking apart and revealing your mistakes. As is standard in the proprietary money management business, we were each paid a percentage of the gross profits on the account we managed for O'Neill, so that if you were managing, say, $2 million and ran it up to $30 million, you would get a percentage of the gross profits of $28 million. In 1999, managing money for Bill O'Neill was the place to be when it came to compensation, and after a huge 1999, we might have expected Bill to come in with the big bonus checks and spray us with his adulation and admiration for doing such a fantastic job in 1999. No such luck. Instead, he immediately began going over his notes and reviewing all our bad trades and dumb mistakes. His conclusion: if you had done everything exactly right, you could have been up 1,000%, the fourth commandment. In this way, we became acquainted with O'Neill's fourth commandment: never stop learning and improving, and the only way to do this is by constantly analyzing your mistakes and correcting them. As we all know, everyone constantly talks about their successes in the stock market, but few focus on their mistakes. O'Neill makes a point of focusing on his mistakes, the fifth commandment. To this end, O'Neill invokes the fifth commandment: never talk about your stocks. The tendency to get excited and tell everyone how well you are doing in the markets is one that O'Neill abhors. By sticking to a simple policy of never talking about your stocks, you eliminate the ego-feeding urge to trumpet your success. Try implementing this rule and see how it changes your perspective on how you handle your stocks. The sixth commandment. The fifth commandment may in fact help you stick to the sixth commandment: don't get giddy at the top, because that is usually the time to be selling. If Bill O'Neill were given a choice of being able to use only one type of chart interval, he would pick weekly charts. At least this is what he once told us, and there is good reason for this. First of all, O'Neill shuns reacting to news and other noise, including unusual intraday price swings. Intraday charts to O'Neill are virtually useless. At one time, he felt that having real-time quotes were a distraction, since operating on a 20-minute delayed basis did not seem to be a burden to his applied temporal frame of reference. O'Neill is on the hunt for big stocks that are heavily trafficked in by institutional investors, whose deployments of cash constantly move into big, winning stocks that are at the cutting edge of any economic growth cycle. Institutional investors buy and sell their stock positions over a period of many weeks, sometimes even months, so their activities are not likely to be picked up by an intraday chart, and in most cases probably not by a daily chart either. For this reason, weekly charts are the preferred visual tool of choice. The seventh commandment. Thus, the seventh commandment is, use weekly charts first and daily charts second. Ignore intraday charts. Weekly charts eliminate a lot of the noise inherent in short-term fluctuations, while providing meaningful clues with respect to potential accumulation by institutional investors. The eighth commandment. The use of weekly charts as one's primary method of discerning accumulation in a particular stock is also in keeping with what we call the big stock principle, which distills the O'Neill methods down to their essential driving element, which is Commandment 8. Find a big stock, and then find a way to own it in size. The ninth commandment. Probably one of the most important rules that O'Neill taught us, and one which we have not always found it easy to abide by, is the ninth commandment. Be careful who you get into bed with. This has nothing to do with one's love life. Although in an age of communicable diseases, it still stands as practical advice in this regard, but rather who you deal with in life's more mundane business affairs. O'Neill believes strongly that trust and integrity between two people are the most important variables in life and in business, and it is not often that one finds this in their relationships and dealings with other individuals. In the investment business in particular, this is a critical teaching, simply because the investment area is full of Bernie Madoff-like characters who will steal you blind, as well as those of a less insidious, but just as insincere, phony and conniving class of individual that can be found in any business. When you do find people with whom you share deep integrity and trust, they become colleagues worth keeping in one's life, friends toward whom one will gravitate throughout life as anchors of trust in a world where finding trust and integrity can be a challenge. O'Neill used to say that life and business will throw plenty of enemies and detractors at you, so choose your friends, partners, and associates carefully and wisely. The 10th commandment. One of O'Neill's overwhelming traits is his intense dedication and passion for the markets, something that led us to postulate the 10th and final commandment: always maintain insane focus. Maintaining insane focus doesn't mean becoming a workaholic, since this implies that one is simply a mindless slave to one's job. What it means is finding one's passions in life so that the work that we do as we express these passions of ours is never really work. Not everyone is lucky enough to work at what they love, but to O'Neill it was something to strive for in life, and maintaining insane focus is another way of saying that people should always seek and pursue their passions in life, one way or the other. It is what makes life worth living, and by relentlessly pursuing our passions, we attain the state of insane focus that in turn drives high levels of success. In O'Neill's view, sitting around drinking beer, watching TV, and playing video games never struck him as a worthwhile, much less interesting, activity. As O'Neill used to say, don't just dabble, dive in. To understand this, it helps to understand that O'Neill never saw any reason to take a vacation. Vacations are for people who hate their jobs, and O'Neill would tell us that if we could afford to leave the office for a 3-week vacation, then we were proving we weren't very important to the operation. In 1999, we knew that the last time O'Neill had taken a vacation was in 1982, taking the family on a trip into the Oregon wilderness where they stayed in a log cabin with no phone, no television, and no other way to contact the outside world. As his son Scott and his wife related at the time when they each told us the story, Bill O'Neill brought up chart books, and for most of the time in the wilderness, he had his nose buried in these same chart books. After just a few days, O'Neill became quite bored and ended up leaving early to get back to his passion, the market, and the rest of civilization. O'Neill's insane focus meant that he could never find solace in any wilderness setting simply because this was not his passion. For some, such as the great wilderness photographer Ansel Adams, camping for weeks at a time in Yosemite Valley in the Sierra Nevada mountain range of eastern California is part of their passion in life, and in this regard, Ansel Adams displayed his own version of insane focus. Certainly, trading in the market was no more a part of his insane focus in life than camping in the wilderness was part of Bill O'Neill's insane focus. And that is the whole point to O'Neill Commandment 10. Conclusion. Overriding all of these rules that go beyond many of the rules most investors are familiar with through his books and other writings, is a basic concept of always striving to operate with purity and simplicity. O'Neill doesn't get bogged down with tracking a multitude of indicators, relying instead on pure price-volume behavior as an old tape reader to discern where the big money is flowing in any market environment. Through his own experience and study, O'Neill understands that some indicators have a limited lifespan and that 15 years was only a slice of the big picture. O'Neill keeps his system pure and simple. He doesn't get bogged down in minutiae. The indicators he does use have proven themselves over many market cycles. They were just as useful back in the 1920s, an entirely different era as they are today, because they are based on human nature, which has remained constant. O'Neill primarily relies on the elements of price-volume behavior of the leading stocks and major indices on weekly and then daily charts, the shape of the patterns the stocks and indices trace out, relative strength, the relative strength line confirming new highs, institutional sponsorship, the accumulation distribution rating, group rank, and the 50-day moving average. If you want to witness simplicity in action, work with Bill O'Neill, and you will soon realize that all your market indicators, gadgets, and gizmos are not necessary to the process of making big money in the market. Since we both left the nest of O'Neill several years ago, the essential truths behind these commandments have become obvious to us as we have dealt with the world outside of O'Neill. In any case, they are useful guideposts by which you can govern certain aspects of your conduct, attitude, and behavior, and hopefully help you stay focused, stay on track, and as Bill O'Neill used to advise us, keep your nose clean. Of course, all of these commandments were conveyed to us while we were managing money for Bill O'Neill, during a time when we were working in the trenches with the man, an unforgettable learning experience we cover in detail in the next chapter. Chapter 9, In the Trenches with Bill O'Neill. The period of 1998 to 2005, particularly the dot-com bubble and crash, were exhilarating periods to be working at William O'Neill Plus Company, Inc., managing money for the firm alongside Bill O'Neill and other very knowledgeable and talented traders at the firm, such as 1994 U.S. investing champion Lee Freestone, Al Savoyan, Ross Haber, Charles Harris, and Mike Webster, to name a few. They say that timing is everything, and we both were very lucky to be managing money at William O'Neill Plus Company, Inc. during the latter half of the 1990s, a decade that featured a parabolic move in the market, figure 9.1. Working closely with Bill O'Neill during this fascinating market period, as well as the ensuing 2000-2002 bear market, and the new recovery bull that began in 2003, provided one-of-a-kind lessons as we took careful notes of our real-time market discussions with him on a daily basis. What follows is an abridged edition of our combined trading diaries during our tenures at the firm, each of which could constitute an entire book in its own right. 1997, 1998. Late 1997 was a difficult time to make any money in the market, and by early 1998 the market was pushing into new high ground following the sharp market break and correction that culminated in a 554.26-point sell-off in the Dow Jones Industrials, the largest point drop in its history at the time, on October 27, 1997. In late February, Bill O'Neill observed that leadership in the rally to new highs was being shared by growth stocks and larger cap, consistent earnings generating, established companies. As he would advise at the time, this is a two-pronged market today. Stick to companies with earnings consistency. This is what institutions are likely to buy. Larger cap stocks of established companies with steady, reliable earnings growth of 10-15% and a long-term record of profitability, while not attractive as classic high-growth can slim-type stocks, do have periods where they come into favor by institutions. And in this sense, O'Neill was relying on his understanding of what we have come to call the big stock principle, as he concluded what institutions were likely to buy in the market environment of 1998. In his observations, O'Neill emphasized that the simplest, most reliable way to identify leading groups in any market cycle is to pay close attention to the new high list and note which groups are consistently making the list. There is no need to create industry group velocity charts, no special color coding of industry group movements, and no reliance on so-called top-down analysis. Industry group comparison invalid. One group moving well in early 1998 was the Computer Software Services Group, adding some confirmation to the strong action in personal computer maker Dell, Inc. Dell, which by April of 1998 had staged two buyable breakouts following the market low in late 1997, as Figure 9.2 shows. Dell's upside trend was a relentless continuation of a price move that began in 1995 and continued right into the market top in March of 2000. The Personal Computer Group was a strong one in 1995, and the Computer Software Services Group, including stocks like Computer Business Solutions, CBSL, CompuWare, CPWR, and Computer Sciences, CSC, was a follow-on type of play to the move in PC stocks like Dell. A large installed base of personal computers, particularly in the business world, meant that companies providing technical and other services for personal computers, PCs, would find fertile ground for growth. Many analysts at that time viewed the move in PC stocks in the 1990s as being like the move in television stocks like Motorola Mott during the 1950s and 1960s, for example, and so felt that this comparison and historical precedent, as they saw it, meant that PC stocks had more or less run their course. O'Neill vehemently disagreed with this assessment, as he felt televisions were purely for entertainment, whereas PCs were more of a knowledge tool for creating efficiency in the workplaces and organizing our personal lives. For this reason, he felt that any comparison to the move in television stocks in the 1950s and 1960s with the move in PC stocks in the 1990s as overly simplistic, as it was not an apples-to-apples comparison, and hence was not valid. In the first half of 1998, the weekly chart of Dell was confirming O'Neill's view, and offered clear proof that price-volume action tells you everything you need to know. Hence the opinions of analysts who tried to intellectualize about the potential price moves of PC stocks by comparing them to the television stocks of the 1950s and 1960s were entirely useless. When we were looking at the Dell chart in April of 1998, it was showing very tight price-volume action as it moved straight sideways, closing tight for 4 weeks in a row before launching higher as we see in Figure 9.2. Notice also that the 4 weeks circled in Figure 9.2 showed 2 weeks up and 2 weeks down, with trading volume higher on the 2 weeks that were up and which had found support off the 10-week moving average, while volume declined on the 2 weeks down in that tight little consolidation. O'Neill commented at the time that this sort of pattern could just be bought right in the handle given how tight it was closing and the associated support off the 10-week or 50-day moving average, an incredible nose for market action. As the market moved into April of 1998, it had been steadily moving higher in a very tight, coherent trend that began in February and continued throughout March. O'Neill considered this very constructive. As he pointed out, tightness in the indexes while in an uptrend is constructive. Figure 9.3 shows this tight trend in the Dow Jones Industrials Index. What is significant here is that once this characteristic changes, in other words, the tight, coherent trend begins to morph into a volatile, choppy, and decidedly less trending state, it gives a strong clue that something is amiss. Indeed, the market began to wobble in the summer of 1998, and while the major market indexes were all able to make a marginal higher high by mid-July 1998, this breakout to new highs was a bull trap. And the market quickly began to fail to the downside, as the continued shockwaves from the Asian contagion of 1997 that caused the big October 27, 2007, break in the market began to hit the headlines. O'Neill could smell something, which told him something was very wrong. On May 28, he called to point out, banks and brokers were hit hard today and did not rally. The financial crisis could be spreading. There is validity to the Asian crisis. It's not just some news but a lot of news. Problems in the Philippines and Indonesia, among other places on and around the Asian continent, were creating palpitations in the market. And it is interesting to note that the break in brokers and banks on May 28 occurred as the tight, coherent trend of February through March, Figure 9.3, changed character, and the market began to wobble around its highs. Merrill Lynch MER, shown in Figure 9.4, gapped down hard on May 28. But this did not lead to any further serious price breaks in the stock as it turned around and broke out again in early July. However, it gave off a certain odor, certainly one that O'Neill did not like. When MER and other financials like Lehman Brothers (LE) and Morgan Stanley (MS) tried to break out into new high-price ground in early July 1998, they all failed and began to break down severely in a classic bull trap. Note the descent of MER's chart as it began to break below its 200-day moving average in late August. Investors who witnessed the severe breaks in financials in March of 2008 might notice the similarity to the 1998 break in financials. By mid-August, O'Neill noted the 12-year cycle followed by big downside market breaks in recent history, such as in 1962, 1974, and 1987. As the market began to roll over in August, O'Neill saw another big market break coming on the heels of this 12-year cycle. He projected that, right now, the market looks like it will need to undercut the low at 7,500. We can project downside risk to 7,500. Mutual funds are loaded up with stock, and they can't do anything about it, so they will start to have their performance questioned, creating fears that they won't be able to come back. Notice that the NYSE short interest ratio currently shows zero shorting on the way down. This is ominous. As a tape reader from the old school, Bill O'Neill has an incredible nose for the market, and his sixth sense derived from years of experience and careful observation gives him an uncanny ability to sniff out a change of character in the market. As the tape began to act in a way that he considered ominous, he surmised that its character was signaling a drop of significant magnitude. O'Neill always looks at market declines and their potential magnitudes within the context of the longer-term chart. As the market began to break in late August of 1998, a logical endpoint for the decline was, as he saw it, a likely undercut of the lows of early 1998, as Figure 9.5 illustrates. The intraday low of the lowest close in January of 1998 was around 7,500. Hence, O'Neill quickly concludes that this is the first likely area for the market decline to stabilize and attempt to bottom. Price undercuts of large support areas often fake out the crowd, which sees such breaches of support as an area to sell stock aggressively or even to go short. And as we all know, when the crowd leans one way, the market will usually lean the other way. As the indexes sat on top of their 200-day moving averages, O'Neill observed, support at the 200-day is too obvious, so it will probably break it. At this stage, he emphasized that while we would watch our stocks first and the indexes second, nevertheless, it is very important to stick to your sell rules. Always being one to interject some optimism and positivity into the conversation, he quickly added, "It's also important to have a rule that will keep you in a stock once you buy it. For example, if you buy a stock on a breakout, then you must stay with it for 6 weeks or until it hits the 8% stop-loss point." While this comment had nothing to do with what was going on in the market at that time, it is interesting to note that this quote from O'Neill in our trading diaries shows that as the eternal optimist, he always has one eye on the bull side of the market and is just as worried about selling a stock too soon before one has given it a chance to work as he is about following sell rules in a market decline. O'Neill was dead on in his projection of a market undercut and bottom at around the 7,500 price level on the Dow, as Figure 9.6 shows. 5 days off the first low in early September, the market staged a follow-through day, but O'Neill felt this was too soon after a 6-week decline. Nevertheless, he felt that the correction was likely over as he set forth his assessment. A short correction of only 6 weeks, but which is greater than 20%, is a bear market. It is possible the adjustment has been made and we probably need some time to back and fill. While many believe that a bear market had to last a certain amount of time to be a valid bear market, O'Neill understood that a downside break that was of sufficient magnitude and velocity to scare and shake every last seller out of the market could easily constitute a valid bear market, sizing up the collapse of long-term capital. By October, the collapse of a hedge fund known as Long-Term Capital was causing a stir. The fund had relied heavily on leverage in implementing the strategies of its PhD brandishing, Nobel Prize-winning portfolio managers, and so had borrowed heavily from banks and brokers of all stripes, and its collapse in turn led to fears of a domino effect, whereby the global financial system would begin to melt down. But when the Fed stepped in and lowered rates by 25 basis points, or 0.25%, on October 14th, in response to the long-term capital crisis, the market was immediately off to the races. Interestingly, most market participants remained shell-shocked by the frightening events and simply could not believe that the market could turn out of this so quickly. As well, most market strategists made the fatal error of considering a 6-week, 20% correction in the market as insufficient for a bear market, and hence were calling for additional downside once the market finished consolidating this latest downside leg in what they saw as a continuing bear market. Despite the fact that the crowd was skeptical, O'Neill reverted to his Livermorian core as he noted, "Basic economic conditions right now are not as bad as other bear periods," making the case that underlying conditions were sufficiently positive to support a rally attempt by the market. A controversial stock recommendation. Sometimes O'Neill would make a statement to the institutional clients of William O'Neill Plus Company, Inc., by making a controversial selection to put on the firm's institutional buy list, known at the time as the O'Neill Select List, but which most followers of O'Neill know as the New Stock Market Ideas or NSMI service, containing recommendations on both the buy and avoid side of the market to institutional clients willing to pay $65,000 and up for such a service. You had to admire his boldness in seeking to demonstrate his confidence in underlying conditions by selecting a retail stock, TJX Companies, TJX, as a buy recommendation for the O'Neill Select List. However, this selection came as a bit of a shocker, since TJX was just coming up off its recent bear market lows, as we see in Figure 9.7, and we can only surmise that O'Neill intended it this way for the express purpose of making a statement about his market view at the time in what we used to call classic Bill mode. O'Neill understood that the U.S. economy is primarily a consumer economy, and this was observed empirically in that most historical big winners in the market over history had a consumer orientation. Further background to this recommendation comes in the form of comments O'Neill made to us in February 1998. As we noted in our trading diary, consumer retail stocks should be emphasized at this time. Over the last 4 or 5 years, the tech sector has been the glamour group, which has performed well, while the big retailers like Walmart and Home Depot sat it out. Now Bill sees them beginning to retake a leadership position due to the general economy and the impact of baby boomer spending. Bill sees a big move in these stocks from here, which could have the same magnitude as the move they had in the early 90s. Also, brokers can be considered part of the retail boom. Schwab, Merrill Lynch, Morgan Stanley, etc. are all becoming more consumer-oriented, and financial services is taking on a broader appeal as more highly educated baby boomers begin to emphasize their own financial futures. This makes them more like consumer stocks. Finally, the internet stocks can be considered retail stocks as well, and this further confirms the coming retail boom. When O'Neill put TJX on the institutional buy list, it caused quite a stir as some wondered whether he had fallen off his rocker. But as he explained, it looks like bottom fishing, but there is an important concept here. First, TJX is a leader in discount retailing. It corrected 50% with 3 waves down. After the third wave down, the need to sell is too obvious, and it also undercut the low on the handle formed in January 1998, which is a logical bottoming point. It is typical in a bear market for a good stock to drop deep into its prior base. As Figure 9.7 shows, O'Neill was far from being off his rocker, and TJX continued higher, nearly doubling from where he had recommended it. This recommendation became notable not only because it worked, but because it demonstrated to our institutional clients that we had techniques for buying stocks off their bottoms, as institutions overwhelmingly love to buy things when they are down. After all, who do you think creates all that support along the lows in the base formations of leading stocks? Institutional clients provide insight into sponsorship dynamics. During difficult or unsettling times in the market, it was common for O'Neill to meet with some of our largest institutional clients. Among these was Boston-based Fidelity Management and Research, O'Neill's first institutional client in the business. O'Neill loved to tell the story of how, as a 26-year-old broker at Hayden Stone in the early 1960s, he first called Jerry Tsai, manager of the flagship Fidelity Fund back then, and started giving him stock ideas that worked out very well. Tsai gave the upstart O'Neill a 5,000 share order, which at the time was a huge ticket to write, as it meant some nice commissions would be earned. O'Neill knew that the account was being handled by a senior partner at Hayden Stone, and so he went into his sales manager with the order. The manager saw no reason to turn down what was good business for the firm and told O'Neill to go ahead and send it into the wire room for execution, and that they would work out the conflict with the senior partner later. As it turned out, Jerry Tsai insisted that O'Neill be put on the account and earn the commissions, which was fair considering that the order resulted from O'Neill's ideas and not those of the senior partner. We remember during an IBD workshop in 1995, long before we worked at the organization, Bill O'Neill got up in front of the audience and held his palms horizontally, facing and parallel to each other, separate by about 2 feet of vertical space. He then said, "Fidelity gets a stack of research this big from us every week." O'Neill is well regarded by his biggest institutional clients, and going in to see a manager of some $100 billion fund somewhere was a routine affair. Generally, O'Neill would go in and present a fund manager of such stature 8-10 of his biggest stocks and best ideas in the market at any given time. In this manner, O'Neill also has gained an intimate understanding of the workings of the minds of institutional portfolio managers given the array of challenges and objectives that they face. Coming back from one such meeting in October of 1998, where he had just met with the manager of a fund with 12 figures in assets under management, O'Neill pointed out that a fund this size could take 3 to 6 months to sell a 3% position. He also pointed out that as a big index like Microsoft, MSFT, goes up, it often becomes a bigger percentage of the S&P 500. So any money manager who benchmarks his performance against the S&P 500 is forced to keep up by becoming more heavily weighted in the stock, and so is compelled to buy more. This in turn drives the stock higher in a spiraling effect. Disagreeing with Wall Street. By December 1998, O'Neill was quite bullish. On December 2nd, a report came out from a major market strategist asserting at the time that since new highs had not been confirmed by breadth, and only 6 of 30 Dow stocks were at new highs, the market was simply going to have a good rally without longevity. The strategist cited the fact that the broad market was lagging the Dow, and that European markets did not confirm the moves in U.S. markets, adding that he would not be surprised if the market retested its October lows. O'Neill quickly pointed out that our methodology does not rely on breadth confirming new highs, and that Europe, beset with lagging semi-socialist economies, was not relevant. As well, O'Neill considered the Dow irrelevant since it was not leading at the time anyway, figures 9.8 and 9.9. O'Neill was more focused on giving credit to the Fed rate cuts, which lay the fundamental foundation for our firm's case. Wall Street's obsession with the Dow and with breadth confirming was always something that O'Neill could not understand, and his voice would sometimes take on a vociferous tone as he would bark his views over the phone with decisive precision. O'Neill insisted that it is the leading index that is always telling you what is going on in the market, and at the time the Nasdaq was in the process of overtaking the Dow, as figures 9.8 and 9.9 show. While we do not show an advanced decline line on these charts, breadth was in fact coming up strongly off its lows, hence the improvement of breadth at the margin was significant. Concerning oneself with what the Dow was doing, what 30 old economy stocks were doing in an otherwise vibrant era of internet connections and shrinking cell phones, was utter nonsense to O'Neill, who felt at the time that market analysts were underestimating the depth of the economy. As always, O'Neill looked to the market for confirmation of his views, and he saw that something stronger was clearly going on under the surface, as evidenced by the steepness of the trend, as the market came up off the bottom with tremendous power and strength. In hindsight, we know what that was, and it was the initial tremors of what would later become the dot-com bubble market of late 1999, as the Nasdaq shifted into high gear and rapidly left behind its larger cap. Old economy, brethren, the S&P 500 and the Dow Jones Industrial Index. In October-December of 1998, a number of deep chart patterns were working very well, which was a bit unusual. However, it was necessary to make this adjustment and allow for more volatility in chart base patterns due to the market's rapid and steep correction of 20% in only 6 weeks. Also, there were examples of historical market environments where such patterns showed similar jagged behavior, particularly in their handles, such as PeopleSoft PSFT in 1994, shown in figure 9.10, which has since been acquired by Oracle Corp. Oracle, PSFT formed a long macrobase consisting of two failed breakouts from improper subbases within the overall structure. The third base was relatively more constructive than the prior two failed subbases and had a deep handle, which looked wrong. But the breakout from this base ended up working as PeopleSoft had a huge move from that initial, correct buy point. In 1998, we saw similar jagged patterns in stocks like America Online, AOL, Charles Schwab Corp. Schwa, shown in figure 9.11, and even Sun Microsystems, Sunwa in 1998, today Java. At first O'Neill wasn't sure what to make of these patterns, but enough of them were working by December 1998 to confirm that the exaggerated price ranges in their chart bases were indeed a function of the market's correction of 20% in only 6 weeks. PeopleSoft is also instructive in that it illustrates the rule of 3, whereby a stock will form a large macro-base structure, as it tries to break out of 3 successive sub-bases within the overall structure, but fails on the first 2, only to succeed on the third try. O'Neill believed that the rule of 3 was valid because the first 2 breakouts that failed conditioned the crowd to expect the third breakout to fail. But as the market always seeks to fool most investors most of the time, it ends up working. We saw this sort of formation occur with Charles Schwab Corp. Schwa, in October of 1998 with the third breakout from a cup with handle, subbase, working as the stock launches higher. The jagged V-shaped handle is due to the steep correction in the general market. It is important to understand that one should not get overly focused on the precise shape of a base, since it must be taken in context with the pattern that the general market is tracing out. If the general market is extremely volatile, this will also likely show up as more exaggerated and jagged action on the charts of individual stocks. 1999-2000. Observant readers will notice that the chart of Qualcomm QCOM in 1999, which is shown at the beginning of the previous chapter, figure 8.1, is also similar to the examples of PeopleSoft and Charles Schwab in figures 9.10 and 9.11. Amazon.com, Amazon, in 2009 also had a similar rule of 3 type of setup, as figure 9.12 shows. 2 prior breakouts within a macro base that is actually trending upwards very slightly both fail before the third breakout from a cup with handle base works. Again, the crowd is conditioned to believe the stock will not succeed on the breakout by the third time, and the crowd, as is often the case at turning points, is fooled. Once Amazon cleared the top of the cup with handle base, it formed in late September 2009. It never violated its 10-week, 50-day, moving average before launching up through the 100 price level into all-time price ground. In any case, the precedent of PeopleSoft in 1994 was helpful in discerning these jagged bases, and stocks like America Online, AOL, and Charles Schwab Schwa were rocketing higher. On March 16, 1999, we put out a price target on Schwab based on some similar historical examples, as well as some simple price target analysis based on earnings growth, forward earnings estimates, and any potential P&E expansions in Schwab. At the time, Schwab was trading at a split-adjusted $90 a share, and O'Neill was looking for a $140 price target on the upside. Most of the institutional sales force was incredulous, thinking that Schwab had come too far too fast. Again, the misperception of overwhelming upside strength as a reason to be negative on a stock because it is just too high is seen at work here. In about 4 months' time, Schwab had gone from a split-adjusted $28 a share to nearly $90, and it wasn't finished yet. O'Neill was using an historical precedent in establishing his price target for Schwab. He had noticed that Quatron Systems, a hot stock back in 1979, had come out of a similar base as Schwab's, and the magnitude of its move indicated that Schwab could go to 140. As it turned out, Schwab eventually topped out at 155, a little higher than O'Neill's 140 price target. The use of historical precedents. Using historical precedents when trying to figure out possible price targets for stocks he owned was one technique O'Neill employed when trying to figure out just how far a big, winning stock that he owned could go. O'Neill believes that the chart patterns are essentially maps of psychology, and that chart patterns will remain useful as long as human psychology remains the same. For this reason, He felt that if a stock he owned today exhibited very similar chart characteristics to a big, winning stock from the past, then using the stock from the past as a historical precedent in order to guide his handling of a stock in the present was valid. In the case of Schwab and its similarities to Quatron Systems of 1979, it turned out to be quite valid. O'Neill understood that it is the big institutional investors that run the market, and since big fund managers all think the same, then the chart patterns of the stocks they traffic in generally will show their psychology at work. O'Neill looked for institutional support, and in his observations, he found that stocks which have upside price runs and then consolidate, forming a base structure of one sort or another, usually need 5 weeks of pulling back in order to digest their gains as some institutional investors finish accumulating their positions and others sell part of their positions after the stock has run up, because it has either become overvalued within their framework of how they look at stocks, and also because they will trim a position that goes up too far, too fast, and hence becomes a larger than normal percentage of their portfolio. For example, if fund manager can only have 2% maximum position sizes in his fund, and he buys 2% of stock XYZ, which then doubles, becoming more like 4% of the portfolio, he may have to cut that position back to 2% if it becomes too heavy of a weighting in his portfolio. As this process occurs and the stock consolidates, other institutions who like the stock will accumulate on pullbacks. One interesting rule that O'Neill had was that after a stock has consolidated and built a base of at least 5 weeks, then usually the stock can be bought on pullbacks that are near to or undercut the prior low of the base in the 6th week or later. In many cases, after a stock has based for at least 5 weeks, the 50-day or 10-week moving average has a chance to catch up to the stock, at which point it serves as critical support. By the end of April 1999, O'Neill was beginning to have his doubts about the market, which was in a choppy uptrend and running into some trouble as the Dow was trying to clear the 11,000 level. Distribution in the form of higher volume down days as the Dow approached the 11,000 mark looked suspicious to O'Neill, particularly when he combined this with the action in leading stocks. As we quote him in our trading diaries, one of the problems is that most, if not nearly all, of the big leaders have undergone serious distribution and liquidation. Even the retailers, which are considered a steady, stable sector, are getting hit. Pointing out the current weekly chart of Home Depot HD shown in Figure 9.13, O'Neill gave a quick assessment of what was wrong with the stock. It broke out at 20 in early 1998 and ran up to the 50 area, then built a big, loose base in the summer-fall of 1998, broke out again in October, then had a smaller run up to 60, and then built a base around 55-60. There are only 2 down weeks in that base on the left side, which is characteristic of an improper base. You need to see 4 to 5 down weeks on the left side, which allows the psychology to set up correctly by shaking out all the weak holders before it moves up. The 3 weeks before it broke out were all wedging up slightly. Author's note: O'Neill is a natural teacher with a natural feel for developing talent in this manner, and these short market school sessions where he would call us to talk about a real-time example in the market that illustrated a lot of the concepts he teaches in his books and workshops were always a privilege and a treat, given that we were receiving one-on-one, real-time instruction from one of the stock market's greatest mentors. This concept is very important in order to understand a proper base formation. O'Neill was concerned that breakouts from improper bases were failing, as in the case of Home Depot, and this was a bad sign for the market. Note the 3 waves down type of structure, similar to the example of TJX Companies, TJX, in Figure 9.7. The critical point here is that the base Home Depot formed in early 1999 only came down 2 weeks before it started drifting back upward again. As it tried to break out in late February, it was not pulling back but was instead wedging along the lows for 3 weeks as it drifted higher on light trading volume. Normally, a stock should pull back a little as volume dries up before launching out of a base. Because Home Depot's base was faulty, by late April 1999 it was starting to roll over. 1999, a challenging year. Throughout much of 1999, the market's trend was a slow, choppy, and grinding upside affair that would break out to new highs and then pull back in again, which it did several times in succession. All the while there were reasons to become bearish and reasons to become bullish. Throughout all the chop and slop, there were some stocks that continued to go about the business of breaking out of sound bases, moving up, building another base, breaking out, and moving up again. Most of these were stocks that were simply stair-stepping their way higher as they slowly built up for the parabolic move that was coming at the end of 1999, but which nobody saw coming in late spring. On May 20, O'Neill called to discuss two of these new leaders, Broadcom BRCM and QLogic QLGC, and to go over how to set price targets for Broadcom. O'Neill frequently discusses how to use price-to-earnings ratios and their associated expansions during a stock's uptrend to come up with price targets, but there are actually 3 different methods that can be used. We've already seen how O'Neill used the example of Quatron Systems in 1979 as a historical precedent to set an upside price target for Charles Schwab Corp. Schwab, which had a similar chart pattern. This is the second type of method he employs to determine price targets. And there is a third, even simpler method, which O'Neill describes as follows as we observe the chart of Broadcom in figure 9.14. Note that the chart is not split adjusted. So prices mentioned in the following diary entry are 3 times the prices shown in the charts, which we put in parentheses. If you have a big position in Broadcom and have pyramided properly, now you have to figure out where the stock could go to. This is the more difficult half of capitalizing on a big winner. Buying the stock is easy. The process can go one of 2 ways. First, look at the prior base, which was formed from July through September 1998. The stock broke out at 40.13.33 and ran up to 90.30, a 125% run. The stock's most recent breakout is now at 77.25.67, coming out of the base formed between January and April 1999. Figuring it could make a similar move as the move from 40.13.33 to 90.30 would take the stock somewhere to 173.57.66. Also note the number of weeks of the move from 40.13.33 to 90.30 was 11 weeks. So you would figure the next move from 77.25.67 should go about the same duration. If you hit your price target of 57.60 within 5 weeks, you would not sell, as this indicates a lot of power, and a big leader will not run up and poop out after 5 or 7 weeks. Your durations should be comparable. This also assumes that BRCM is in fact a big, institutional leader and not a thin, wild thing that could go up 5 weeks and blow up. Some thin, wild things can do exactly that, but a big institutional, heavy trading leader will not. O'Neill also reiterated the use of a similar historical precedent to generate price targets. At O'Neill, we had model books of all the big, leading stocks that were huge winners in prior historical cycles going all the way back to the 1880s, and these were very helpful in finding historical precedents that could be used in assessing stocks we were handling in real time. O'Neill describes this process as follows. A third way to gauge the potential move is to look for a similar leader in the model books. If BRCM has gone up 33% in the first 5 weeks since breaking out at 77.25.67, look for another big leader in the model books that also moved up 33% in the first 5 weeks. Don't pick a second-tier leader. Look for a big leader that is similar in its base structure and how it acts right out of the chute. Maybe there are some similar industry characteristics, but this is not necessarily a key thing. By June 6th, O'Neill was starting to look for a bear market to develop, as he believed the market was topping. He ran through the process he believed was unfolding. Note that the market topped in late April when Schwab and AOL topped. At that point, the Dow started running up due to buying in cyclicals. The market will top in a couple of ways. First, distribution occurring on the Dow sucks and shorts who are then run in, and the market moves to new highs and then rolls over, making a final top. The second is as you get distribution in the big leaders, one other index keeps going up, which fakes everyone out. This divergence camouflages the real top in the market. Despite the bearish evidence in the market, the indexes soon stabilized in mid-June before turning and making a run for new highs, as figure 9.15 shows. In Chapter 1, we discussed the difficult period that most of 1999 represented, despite being considered a bubble market as it went parabolic at the end of the year. But there were plenty of cross currents that could throw you off. We remember buying a pretty large position in WorldCom, Inc., which gained infamy during the bear market when the company went bankrupt and its CEO, Bernie Ebbers, was sent to prison. This all occurred right around the bear market bottom in 2002, but the hints of trouble brewing for WorldCom were evident even in June of 1999. We noticed that as we were buying WorldCom, the stock was actually moving lower, figure 9.16, something that O'Neill insisted should never happen to any stock while you are buying a large position in it. Buying more than just a few thousand shares of any stock should never be easy, but somebody was pelting our order with stock they wanted to sell, and the stock kept going down in earnest. About half an hour later, we called our trading desk to dump the stock, which was down about half a point from where we had bought the shares, and exited the position in its entirety. O'Neill later called up to ask, "What's up with WorldCom?" We told him of the experience we had trying to buy a good-sized position in the stock and that it kept coming down as we were executing the order. Perhaps, we speculated, WorldCom was simply under pressure because of news that the Federal Trust Commission was investigating undersea cable operators, of which WorldCom was one at the time. O'Neill pointed out that he had noticed that whenever WorldCom tried to break out of its base, a seller would show up and hammer the stock. O'Neill wanted no part of it, as he surmised. Maybe Janus or someone big is dumping their stock. What I want to know is, why? By 2002, we had our answer, but the price-volume action of the stock was telling you that something was very wrong well in advance. In this case, we were lucky, since using O'Neill's 50,000 share rule, whereby any stock you are buying 50,000 shares of or more should be difficult to buy, got us out of WorldCom immediately. This was typical of O'Neill's understanding of the line of least resistance. In WorldCom's case, the different points at which it tried to break out to new highs in 1999 were not lines of least resistance, but rather lines of very stiff resistance. Watch out, it's Billy O. Most investors who follow O'Neill know of the ascending base, but most do not know that there are a number of corollaries to the ascending base, which is a jagged sort of formation where the stock has 3 sharp pullbacks in an overall ascending formation of 9 to 18 weeks long, with each pullback ending just above the low of the previous pullback, such as Home Depot, which formed an ascending base in the second quarter of 1998, figure 9.17. We recall going down to the floor of the New York Stock Exchange when O'Neill was playing Home Depot very heavily. At the time, O'Neill owned one seat on the floor and leased the other. O'Neill once grumbled that he hired some consultants to review his business, and they advised selling one of the seats and leasing one instead. This turned out to be a big mistake, as the value of the seat went up quite a bit after that, leading to O'Neill's subsequent distrust of consultants of any kind. Running around the floor of the exchange with Lou Salcenti, O'Neill floor broker at the time, was always an interesting and educational experience. In this case, we recall Lou telling the story of getting a G order to execute in Home Depot, which means an order that a member firm is making on its own behalf. So when he went up to the post, Louis yells out, "50,000 HD to buy G." The Home Depot specialist, in testimony to O'Neill's recognized prowess on the floor, rolls his eyes, back again. "Don't tell me this thing is going higher again." Short sellers in Home Depot who were in the crowd see O'Neill's G orders coming in to buy the stock, prompting them to warn each other, "Watch out, Billy O! Watch out, Billy O!" Such was O'Neill's reputation on the floor, and it was not limited to his trading ability, but also his gestures as a human being. Way back when, a floor broker for O'Neill, whom we knew as Bob, was working on the roof of his house one weekend and fell off, injuring himself severely and becoming paralyzed from the waist down. O'Neill brought the floor broker back to California and gave him a job at the home office in Los Angeles, making sure that he was well taken care of. Every time we went on the floor, certain floor brokers on the exchange would ask, "How's Bob?" The NYSE members and floor brokers were like a big family, and they recognized that O'Neill had taken care of one of their own. For this, O'Neill was afforded great respect, perhaps even more than for his trading prowess, on the NYSE floor. O'Neill's buying spree in Home Depot came as a result of the breakout from the ascending base in figure 9.17, as this is a very powerful pattern to buy off of, and O'Neill knew what he was looking at. Certainly the upside action of the stock after O'Neill started buying Home Depot stock with his G orders on the NYSE floor was enough to impress the specialist, who probably didn't want to have to act as a seller of last resort in the face of O'Neill's relentless buying of the stock. In such case, the specialist was more likely to turn and start buying the stock for his own firm's account. A boring base is not so boring. Another little pattern that O'Neill discussed is one that is somewhat similar to an ascending base, but simply looks like three little bases all on top of each other, instead of the more jagged look of the ascending base seen in Home Depot. Overall, the stock appears to be making little net progress as it breaks out and moves up a little bit, forms another little base, breaks out again and moves up a little again, and forms another little base. This is one of those patterns that lull you into thinking the stock isn't able to make any real upside progress. As O'Neill put it, the pattern fakes you out into thinking that the stock is boring and won't go anywhere, but then it moves out and takes off. Watch for it. In late 1999, Ariba, Inc., Arba, part of the dot-com sub-craze in emerging business-to-business or B2B e-commerce plays, was showing this type of formation as it's set up in three little stair-step style bases, each 3 to 4 weeks in length so that they are not of sufficient duration to meet the definition of a flat base, which must be 5 weeks or more in length. Figure 9.18. From August to November 1999, Ariba slowly wended its way higher, launching on a threefold price move that carried into March 2000. The essential force behind any of these patterns is that they indicate a stock that is coiling as it prepares to spring to the upside. Often, such patterns, unless you understand them and know how to look for them, can lull you into thinking that the stock can't get any kind of consistent upside movement going. In particular, if you buy a stock, say, in the first little base of a 3-base stair-step type of formation, it is very likely that the stock's lack of decisive upside action will wear you out so that you sell the stock, perhaps taking a small profit, and then forget about it, missing the huge price move when it begins. Recognizing when the line of least resistance has been broken, however, and the stock is free to romp higher, is critical in understanding these types of patterns. In the same manner that the ascending base has 3 pullbacks in the formation, the stair-step formation has 3 little bases, which do not pull back down into the prior range. The basic idea is that what looks dull may actually be coiling up, and one should pay close attention to these types of patterns when they occur. Before the advent of online services like William O'Neill, Direct Access, Wanda, one of the best-selling and most popular institutional products offered by the firm to its institutional clients was the Data Monitor. This was a custom chart book created for each client's portfolio, containing a weekly O'Neill data graph R, with the option for a daily chart to be shown on the left-facing page. At additional cost, of course, for each position owned by a particular client in their respective portfolios. In this manner, institutional portfolio managers had the ability to quickly reference, review, and monitor each of their portfolio holdings at a glance. Data Monitor contained an alerts matrix in the front of the chart book, which alerted the portfolio manager to any negative or positive changes in the stock's fundamental or technical data points. Earlier in 1999, we had noticed that Waste Management Industries, WMI, was triggering several such negative alerts, and normally this would cause us to advise a client who might have owned the stock to consider selling WMI, or at least reviewing the position carefully. Those who may not have acted on the negative alerts, unfortunately, reaped the consequences of their decision to hold the stock, as Figure 9.19 shows. Listening to the market. O'Neill always views the market as a feedback system, whereby the market is either confirming or disconfirming your decisions in real time. If you make the decision to buy a stock and the stock goes higher, the market's feedback mechanism was confirming the correctness of the decision. O'Neill's great strength is in totally accepting the market as a feedback mechanism and abiding by the evidence the market offers in real time, even if it contradicts his earlier views. An example of this is seen in Best Buy BBY in Figure 9.20, which we were fairly bullish on as it broke out of a 7-week base, paused for 1 week, and then continued higher over the next 4 weeks. BBY began to falter, however, and as the market began to mistreat him, O'Neill became suspicious of the overall environment. On September 24, O'Neill was fairly certain that the market's back has been broken. He summed it up tersely: "I think it's through." Indeed, the market looked quite weak, figure 9.21, as the Fed began to raise interest rates, and enough feedback was provided by both leading stocks and the general market to validate this view. However, O'Neill recognizes at all times that market conditions can change very rapidly, and this is why he never, ever assumed a rigid position, no matter how certain he was about the state of the market at any given time. This is a critical lesson for investors of all stripes. In the market, there are no constants, and changes in the market environment, some more rapid than others, are part and parcel of the game. Modern civil engineers understand that large structures which are subject to the more intense forces of nature, such as hurricane-force winds or earthquakes, must have certain features built into the design that allow the structure to sway, move, and bend with these forces, which decreases the chance that they will be toppled instead. In the same way, investors who cling to rigid opinions, and thereby resist the forces of the market as they shift and change, risk being snapped in half like a brittle little twig. The market continued to plumb new lows going into mid-October, and there was still no concrete evidence that the market decline was ending, until it finally undercut the September lows and began to rally, posting a massive follow-through day on the 9th day off the bottom, figure 9.21. Reacting to new evidence, O'Neill was no less than decisive as he adamantly declared, "The market is telling us to buy and buy big." There were plenty of stocks to buy, and the ensuing price runs in many of these stocks made us a fortune. On the way up, however, given the sharpness and steepness of the rally, some leading stocks would exhibit a great deal of volatility as they ran up sharply, pulled back sharply for a few days, and then turned and charged to new price highs. During one of our market school sessions, Bill talked about handling volatility in a high-flying stock, using the example of a Monex IMX as he advised. It is wise to go back and map out all the pullbacks the stock had during a rally phase. Check the percentage decline off the top and the number of days over which the decline occurs. This gives you some idea of where the stock can trade within a normal uptrend and will keep you in when it corrects sharply. This basic idea kept us in some of the volatile leaders we were playing, and IMX weekly chart, figure 9.22, shows the typical one-week pullbacks that the stock put in as it moved higher. Once the duration of the stock's pullback in early March 2000 exceeded those seen on the way up from December through February, it was clear that at the very least the uptrend was starting to run out of gas, and at the very least would have to build a new base and set up again if it had any chance of pushing into new high-price ground again. You screwed up. In February of 2000, it was time for Bill O'Neill to pass out the commission checks for all the internal portfolio managers who had made money that year. As is standard at most proprietary trading outfits, the portfolio managers were paid a percentage of the gross profits they made in their internal account. You might think that clocking performance numbers in the low 500% range in 1999, as we both did, would merit some heavy praise from O'Neill, but far from it. He brought in your check and handed it to you, and then started flipping through what we used to call the famous O'Neill personal data assistant, which was essentially a very fat legal pad on which he wrote endless notes, folding back the pages that already had notes scribbled in every available square millimeter of their cellulose surface. O'Neill kept track of his portfolio managers, particularly their mistakes, and these often found their way onto his non-electronic legal pad PDA. O'Neill respected those who could perform well in the market, and you only gained credibility with him as a portfolio manager if you could keep up with the group and its high-performance standards. He was always happy if you were making big money for the firm, but he just didn't gush over it, or waste time allowing you to bask in the warm afterglow of a very profitable trading year. He preferred to go over mistakes, which is what he would do as he flipped through 30 pages of his legal pad and found the exact page where he had his notes on your trading mistakes. After reviewing critical mistakes you made, despite being up over 500% on the year, he quickly concluded, "You screwed up. If you had done everything exactly right, you could have been up 1,000%. The bursting of the bubble. As we moved into the end of February 2000, the market was becoming even frothier as many leading stocks burst into climax runs. As well, money poured into ever more speculative stocks, in particular the mass.com bubble IPOs with no sales, no earnings, and no real business plan that related to generating either. The climactic action in leaders combined with this increased speculative flavor to the market was to O'Neill a clear sign of danger lurking in the shadows. This was not necessarily a sign to hurl your stocks at the nearest seller and run for the hills, but to be on a code red alert ready to instantly react to the confirming action of a technical top in the market. Obviously, sentiment had become frothily bullish, but this was merely one lesser, but still key piece of the puzzle, and in and of itself was not sufficient to call a top. When the associated technical evidence began showing up as climax runs turned into climax tops, and heavy distribution began to beset the market, it simply added conviction to the conclusion that it was time to begin exiting the market in earnest. After the top on March 17th, O'Neill wisely counseled us to stay out of the market for at least 3 months. O'Neill told us, "Watch stocks that were big winners. They will break once and then try to rally sharply, and then they break again, at which point you can put a fork in them." O'Neill recalled that in prior market cycles, you might have 2 or 3 story stocks going nuts, but to see 200 to 300 like you have the past several months means we've seen a tulip craze or bubble, if you want to call it that. The magnitude of this tulip craze indicates that it needs time to work out of the system. The steepness of the market's decline caused O'Neill to begin seeing some similarities to the bear market of 1962, which finally culminated in a climactic low during the Cuban Missile Crisis of October 1962. As we all flew to New York in early June of 2000 to present at the Investors Business Daily Workshop to be held at the Hyatt Regency Central Station on Saturday the 3rd, we did not realize just how eventful this trip would be. Overpaid analysts. We were both tagged to participate in the workshop by making a presentation on the Daily Graphs investment tool after lunch. So along with our faithful assistant, Mike Webster, one of the newest internal portfolio managers at O'Neill at the time, the 3 of us landed in New York that Wednesday night. Holing up at the Peninsula Hotel on 5th Avenue, we began preparations for the weekend event, as well as the next day's full slate of appointments we had scheduled with several O'Neill institutional clients with offices in the city. On Thursday, June 1st, we went in to see one client firm which had just hired a hotshot $1 million internet analyst who allegedly knew everything about the internet space. Hiring a high-priced internet analyst after the dot-com bubble market had topped didn't seem too smart to us, but we went into the meeting with the best of intentions. This particular client firm gave us a very gracious reception when we showed up at their offices on Park Avenue. After a bit of bantering about the current state of the market, we were all ushered into their conference room to begin a meeting during which we were to review their current portfolio holdings. The 3 of us, along with several staff, including the $1 million internet analyst, began viewing wonder charts that were being projected up onto a screen on the wall at the end of the long conference table. Mike Webster sat in the back, since he could only act as an observer, and as we went through the stocks, an almost surreal yet comical repartee began to take form as Mike kept instinctively reacting to each new chart that he saw by softly saying to himself the same phrase over and over again. "That's a top. That's a top. That's a top." While he was actually saying this quietly to himself, the room was quiet enough so that everyone could hear him, and each time he uttered this simple but accurate phrase, the $1 million internet analyst harumphed and laughed quietly at the naive upstart calling tops in his beloved internet holdings. Among the stocks that they owned was InfoSpace INSP, shown on a weekly chart in figure 9.23. We advised them to sell the position, but their analyst began a long-winded discourse on why INSP was undervalued. At the time, Mike Webster was a rookie portfolio manager at O'Neill, and the spectacle of him out analyzing a hot-shot $1 million analyst without even trying was something that was truly, as the famous credit card commercial puts it, priceless. We should note that while the analyst was both arrogant and ignorant, the CEO of the client firm was himself extremely gracious and grateful for the meeting. At one point, we had told this client that we expected the Nasdaq Composite Index to push below 2,500 at its nadir. In 2001, when it finally did, the CEO sent our entire institutional services department a case of very fine Dom Perignon, congratulating us for accurately making what he had originally thought to be an unbelievable prediction. Avoiding the Nokia trade. Friday morning, June 2nd, we found ourselves at breakfast in the Luncheon Club of the New York Stock Exchange, where our firm of William O'Neill Plus Company, Inc., was a member. We met up with O'Neill NYSE floor broker Lou Salcenti when we first arrived at the exchange and headed upstairs to eat, where we were joined shortly thereafter by Steve Porpora, the second floor broker, whom many readers may recognize as a former NYSE floor commentator on CNBC throughout a good part of the 2000s, until O'Neill shut down his floor operations in 2008. At 8:30 a.m., just as we were settling in and enjoying our blintzes, omelets, and Canadian bacon, the monthly jobs number hit the newswires. 131,855 jobs had been added in May, when many feared that the brutal market top and bubble bursting in March might have severe economic consequences. Employment tends to lag market turns, but the futures were reacting big to the upside. The room began to clear out very quickly as most of the floor brokers in the room headed downstairs. An avalanche of buy orders was expected at the opening, so Steve Porpora, who functioned as director of floor operations for O'Neill, headed downstairs while we finished up with breakfast. It was somewhat surreal to be sitting in an almost empty room that just a few minutes before had been filled with a multitude of floor brokers devouring their healthy start to the day. A lot of very fine breakfast fare was left uneaten on those NYSE Luncheon Club tables that morning. In some cases, you had to admire the dedication of the NYSE members as duty took precedence over sustenance. When you run all over a floor the size of perhaps half a football field, racing from post to post throughout the day, all those carbs come in very handy. On the other hand, we don't recall ever seeing a skinny NYSE floor broker. Either way, once we had finished eating, it was down the elevator to the floor, but not before stopping in the men's room to snare a souvenir comb. Trays of black combs with New York Stock Exchange stamped on the side in gold letters could always be found in the Luncheon Club restroom, and it became a custom to take one each time we showed up at the exchange and stuffed our faces. We are not telling how many of these combs we have. Once we were on the floor, the excitement began to build. In those days, before traders began letting electrons run their orders around for execution, nothing would get the floor in a good mood faster than a busy morning, because when the floor brokers are busy executing orders, that means they are making commissions, while the specialists are ringing the cash register as they work the spreads, providing supply and taking stock for their own account as supply and demand shifted throughout the day. Once the bell rang, what had been a steady low-volume drone rose sharply to a roar as the flood of orders hitting the floor translated into a flood of sound. Standing in the O'Neill floor booth, we decided to check out Nokia Knock. Using the phone in the booth, we called the trading desk at O'Neill's home offices, yelling to our trader over the phone, "Jack, buy 50,000 Nokia." We then handed the phone over to O'Neill floor broker Louis Salcenti, so that Jack Hodges, the O'Neill desk trader back in Los Angeles to whom we had just given the order, could in turn give the order to Louis. A bit circuitous, as one might wonder why we couldn't just tell Louis to buy the 50,000 NOK ourselves. After all, we were on the floor in the O'Neill floor booth, standing right next to him. But those were the rules for giving an order, and we had to follow them. Order in hand and correctly routed. Off to the NOK trading post we went, figure 9.24. As we approached the NOK post, a small group of 3 or 4 floor brokers was standing around with orders to buy, but they were all sitting on the bid side of the market waiting for the stock to come to them. Louis, a street-smart floor broker if there ever was one, noticed a guy standing off to the left, away from the crowd. As we said to Louis, "Let's go in and take stock," he waved us off, barking, "Wait a minute. See that guy over there, watch him." The guy we were to watch was a floor broker from Donaldson Lufkin and Jenrette, or DLJ. Louis's instincts proved to be correct, as the DLJ guy suddenly leapt into the crowd and took the offer price for 50,000 shares. The other brokers in the crowd who had been lying back, waiting for a seller to show up, suddenly had to execute their orders or risk being left behind. When they all stepped up to buy stock at the offer price, the DLJ floor broker turned around and yelled out, "Sold, sold, sold." Pointing to each buyer in succession, Louis curtly ordered, "Let's get out of here." We did not argue and left NOK for someone else to buy. In this case, Louis saved us from making a dumb stock purchase. In hindsight, the pattern was never really right, but NOK had actually bucked the March market top in 2000 and remained only 3% off its all-time high. It was an interesting lesson in the truism that faulty chart patterns are often indications of institutional distribution. And in this case, we witnessed such distribution in action, right on the NYSE floor, where the rubber meets the road. June 2, 2000 was a follow-through day for the market, signaling that it was now in a rally phase. O'Neill immediately grasped onto the bear market bottom of October 1962 as a precedent for the market bottom in June 2000. In his experience, the sustained velocity of the 1962 bear market decline was the only thing he had seen that was similar to the Nasdaq's decline off the March 2000 top. Because the Nasdaq Composite was also the index in which the dot-com bubble phenomenon was centered, it bounced the hardest off the late May lows, figure 9.25. These lows had in turn undercut the April lows, constituting a shakeout that faked out short sellers as the market turned and began to rally. 7 days after that May 24th bottom, the huge gap-up move on June 2nd constituted a clear follow-through day, given that it came on heavier trading volume than the prior day. Despite the follow-through, there were very few stocks breaking out from proper bases and into new high-price ground. Most of the movement was occurring in former leaders that had topped with the market in March 2000, and that were now bouncing sharply off lows. Groping around for something to buy on that June 2nd follow-through took us to Nokia NOK, which we decided not to buy, but in the process we missed Corning, Inc., GLW, a glassmaker that was spinning fiber optic cable for the new high-speed internet age. While we were getting lessons in institutional distribution at the NOK Post, O'Neill zeroed in on GLW's clean breakout from a slightly udder-like cup with handle formation, seen in figure 9.26. Bill the rock star Saturday morning. On June 3rd, we woke up bright and early to get ready for the advanced investment workshop. Arriving at the Hyatt Regency Central Station, we noted that a crowd was already starting to gather. Previous workshops had been a one-stage affair with perhaps 200-300 attendees at most, but this place was packed with what was later estimated to be around 800 attendees, the largest O'Neill investment workshop in history. In hindsight, it makes complete sense, considering the tulip craze of the market that had topped in March 2000. On that Saturday, the crowd was quite bubbly and excited about the previous day's follow-through, and there was tremendous electricity in the air. Steve Porpora, O'Neill's director of NYSE floor operations, proclaimed, "Bill's a rock star." Because of the tremendous size of the audience, instead of the usual single-stage setup we were used to dealing with, we had 2 stages stretching across the front of the room. Looking back on it all now, the mass ebullience in that room that day was clearly a sign that the bear market of 2000 was far from over. Leaving the hotel conference area that evening as we departed the workshop, attendees tried to follow us as some ran down the up escalator adjacent to the down escalator on which we were descending to continue asking us questions. As we tried to get into our cab, some attendees tried to get into our cab with us, but since we were headed off to dinner with O'Neill NYSE floor broker Lou Sulcenti, a street-smart, tough Italian boy from Jersey, who was also in the cab with us, he played the role of bodyguard as he kept our would-be taxi cab mates at bay. All we could do was look at each other and say, "Major market top, the Great Bear of 2001-2002. By September 2001, the market was rolling over again, and the second leg of the great post-bubble bear market of 2000-2002 set in with a vengeance. The general market and leading stocks broke down steadily through the last quarter of 2000 and the first quarter of 2001, until the market put in a follow-through day on March 27, 2000, as the daily chart of the Dow Jones Industrials in figure 9.27 shows. The March 27th follow-through came on the 4th day off the bottom, hence a 4th day follow-through, which is normally a sign of strength. The market, however, began to roll over again over the next few days, and began to break as volume picked up, marking an initial distribution day, which can normally signal an end to the rally attempt. However, the understanding of follow-through days is very subtle, and O'Neill would articulate certain ideas about how any follow-through, as well as the general price-volume action of the major market indexes, must be seen in the context of the overall market position within the bull-bear cycle. With respect to some of the weakness seen in April of 2001, he pointed out, "Generally, you should see, As the market is coming off a strong follow-through day and is rallying, what look like distribution days but are then followed by up days, so that the pattern of distribution days does not really build on weakness. It forms as a result of bearish psychology reacting to a rally in the market, and then the market shakes it off and moves up for a day or two. In Figure 9.27, we have pointed out the two distribution days that hit the market just as it was coming up, distribution days that came on heavier, above average volume, and that looked quite negative at the time. A walking encyclopedia of historical chart patterns. Often such distribution days that are so early after a follow-through will be accompanied by shakeouts along the lows of bases as the market turns. As O'Neill would say, the potential for heavy selling in some stocks is also normal at this juncture. At the time, O'Neill recalled his experience with McDonald's MCD in 1970 as an example. O'Neill was very much like a walking encyclopedia of historical stock chart patterns. He would recall chart patterns of stocks from the past, quickly reciting the characteristics of the stock's pattern, and he did so with the 1970 example MCD. As the stock was forming a bottom and rounding out the lower part of cup pattern, about halfway up off the bottom, the stock got hammered on massive volume for 1 week. The stock then turned around and tripled. Going back to check the old copies of MCD charts from the 1970s that were lying around the office, we could see what he was talking about. O'Neill continued with the lesson. So the point is that ugly, hammering sell-offs in stocks at this juncture are likely to be fake outs, since they can be exacerbated by bearish psychology caused by negative news at the turn. This is often why potential leading stocks have quick, very sharp shakeouts through the lows of their bases, such as Cisco Systems, Cisco, in 1991. News of the Iraqi invasion of Kuwait at that time marked the panic lows of the October 1990 bear market bottom, and the ensuing and extreme washout of bearish psychology is reflected in the chart of Cisco at that time, Figure 9.28. From chop and slop to donuts and milk, the market action after the March 2001 follow-through was tepid. O'Neill lamented the fact that there was no power or momentum in the market. Nothing works. Lots of funds are loaded up with techs and are muscle-bound. Stocks run up and then run down, like Sun on news alone, Figure 9.29. With so little that looked correct to buy from an O'Neill perspective in 2001, the emergence of Krispy Kreme donuts, KKD, as it broke out approximately 1 month after the late March follow-through, and market turn was a blast of fresh air, Figure 9.30. KKD had come public in April 2000 right after the market top in March, but the stock bucked the initial market sell-off by building a short little base. We became rather enamored with the stock as it continued to perform throughout the summer of 2000, finally topping out and building a 26-week base from which it broke in May of 2001. This was the only time we ever owned a stock that caused us to gain weight, since owning KKD somehow became an excuse for bringing in Krispy Kreme donuts at the time. The closet-like employee kitchenette in the O'Neill Institutional Services Department was frequently populated by dozens of fresh Krispy Kreme donuts, something that provided a humorous contrast to the normally health-conscious environment that was the rule at O'Neill. Trying to ward off the subjective influence of our taste buds, we tried to assess the prospects for KKD once it emerged from its 26-week base as objectively as we could. There were some bullish reasons for owning the stock, and it gave some insight into how O'Neill places importance on certain characteristics that are specific to retail-oriented stocks like Krispy Kreme Donuts, Inc. At the time, O'Neill boiled it down like so. This is a real business with a strong brand, strong products that have barely touched their markets. Look at TCBY and Snapple. They had huge moves even though they turned out to be fads. Krispy Kreme could also be a fad, but it could have a huge move first. Krispy Kreme creates scarcity before they move into a market. First, they open 1 or 2 stores and people see the long lines and hear the rave reviews, thus setting up strong demand for the next stores they open. You must try and maintain your position. Do not cut back excessively as this is a winner. Calculate how much they can expand. Charles Tandy once told me that their strategy was to experiment in each city to see how many stores they could open up before saturating the market. They found that Radio Shack could open 25 stores per major city before saturating. Eventually, they had 5,000 stores. Krispy Kreme has 174 stores. there could be huge expansion. And if the company is able to produce a solid 20 to 25% growth rate over 3 to 5 years, a high P/E here is not unreasonable. KKD is also a lesson in how the crowd can often be fooled. In late March of 2001, many were shorting the stock on the basis that it was just a fad, and that insiders would be tossing stock out the window once the stock's IPO lockup period was over, during which insiders were finally allowed to sell stock following the initial public offering. Once the lockup period ended, insiders didn't sell, and shorts had to scramble to cover their positions as natural buyers also showed up, given the company's strong sales growth and product recognition. The stock soared, and KKD ended up doubling from the pocket pivot buy point, figure 9.31. While Krispy Kreme never got too far past the $40 price level after doubling in price off the early May 2001 breakout, it still illustrates how O'Neil looked at retail stocks, and how Krispy Kreme, while it worked reasonably well. And while we did not exploit the move in the stock as fully as we may have liked, it was still grist for the mill in otherwise bleak times for bull trend followers as we were at O'Neil. Adjusting the follow-through day threshold level. It was around June of 2001 that O'Neil began to believe that his 1% upside move requirement as one of the vital parameters of a market follow-through day signal was insufficient. A follow-through day, or FTD, is a signal generated when the indexes are up 1% or more on heavier volume than the prior day, and this must occur on the 4th through 7th days, optimally or sub-optimally a few days later, following an initial low in the general market averages. When the market posts a follow-through day, it is, according to O'Neil methodologies, at that point technically in a rally phase. Not all follow-throughs lead to a bull market, but no bull market has started without one, as O'Neil was always quick to point out. Understanding that the markets had become far too volatile following the March 2000 top meant changing the 1% index move requirement to 2%. At the time, however, this 2% follow-through requirement was based solely on observation. The fact is that optimization studies we had already done on our own showed the most statistically reliable percentage move requirement for the indexes, in order to call a follow-through day at that time, was 1.7%. We never told O'Neil of this, but were not surprised that he instinctively began to sense that the number had to change, and 2% seemed like a reasonable number to him based on the number of observations he had made in the 2000-2001 period. In making his assessment that the follow-through day percentage index move requirement should be increased from 1% to 2%, one of the examples he was looking at was the follow-through day of July 25, 2001, shown in figure 9.32. This was an 11th day follow-through on the Dow Jones Industrials and Nasdaq Composite Index, and a 10th day follow-through on the S&P 500. However, the index moves on that day for each of these three indexes was 1.6%, 1.28%, and 1.61%, respectively. At the time, O'Neil expressed great skepticism about this late follow-through. The concept of a follow-through is overwhelming power to the upside. We ran a screen on the 200 new highs that were made yesterday and found only 16 of the stocks had EPS greater than or equal to 72 and relative strength greater than or equal to 80. So it was a laggard rally. This is not powerful upside action. A few days later, the market began to roll over again, negating the follow-through day as the market broke to fresh lows, and the bear market of 2000-2001, so far, continued. Steadfast on 9/11. The morning of September 11, 2001, started like any other day at William O'Neil Plus Company. We were in our offices well before 5:30 a.m., 8:30 a.m. New York Stock Exchange time, getting ready for the market day and working out how to handle our short positions. One of us was 200% short coming into the market opening that day, the other 100% in cash. When the first jet hit the World Trade Center, the images of the North Tower with a gaping hole in it was described as a small plane, perhaps a Cessna that had errantly flown into one of the two tallest buildings in New York City. Knowing the size of the buildings at the World Trade Center, we quickly surmised that the hole in that building could not have possibly been made by a little Cessna 172, or even a Cessna 372, if they had made one that big. the futures began to hurtle to the downside. And it was a strange feeling to be 200% short that morning, knowing that a huge gap down in the markets was going to result in a very profitable trading day when the markets reopened, as you watched images of people jumping out of broken windows in the upper floors of the North Tower. At about that time, the O'Neill trading desk had been on the phone with their Los Angeles-based counterparts at Cantor Fitzgerald when the first jet hit the 93rd floor, just below the New York-based Cantor Fitzgerald offices on the 101st to 105th floors of the World Trade Center's North Tower. At that point, we immediately began to try to account for O'Neill personnel who worked at the New York Stock Exchange. They included our two-floor brokers, Steve Porpora and Lou Salcenti, and two clerks in the booth. Steve, who had been depositing a check at an ATM for his daughter, saw one of the jets when it hit and immediately headed for the shelter of the NYSE building at Wall and Broad Streets. At that point, we were able to account for 3 out of 4 New York-based O'Neill personnel, but floor broker Lou Salcenti was still on his train, scheduled to arrive underneath the South Tower of the World Trade Center just before what turned out to be the time that the second jet hit. Lou was coming out of the South Tower as debris rained down around him, and he was finally able to find his way to a ferry boat at the southwest end of Manhattan Island that took him across the Hudson River and back into New Jersey. During this entire time, we had no idea where Lou was until we finally heard from him at 11:30 a.m. New York time. O'Neill's reaction to the events of that day was steadfast and typically optimistic. He believed that these troubles had been brewing for a while, so 9/11 was simply the culmination of the flawed anti-terrorist policies of the Clinton administration, and that the attacks of 9/11 would provide a catalyst for taking decisive action to address the growing threat of terrorism. He believed that 9/11 would ultimately be transmuted into a positive by the country and the markets. He felt that this was about as bad as it could get, and hence when the markets reopened, the market would initially sell off and then quickly bottom, setting off a new rally phase in the market. O'Neill's calmness during those times also had a calming effect on those of us who worked with him, so we were able to keep our heads and think through what would happen when the market reopened a few days later. When the markets finally did reopen on September 17th, we began to cover our shorts as we turned with the market and went long defense stocks like Lockheed Martin, LMT, shown in figure 9.33. The United States was now on a war footing, and as was the case in prior periods where the country was at war, whether it said so or not, the defense industry and its associated stocks would be the place to look for big stocks. Initially, the defense stocks did not have the typical earnings growth numbers one might expect to see in a slim stock. But in certain environments, we relied on O'Neill's model book studies when it came to identifying the stocks that institutions would have to own in any given market cycle. Given that most growth stocks were still reeling from the deleterious economic and wealth effects of the dot-com bubble popping in March of 2000, 9/11 did little to embolden or even encourage consumers to spend as they simply became more cautious, drawing like turtles into their shells. Understanding which of the defense stocks institutions would turn to as a big stock holding in the sector was critical in optimizing the group move. Defense stocks launched higher when the markets reopened on September 17th, and Lockheed Martin gapped out of a 14-week cup with handle base on huge volume. It is quite interesting to note that going into the events of 9/11, Lockheed Martin had been quietly building a rather well-formed cup with handle formation, almost as if it knew what was coming as it coiled up for its big breakout. Lockheed Martin ran up for 6 more weeks before pulling back to a point just above its breakout point, as figure 9.33 shows, and then building a series of very tight weekly closes as it slowly moved up along its 10-week, 50-day moving average. This was very tight, constructive price action, and Lockheed broke out again in early January 2002 as it continued higher, even as the general market began to wobble and roll over again to fresh new lows. Back in those uncertain days, it was easy to get depressed about all that was going on after 9/11, including the anthrax attacks that were making the news. The administrative assistant in the O'Neill Institutional Services Department who passed out the day's mail wore plastic gloves and a surgical mask while she opened up each envelope or package and checked for unusual substances. During this time, one could always depend on Bill O'Neill for a pep talk. His optimism was tireless, and after a while you realize that this is one of the primary secrets to his success. He proved the old adage that you will never see a successful pessimist. He would call up, citing an article about a study regarding the main causes of death. He informed us that the one cause of death was smoking, and the two cause of death was simply how one reacts to daily stresses and their emotional consequences, a very key concept. O'Neill knew that reacting badly to the emotional stresses of trading was deadly in the markets, which is why he always advised to sell to the sleeping point. As in trading, O'Neill believed that life was not about what happened to you, but how you react to what happens to you in life. In this manner, keeping your head screwed on right, whether in the markets or in life following a frightening event like the attacks of 9/11, was paramount to survival. The market cleans house. As 2002 wore on, the move in defense stocks ended, and a general malaise began to set in as the debate over whether to go to war with Iraq was the main topic of the day. The bear market was breaking to new lows, and the financial services industry, particularly in the investment arena, was contracting rapidly. Hedge fund clients of O'Neill's were closing left and right, and some of the bigger client firms were beset by mutual fund timing scandals or swallowed up by larger financial entities. The bear market was putting everyone in their places, and every corner of excess was being rooted out. O'Neill would muse at the time, "The market is the only thing in life that is the great leveler. You can argue with your wife, your family, your co-workers, the IRS, and so on, but you can't argue with the market because it will clean you out. It doesn't care who you are." By late October 2002, everyone was pretty well cleaned out as the Nasdaq finally bottomed out after plummeting 78.4% from its bull market peak in early 2000, shorting Cisco Systems near the bottom. There is no greater example of Bill O'Neill's optimism than when he turns pessimistic. In October 2002, he became so pessimistic that he decided to short Cisco Systems, Cisco, right near its bear market lows, figure 9.34. We know this because Bill O'Neill called us to tell us he had done so. When the last bull in the market throws in the towel and starts shorting Cisco at around $10 a share, more than 90% from its bull market peak, then that has to be the bottom. We had heard this from other old-timers in the firm, but it was interesting to see O'Neill actually do this. Notice, however, how Cisco turns up off its lows on huge volume. Most traders, having shorted Cisco a few days earlier, might have added to their short position in response, or simply and stubbornly sat with the position. Not O'Neill. He could care less what he thought 2 days earlier as he quickly covered the Cisco short position and went long eBay, Inc., eBay, something we discussed in Chapter 3. As the nation prepared to go to war in Iraq, the market corrected 17.6% off its December 2002 peak, as measured on the Nasdaq Composite Index, and many were expecting the worst. At the very least, it was expected to be a protracted war that would involve Saddam Hussein retaliating with chemical or biological weapons. Other fears grew around the idea that attacking Iraq would provoke radical Islamic terrorists into conducting additional terror attacks on American soil. There was, in fact, a very large wall of worry building, and O'Neill, having seen the market rally sharply in January 1991 when Allied forces launched the attack that ejected invading Iraqi military forces from Kuwait in the Persian Gulf War, saw a similar potentiality evolving as U.S. forces moved into their final positions in early March 2003. 2003-2005 bull market. When the swiftness with which U.S. forces penetrated into Iraq and took control of the capital city of Baghdad took the crowd by surprise, the market followed through to the upside on March 17, 2003, launching a new bull market. One of the first stocks out of the gate was Amazon.com Amazon, which we began to play heavily, figure 9.35. Amazon did not show immediate power as it broke out to new highs on March 17th, right in sync with the market's follow-through on the same day. The stock pulled back over the next 4 weeks before finding support at the 10-week, 50-day moving average. Volume had dried up sharply on this pullback, so we bought the stock right there. For the next 6 weeks, the stock closed right at the peak of the weekly ranges for each of those weeks. 5 of those 6 weeks closed at new price highs. O'Neill was quick to point out just how constructive this action was, and that he had calculated an upside price target for Amazon of $60 a share. In an interesting coincidence, we owned the stock as well, and had used point and figure charting techniques to calculate an upside price target of $61 based on the upside thrust of those 6 weeks, where the stock closed right at the peak of each weekly range. Amazon finally peaked at 61.15, with a little climax top type of move in October 2003, and then began building a big, ugly base, figure 9.36. As Amazon continued to build its base, it put in an initial low of 47.67 on the left side of the base on November 19, 2003. The stock rallied for a few days, and then spent the next 2 to 3 weeks drifting back downward, before undercutting the initial 47.67 low at an even 47.00 on December 17. This was the only time we ever saw O'Neill implement the old Livermore trick of buying off the bottom on a shakeout +3 situation in real time. On December 23rd, he called to declare that Amazon was a shakeout +3 buy based on adding 3 points to the 47.67 low of November 19th, in order to come up with a new buy point of 50.67. On that day, as figure 9.36 shows, Amazon pierced the 50.67 buy point with volume up sharply on the day. In this particular case, the shakeout +3 or so +3 buy signal on Amazon resulted in a tepid rally, and the stock eventually rolled over and failed, gapping down hard in late January 2004. One significant takeaway from O'Neill's implementation of the SO +3 buy rule that Livermore would make use of from time to time is that the shakeout in the pattern should be exactly that, a quick and sharp shakeout that immediately turns and begins rallying to the upside, as Amazon did over the next 4 days following the 47.00 low on November 17th. The stock should not have undercut the prior low at 47.67 and drifted lower or sideways for a few days. The turn off the lows following the undercut should be swift, as this confirms the stock's ability to recover quickly and with some authority, hence giving the SO +3 a look of extreme buoyancy in the stock as it immediately rises back to the surface, the top of the base. The past doesn't repeat, but often rhymes. O'Neill frequently had interesting stories to tell about stocks he played in the past and how they were similar to what was going on in the present. When Netflix, Inc., NFLX emerged as an IPO in May 2002 at $7.50 a share, the market was still in a bear trend, so the stock immediately tanked, finally bottoming out in December 2002 at $2.42 a share. The stock then began working its way higher, along with Amazon.com and other .com e-commerce survivors like eBay Inc. eBay, NFLX figure 9.37, rode the second wave in the internet stock move among those companies that had actually figured out how to make money running a business on the internet. This new wave began in late 2002 and into early 2003. An NFLX DVD buy-mail movie rental model was the perfect service for a consumer population that was opting to stay home more in the wake of the 9/11 attacks. After a long price run, Netflix began to show signs of topping as it failed from a late-stage base in April of 2004. Note how this move occurred on low volume, as figure 9.37 shows. The 2 weeks just before the week of the late-stage base failure, it moved up straight from the bottom of the stock's chart base on below-average volume, with the second week occurring on extremely light volume, a sign that buying demand was beginning to wane. Talk of Blockbuster, Inc., the grandfather of movie rental chains, moving into the DVD by mail business in early 2004 was weighing on NFLX stock. The stock had, by this time, had quite a price run, so it was obviously late in its cycle when this news hit, and O'Neill made an interesting observation at the time, comparing Netflix and Blockbuster to motor home maker Winnebago and car maker General Motors back in the 1960s and 1970s. Years ago, when Winnebago was making RVs and selling them like gangbusters, their stock was a huge winner. General Motors came along and announced they were going to build these RVs also, but they never made much money in that line of business. This is similar to Blockbuster announcing they are going to compete with Netflix. As it turned out, Blockbuster never made a go of the DVD by mail business and never became a competitor to Netflix. At the time of this writing, in early 2010, Netflix is still in business while Blockbuster has declared bankruptcy. It is also interesting to note that in 2010, Winnebago is still in business, and General Motors has been taken over by the U.S. government, garnering the nickname Government Motors, proof that some individuals know how to run a business correctly, and some don't, and it is usually the early innovators that prevail over time. O'Neill viewed 2003 as the first year of an economic cycle, and in February 2004, he was keeping an eye on where we were in the cycle. As he put it, there is a certain order to a bull cycle. In the first year or initial phase of the bull market, the hot, newer names will have their move. Sometime later, 8-12 months or so, big business starts to participate in the new economic cycle, and you will see cyclical growth stocks come on. Later on, the capital spending stocks will come on as businesses are flush with cash and start spending on capital equipment. In the old days, capital equipment stocks were the machinery stocks. Today, they are technology stocks. The tone of the market in 2003 going into 2004 was also much different from the heady days of the 1990s, when markets were in a grand, parabolic upside move that ended in the March 2000 market top and bubble bursting. O'Neill, however, was familiar with how this could cross us up, and he warned, "When I made a lot of money in Syntex many years ago, I had trouble making money right after that big success. I would sell stocks too soon, since I figured if they weren't up 6 points a day, there was something wrong. I had gotten acclimated to Syn's strong uptrend and couldn't adjust to slower, yet still profitable stocks. In 2004, we had to adjust from an environment that was simply slower and less parabolic than that of the late 1990s. In early 2004, there were several textbook examples of topping action that O'Neill called to our attention. Often the phone would ring, and O'Neill would be on the line wanting to discuss a particular stock, making note of its characteristics in real time. In March of 2004, O'Neill pointed out the 2 weeks down and 2 weeks up sell signal in Boston Scientific BSX, a leading stock at the time, figure 9.38. This occurs after an extended price run when a stock makes a new price high and then immediately pulls back 2 weeks before shooting back to new highs over the next 2 weeks, creating a 2 up and 2 down formation on the weekly chart. This was an old sell rule of O'Neill's, which is often misinterpreted, but in this case, the 2 down and 2 up rule was a textbook sell signal, and the action in BSX here illustrates it well. A number of biotech stocks had big moves in 2003, including Gilead Sciences, Guild, and Celgene Celg. Joining in on the group move was Marduk Biosciences, MAC, which had found a way to turn microalgae into 2 fatty acids, DHA and ARA, essential to brain and eye development. These in turn were added to baby formula, producing a super formula for infants. Marduk Biosciences formed a late-stage double-bottom base in the first 4 months of 2004. The major flaw in the pattern, as shown in figure 9.39, is the midpoint of the W formation. Normally, in a proper double-bottom base, this should close below the left sides of the W, but in this case the midpoint exceeds that high. As Marduk Biosciences attempted to break out on the right side, O'Neill pointed out this flaw. As it turned out, the breakout failed, and the stock broke down altogether over the ensuing months. The IPO, U-turn base. In the Institutional Services Department of William O'Neill Plus Company, Inc., there was never any shortage of banter and debate about the market and leading stocks. As well, there was always somebody coming up with some new concept to which they had given a clever name. During 1999, the moves in stocks were so crazy that we would give some of their strange short consolidations as they dashed to the upside descriptive names like Double Flying Eagle or IPO U-turn. The only one that survived was the one that Michael Lowry, an institutional salesman at O'Neill, first dubbed the IPO U-turn. 2 of the biggest IPO U-turn setups at the time were eBay, Inc. eBay in October of 1998 and Ubid, Inc. Ubid in December of 1998. The infamous IPO U-turn was not only a first stage-based setup that we observed during that dot-com bubble period, but would also serve as a later stage base as hot internet IPOs would run up rapidly, then correct very sharply before making a sharp U-turn right back up to new highs. In August of 2004, another internet IPO, Google Inc., Goog formed its own first stage IPO U-turn, figure 9.40. When we first mentioned Goog's IPO U-turn formation to Bill O'Neill, he wasn't buying it. However, once it was explained in terms he could understand, he took another look at it. The primary characteristic of an IPO U-turn is not the U in the formation. It is actually the invisible flagpole that forms when the stock opens up for trading on the first day at a price far above its initial offering price. In Goog's case, it had come public via a Dutch auction, which priced the stock's initial public offering at $85. Goog opened up for trading on August 19, 2004, at exactly $100 a share, pulled down a couple of bucks, and closed at 100.33. Over the next 2 days, the stock ran up to an intraday high of 113.48, before pulling back down to the 100 price level, and then pulled a U-turn back to the upside. By including the invisible flagpole that Goog formed by opening up at $100 a share on its first day of trading, a full 15 points higher than its $85 a share IPO price, we can see that Goog's pattern was actually a high, tight flag. In this manner, one of the primary requirements of an IPO U-turn formation is that it should generally form well above the stock's initial public offering price. Institutional sponsorship is key. Another characteristic of Goog at the time that also influenced our decision to purchase the stock at around the $111, $112 price level initially was the fact that a 13D filing had been released and was reported by news service BriefingCom as indicating that Fidelity Management and Research had taken a 13% position in Goog stock. In most cases, when a large mutual fund known to have outstanding research capabilities buys a stock like Goog in such size, they are not planning to flip the IPO, but are in fact accumulating stock with the idea of holding it for 3 to 5 years. This made Goog a big stock right out of the gate, and its IPO U-turn base worked quite well. The short stroke. Occasionally, we might witness the genesis of a new base pattern, such as was the case with the short stroke formation, although we didn't know it at the time. 3 days before Christmas, December 22, 2003, O'Neill called to ask what we think about Research in Motion RIM. We noted that the base was very tight and that the company would be reporting earnings that day after the close. We debated whether to put the stock on our institutional stock ideas list. We ourselves could not buy it for 48 hours once it was put on the ideas list, so that our institutional clients were able to act on the information first. We decided to wait for the earnings to come out that afternoon. And once the news was out that RIM had handily beaten the estimates, the stock gapped up out of a very tight 6-week flat base, shown in figure 9.41. This was a very powerful move, but the stock was immediately extended from its buy point by over 20%. Hence the idea of trying to buy the stock up that far away from a proper buy point carried a great deal of risk with it. The quandary here was where to jump on what we thought was likely to become a very hot moving stock. The next week, the stock traded in a very tight price range, as figure 9.41 shows, with the stock closing at the peak of the weekly range as trading volume dried up precipitously. This sort of action indicated that the story here was simply too big from a fundamental perspective, and institutions were not interested in selling any RIM stock that they may have held. This stinginess with the stock shows up in the very tight weekly range, the close right at the weekly peak, and the lack of trading volume as sellers fail to show up. Later, this chart pattern began to appear as the short stroke formation in O'Neill's workshops. The term short stroke comes from the musical notation that indicates where the bow of a string instrument is to briefly touch the strings in a short stroke. This makes complete sense when you understand that O'Neill was a trumpet player in his youth and likely played in orchestras with string instruments. Statistically, it is not clear whether this pattern has any real validity, but it is something of a corollary to a high, tight flag formation where the flag is a single, very tight and short, 1-week flag. Labels can be misleading. Context is key. One of the drawbacks to trying to label every type of base formation is that it puts one in the position of assessing bases or chart formations on the basis of their fit to these base templates. In the process, many of the chart phenomena that O'Neill goes to great lengths to measure, label, and categorize are easily misinterpreted. For example, in October of 2004, we were playing very heavily in Apple Inc. Apple, which was riding a wave of iPod sales. On October 15th, Apple announced earnings and the stock gapped up through the 20 price level on the chart in figure 9.42. The huge volume breakaway gap to the upside had many thinking that the stock was putting in a climax top, failing to understand that the position of the stock within its overall move and the market cycle is critical in determining when a stock is making a climactic topping move. Because the general market had only begun a new rally phase by follow-through to the upside in August of 2004, Apple's breakout in the last week of August was a breakout from a first stage base. During their price moves, stocks will generally put in 3 to 4 later stage bases after initially breaking out at or around the same time as the general market also begins an upside rally phase. The first breakout that coincides with the market's recovery and follow through to the upside is the first stage base. Climax tops generally occur after a third stage or fourth stage or later base is formed in a stock's overall price run. The interesting thing about this was that at the same time a lot of individuals at the firm were thinking Apple was putting in a climax top, we were buying the stock aggressively for our own accounts. We had actually bought most of our position on the earnings gap up on October 16, 2004, recognizing that the line of least resistance had been broken, figure 9.43. In Chapter 4, we discussed buying gap-ups like this because they are buyable, particularly when they have a volume signature, as Apple did on that day, which is clearly visible on the daily chart in figure 9.43 as a big upside volume spike. Apple was the last big winning stock we played as internal portfolio managers at William O'Neill Plus Company, Inc., and O'Neill was in it very heavily at the time as well. The last classic maneuver we saw him pull occurred in our last month at the firm, when Apple announced earnings in October 2005. By that time, Apple had already had a huge price run, and following this October 2005 earnings announcement, the stock began to sell off, finally gapping down and dipping just below its 50-day moving average. O'Neill was shaken out of a lot of Apple stock at that point, and the stock ended up closing just above its 50-day moving average, as we see in figure 9.44. The next day saw Apple lift off the 50-day moving average on huge volume, something that we know today as a pocket pivot buy point. O'Neill saw this action and, forgetting about whatever stock he had sold at lower prices, immediately began buying the stock back, most likely buying back even more, as this was often his policy. He would often urge us that if we found ourselves shaken out of a big, winning stock, and the stock then showed overwhelming power as it recovered and turned back to the upside, we should consider buying back our entire position and then some. This was the type of decisive and flexible reaction that O'Neill displayed, which is very uncommon among average investors. O'Neill was not price sensitive. He did not care what price he had sold a stock at and whether he was buying it back a few points higher. The point in buying the stock is to catch the fat part of the price move. Whether one bought it a few points higher or lower, or sold it lower before buying it higher, is simply not a factor. The key is whether the stock is signaling that the line of least resistance has been broken, and a big move is now starting. Buying back Apple in this manner is typical of O'Neill's aggressive style in correcting mistakes in a decisive manner that quickly compensates for the prior mistake of being shaken out of the stock. As figure 9.44 clearly shows, had O'Neill worried about having to buy Apple stock a few points higher than where he was shaken out around the 50-day moving average, he would have missed the parabolic move in Apple that ensued. Notice also that Apple gave investors 2 pocket pivots. Conclusion: if you ever have the opportunity to work side by side with Bill O'Neill, experiencing and operating in the market in real time, you might begin to understand that being one of the greatest stock market investors in history isn't about being right all the time. In fact, O'Neill was often wrong, but he never had his ego staked in being right to begin with. He constantly reminded us that you miss 100% of the shots you don't take. O'Neill took a lot of shots, but he also used the market as a massive information feedback system, moving with the evidence as it changed, not before and not after. In this manner, he was constantly trying to figure out where he was wrong so that he might take immediate corrective action. O'Neill often preaches that in the stock market there are 2 kinds of investors, the quick and the dead. O'Neill was quick to discern when he was wrong and to shift course before it caused him too much damage. He could also pick up the scent of blood very quickly, and when he picked up the scent, knowing he was onto something big, he knew how to squeeze every last drop of profit out of a big, winning stock. Nobody is better at this than Bill O'Neill. You can read all about Bill O'Neill in books like Jack Schwager's Market Wizards, and you can read all the books he has written himself. but you can never truly understand his sheer market genius until you see him in action. Working with him in real time, you also begin to understand that what he does is not magic. It is the result of discipline, hard work, detailed observation, tireless study, and decisive action. In this way, it is accessible to all of us as traders. This chapter has hopefully brought into focus how someone with such immense experience as an investor engages the market with his own methods in a manner that is simultaneously fluid and decisive. Chapter 10. Trading is life. Life is trading. The material covered so far can be used to optimize your own trading, but this form of learning is only half the story. If there are misalignments within yourself, this implies that your personal psychology is not fully optimized. And as Ed Seykota, the legendary futures trader who was interviewed in Jack Schwager's book Market Wizards, says, you will not reach your full potential, or in the worst case, you are setting yourself up for a big fall. Much as athletes psych themselves up for an event, traders should be sure they too have optimized themselves psychologically. As O'Neill always told us, never operate from a position of fear or put into the positive. Always operate from a position of strength. Psychological strength is paramount, and as we all know, one of the biggest challenges when it comes to successful investing is in mastering one's own psychology. Richard Dennis and William Eckhart selected individuals for their Turtles program, briefly mentioned in Chapter 7, Section 2009, Commentary, who had the necessary psychological characteristics so that they could be taught to trade profitably. It should then come as no surprise that many traders see trading as a looking glass into oneself. We would add that trading is like looking into the abyss and seeing yourself magnified 1,000 times, where all your best and worst traits are shown in full measure. As we discussed earlier, an oversized ego is often the downfall to successful trading, especially when such an ego can shield the trader from hearing what the market is saying because the ego wants to be right, and since it has been right before, it thinks it must be right again. Ed Seykota, teaching a technique that has helped traders around the world. Ed Seykota has made a lifelong study of how personal psychology affects one's trading. His interview in Jack Schwager's Market Wizards is still considered to be one of the best interviews ever given by a top trader. Seykota says that trading amplifies everything that is going on within a person. One of the first questions that Seykota has been known to ask traders who seek his coaching is, "You ever cheat on your significant other?" Seykota considers it important to know whether traders are willing to compromise their ethics, since behavior and other tendencies in daily life outside of trading can bleed into one's trading and have an effect thereby. The two are inextricably, psychologically linked. Thus, the beauty about trading and the beauty about life as well is that there is no cheating. Or, as free market economist Milton Friedman said, there is no such thing as a free lunch. When people cheat others, they effectively cheat themselves. It will show up in their trading and performance will suffer. For well over a quarter century, Seykota has been known to take on one student at a time to teach how to be an effective investor. He screens applicants by psychoanalyzing them to see if they have the character traits that will enable them to succeed. While Seykota might not take on a student who lacked the necessary character traits, he created a practice called the Trading Tribe Process, TTP, which teaches traders to overcome any weakness by optimizing their own psychology. Not surprisingly, Seykota's TTP, www.tradingtribe.com, has become hugely popular worldwide as trading tribes across the world have sprung up like mushrooms among traders who meet regularly to practice Seykota's philosophy. This philosophy can be summed up in 2 words, right livelihood. This parallels Wallace D. Wattles' book The Science of Getting Rich, Top of the Mountain Publishing, 2002, where Wattles gives the reader the roadmap to developing the right mindset so they can live a rich life. The term rich, of course, does not just mean financial wealth but a wealth of beautiful friendships and relationships, strong family bonds, and worthwhile accomplishments. TTP, explained in detail at www.seykota.com Tribe TT Process Index. HTM can be broken down into 3 phases. Phase 1, a person gets upset and identifies why. Even though the person may understand why, he may resist the why in the form of denial by the conscious mind, CM. This can take many forms such as making excuses or shifting blame onto others, since the ego will do what it takes to protect itself. The person will feel a general discomfort as a consequence. Over time, this general discomfort may grow if the matter is not dealt with effectively as the ego continues to mask the problem. Phase 2, the subconscious mind, what Sakota calls Fred, communicates with the conscious mind CM. In a healthy person, Fred sends signals to the CM that are fully acknowledged. Wisdom is the final result. Those who resist the signals Fred is sending from one's unconscious mind to one's conscious mind end up repeating the same negative patterns and making the same mistakes. This is known as drama, and we all know certain people who nicely fit the label drama queen. They seem to attract drama wherever they go. The trouble stems from suppressing, masking, or hiding one's feelings. Maybe one was told long ago by a parent, peer, or teacher that having such feelings is wrong or bad. Or perhaps one's CM may see the feeling as dangerous and block it out. Knots can then form within one's subconscious mind. Fred will raise the intensity as it attempts to get its message to the CM. Similar dramas can thus be repeated at higher and higher levels. Certain images and nightmares may reoccur as Fred attempts to get its message to the CM. Ultimately, Fred will continue to send its message by reenacting the experience. Thus, the person will repeat the same drama over and over again. Further, the behavior is reinforced by neural pathways that are strengthened in the brain each time this behavior is repeated. Strong neural pathways lead to repeat behavior as the brain is comfortable traveling on a well-paved neural track. However, once one's CM fully acknowledges Fred's message, this is often experienced as an aha moment within the person, which is accompanied by the great feeling where things suddenly make sense. Some have said this wonderful moment is akin to the feeling of things just clicking into place. This feeling is usually accompanied by a physical release of tension and an outpouring of pent-up emotion. Sakota's TTP facilitates the flow of experience between Fred and the CM. It is essential that one does not try to go it alone, as the process requires a group effort to be fully effective. The problem is that many people, especially traders, tend to be fiercely self-reliant. The do-it-yourself culture can prevent one from realizing your fullest potential by not interacting in a group or a tribe. But group participation can still mean being self-reliant. If one wishes to get the most out of TTP, then group participation will provide the highest quality experience as opposed to going it alone. No entrepreneur ever built an empire without the help of others. The philosophy of the TTP is akin to other teachings discussed in this chapter in that we are all interconnected and we are all one. There are no boundaries. An acknowledgement of this beautiful and deep interconnectedness is the first step towards self-actualization and enlightenment. This state of enlightenment is what Sakota calls getting to the 0 point. The 0 point is the state of being in the now, of being in the present, of being in the zone. A state the writer and philosopher Eckhart Tolle discusses fully in his seminal works The Power of Now, New World Library, 2004, and A New Earth Penguin, 2005. As Ed Sakota writes, it is dancing joyously with abandon. It is splashing your hand in a mud puddle and just being there with the experience. It is putting on a trade and succumbing to the enchantment of the whole process, including the market, yourself, the prices, the pluses and minuses, and the pretty colors on the monitor screen. www.sakota.com Tribe TT Process Index HTM. Phase 3. As individuals continue to untie their psychological knots, long-standing, recurring, and destructive dramas disappear. One will notice a decrease in obsessive defensive anxiety and an increase in a healthy anticipatory expectation of the future. A feeling of balance between emotion and logic, of being in the zone, an increase in creativity, an increase in physical health, improvement in friendships and relationships, and successful trading are the result. Eckhart Tolle, helping people achieve inner peace and greater fulfillment, a prerequisite to optimize trading and living. Eckhart Tolle has become one of the great spiritual teachers of our time. The Power of Now has had a hugely positive impact on the planet and has been translated into 15 different languages. The essence of his teaching is simple: remain in the present, for that is all we have. But so many people find this challenging as they obsess about the past on some wrong that was done to them or some mistake they made. Here are some examples of the mental games traders can play. I can't believe I sold that stock under what I paid, so even though it's set up to buy again, I won't touch it. Fool me once, shame on you. Fool me twice, shame on me. So this trader lets his emotions get in the way of his rational thinking. He got burned once by the stock, so now he has a negative bias against it, even though it may still be a perfectly good stock with a great buy point. I am so upset. I held onto this position too long, so I'll just wait until it gets back to where I paid so I can at least break even on the trade. Meanwhile, their focus is often taken away from new stocks that are buyable, so they miss out on new profitable opportunities. Just as with obsessing about the past, many people worry about the future. For example, I hope the stock I bought goes higher even though it's well under what I paid for it. Instead of hoping, they should fear instead the possibility that the stock will go lower, and so it should be sold. I'm afraid the stock will drop since it has risen so much, so I had better sell it up here to lock in profits, and you can't go broke taking profits. Selling a stock because one is fearful that it has risen too much is not a reason to sell a stock if the stock has done nothing wrong and continues to act properly. Instead, traders should be hoping it continues to act well and move to a higher price, and thereby hold onto the stock. How will I pay my bills if that stock doesn't get back to my break-even point? As O'Neill has said, never trade from a position of fear. Scared money never wins. So while obsessing about the past or worrying about the future can take one's focus away from the present, that is not to say that there is no place for what Toll calls clock time, where one strategizes and plans for the future. What Toll tells us to guard against is psychological time, where the person gets stuck in the past or continuously worries about the future. Such distraction can derail a person from staying focused in the present. If people spend too much time thinking about their circumstances, rather than simply doing something in the present to make incremental progress, they are more likely to fail. To use an American football analogy, the player found small holes, but he ran through every one of them, finally getting to the goal line. O'Neill would tell us to always work hard and to understand that progress is often incremental, and to just keep running for daylight, wherever you see it. Life is rarely still, but we can maintain a state of peace and harmony by staying in the present and dealing with whatever challenges life throws at us. An analogy we have always loved is that every person is like an ocean. Life is the stuff on the surface that happens. Sometimes, the surface can be quite turbulent and volatile, but it is still only on or near the surface. The real you is all the depth under the surface, which cannot be disturbed and is connected to all other oceans. So whatever challenges or setbacks may occur, know that this depth is the real you, and acknowledging and focusing on this depth will keep you grounded, so that when life's challenges arise, you will be best equipped to handle the situation. Like the great redwoods that live for thousands of years, they let life unfold naturally, absent of worry. Worry and unhealthy obsession are rooted in the ego, and the ego often fuels the mind with obsessive thoughts that can dominate one's focus and take them out of the present. Leaving your ego behind can be the best prescription for staying in the present. Toll says that the next time something bad happens, instead of going into mental overdrive, observe yourself thinking as if you were an outside observer observing you. When you do this, you may see that all this thinking noise that goes on inside your head is not really you, and any tough times that arise are also not you, but just stuff that passes through. Keep a comfortable space, an inner stillness, between you and whatever is happening. Whenever the market does something completely unexpected and which could cause big losses in one's trading account, one market wizard we knew was famous for addressing the situation by calmly saying to himself, "Isn't this interesting?" and then proceed to quietly observe the situation unfolding, taking any needed action in the present. This inner stillness will keep you in the present so that you can take the best possible course of action, since you will be able to maintain your focus. This inner stillness is your true self-esteem. Do not let your ego disconnect you from this. Also, once you can let go of your ego, you will no longer be attached to labels nor hurt by criticism. Inner stillness is the true you, which is analogous to the depth of the ocean. Your words and actions that flow from this spaciousness, this inner stillness, will be helped by universal forces, since you attract and manifest according to what is going on inside of you. Like radio waves that are emitted through the atmosphere, you send out various levels of energy based on how you feel, and how you feel is referred to as your vibrational state. A high vibrational state corresponds to feelings of joy, euphoria, and passion, while a low vibrational state corresponds to boredom, depression, anger, and self-pity. This is discussed in more detail in the following section on Esther Hicks, who writes that the higher the frequency of your vibrational state, the more positive the circumstances you will attract into your life. It is therefore important to accept and embrace whatever happens to you, because you are then in the strongest state and therefore best equipped to deal with the situation. In a sense, after tragedy occurs, true acceptance of what has happened is when the healing begins. This is akin to Seikota's TTP, where traders emotionally embrace what Fred is telling their CM, which simply means that their CM fully acknowledges Fred's message, and this leads them to their aha moment. TTP essentially short-circuits and bypasses the stages of denial, anger, bargaining, and depression that occur when tragedy strikes. That said, as Toll writes in Practicing the Power of Now, Novato, New World Library, 2001, 135, don't let the mind use the pain to create a victim identity for yourself out of it. Feeling sorry for yourself and telling others your story will keep you stuck in suffering. Since it is impossible to get away from the feeling, the only possibility of change is to move into it. Otherwise, nothing will shift. Toll advocates moving into the painful emotion, embracing it, surrendering to it just as Ed Seikota's TTP would advise. Otherwise, you will be likely to repeat it by way of the subconscious mind, recreating the same situations over and over again. True acceptance of what has occurred is akin to the CM fully acknowledging Fred's message. True acceptance of any negative news or tragedy should not be confused with negative mindsets or negative attitudes, both of which are poison. O'Neill used to tell his employees that anyone with a persistently negative attitude would be fired. A negative state of mind can be caused by letting one's ego rule one's thinking, and such thinking often leads to negative, worrying, and often obsessive thoughts. When asked how one drops negativity, Toll simply answers in The Power of Now, A Guide to Spiritual Enlightenment, Novato, New World Library, Vancouver, Namus Publishing, 2004, 79, by dropping it. How do you drop a piece of hot coal that you are holding in your hand? How do you drop some heavy and useless baggage that you are carrying? By recognizing that you don't want to suffer the pain or carry the burden anymore and letting go of it. Practicing the power of now includes several exercises we have found useful. Watch your thoughts and emotions as well as your reactions to various situations. Notice if your attention is in the past or future. Like darkness that cannot escape the light, such attention dissolves when you shine the light of consciousness on it. Whenever you feel negativity rising within you, tell yourself to get out of your mind and be present. Keep a trading diary where you note your thoughts and feelings as you react to the daily twists and turns of the stock market. Stay focused on whatever you are doing. Do not get sidetracked by wondering when the gains will come or by the gains that have come. This is akin to counting the money in your trading account or making the market pay for luxuries you don't yet have. Focus on making decisions in real time and reacting to what the market is actually doing, rather than what you think it should be doing, or what you fear or hope it might do. Monitor your mental and emotional state through self-observation. Your interest should be more on what goes on inside you than on what happens outside. If your inside is in alignment, the outside falls into place. Do you ever feel guilt, pride, resentment, anger, regret, or self-pity? If so, you are reinforcing a false sense of self and accelerating the aging process by building up a storehouse of the past in your psyche. These negative feelings can take away your focus from the matter at hand, namely trading, which requires being fully in the now. Give up waiting as a state of mind. Just be and enjoy being. If you are in the now, you never have to wait for anything. Don't say to yourself, someday, I will have made enough money in the market to own that big house. Life is in the now. Become aware of your breathing as you trade. This can help restore focus. This is a particularly powerful technique for anyone, and especially for those who meditate. Blanking the mind will paradoxically lead to answers because it enables a person to access inner stillness. One can also focus attention on the body, a technique that can take one's attention away from one's thinking. Ask yourself, is my body alive? Can I feel life and energy in my hands, arms, legs, and feet? As you breathe, observe how your lower abdomen gently expands and contracts. When you can feel your inner body's energy, let go of any visual image and focus exclusively on the feeling. Become one with it, so that there is no boundary between you and your body, no boundary between your inner and outer self, and no boundary between you and all that is, as you become one with all that is. The more consciousness you direct into your inner body, the higher its vibrational frequency, much like a light that grows brighter as you turn up the dimmer. In this state, you tend to attract positivity that reflects this higher frequency. You are anchored in the now, where the external world and your egoic mind cannot overtake you. Whenever you need to find an answer to a problem or are looking for a creative solution, stop thinking. Focus your attention on your inner self for at least a few minutes. While doing this, the answers may come. If not, at least your thinking will be fresh and creative when you resume your task. We have come up with some of our more creative trading ideas and research ideas in this manner, and sometimes we'll even dream on it. Offer no resistance to life. This means being in a state of ease and lightness. Should the market go against your positions, you are relaxed and can take the best course of action. You maintain clarity. You lose the need for things to be in a certain way. Your dependence on outer form is gone. Paradoxically, when you reach this state, the general conditions of your life, that is, the outer forms, tend to improve greatly. All good things, of course, will still eventually come to an end, but with your dependence on form gone, you have no fear, and life easily flows. Should someone say or do something that is rude or hurtful, instead of unconsciously reacting by attacking or defending or withdrawing, let it pass right through you. Do not resist. You can still tell people their behavior is unacceptable, but you are in control of your inner state. You are then in your power, not someone else's, nor are you controlled by your ego. Watch out for any kind of defensiveness within yourself. Is your ego trying to protect itself? By identifying your defensiveness, you remove your identification with it. In the light of your conscious awareness of it, this defensiveness will dissolve. Arguments and power mind games, which are destructive to relationships, also dissolve. While this relates to dealing with others, it can spill over into one's trading if one's focus is temporarily derailed due to some prior disagreement that is festering in one's mind. Paradoxically, do not look for peace. Forgive yourself if you are not at peace, namely, if you find yourself obsessing about the past or worrying about the future. As you accept and surrender to not being at peace, you are accepting what is, which is essential to being in the now, and every moment can become the best moment, which in its purest essence is enlightenment. Surrendering brings about important change. By surrendering, toll does not mean giving up or failing to rise to the challenges of life. Instead, you see clearly what needs to be done, doing one thing at a time, focusing on one thing at a time. As Toll writes in Practicing the Power of Now, Novito, New World Library, 2001, 115. Surrender is the simple but profound wisdom of yielding to rather than opposing the flow of life. The only place where you can experience the flow of life is the now, so to surrender is to accept the present moment unconditionally and without reservation. It is to relinquish inner resistance to what is. Thus, should your positions in the market take a nosedive, you don't need to deceive yourself by hoping they will bounce back, or worse, by denial or by blocking out the situation, as some traders have been known to bury their trades in such dire situations. You accept the situation fully, then you take action by doing everything you can to repair the situation. That might mean taking a loss on multiple positions, but losses, whether big or small, can always become bigger, so deal with the issue now. We conclude Toll with a powerful passage from his seminal bestseller, A New Earth, New York, Penguin Group, 2005. There are many accounts of people who experience that emerging new dimension of consciousness as a result of tragic loss at some point in their lives. Some lost all of their possessions, others their children or spouse, their social position, reputation, or physical abilities. Whatever they had identified with, whatever gave them their sense of self, had been taken away. Then suddenly and inexplicably the anguish or intense fear they initially felt gave way to a sacred sense of presence, a deep peace and serenity and complete freedom from fear. When forms that you had identified with, that gave you your sense of self, collapse or are taken away, it can lead to a collapse of the ego, since ego is identification with form. When there is nothing to identify with anymore, who are you? When forms around you die or death approaches, your sense of beingness of I am is freed from its entanglement with form. Spirit is released from its imprisonment in matter. You realize your essential identity as formless, as an all-pervasive presence, of being prior to all forms, all identifications. You realize your true identity as consciousness itself, rather than what consciousness had identified with. The ultimate truth of who you are is not I am this or I am that, but I am. When you yield internally, when you surrender, a new dimension of consciousness opens up. If action is possible or necessary, your action will be in alignment with the whole and supported by creative intelligence, the unconditioned consciousness which in a state of inner openness you become one with. Circumstances and people then become helpful, cooperative. Coincidences happen. If no action is possible, you rest in the peace and inner stillness that come with surrender. 5658. Esther Hicks, teacher of the law of attraction. Esther Hicks defines true success as the amount of joy you feel as you live your life. She writes that the universal law, like the physical law of gravity, is that the more joy you feel, the higher your vibrational frequency. The higher your vibrational frequency, the faster you will manifest what you desire. When we feel good, we are enabling the universe to deliver our desires. When we feel bad, we are closing ourselves off to our connection with the universe. Anyone can walk the path that leads to this higher vibrational frequency. We have all heard of the power of positive thinking. Hicks says it is rather the power of positive feeling and the power of positive doing that serve as far more potent methods to raise one's vibrational frequency. In her books, The Law of Attraction, Hay House, 2006, and Ask and It Is Given, Hay House, 2004, she gives many mental exercises readers can practice to raise their vibrational frequency. In more challenging circumstances, such as the death of a loved one or the loss of a job, feeling positive in the face of such loss or disaster can be nearly impossible. But the power of positive doing often will change people's mindset so they can begin the healing process and eventually come to terms with the situation. But before one is even willing to take action and do, one must accept and embrace the loss or the tragedy as prescribed by Toll, and this means accepting and embracing the sadness, the depression, and the loss. Otherwise, one may remain in a prolonged state of deep depression where one does nothing and only thinks and feels negative thoughts. Remember, it is how you react to what happens that matters. Using a real-life analogy where tragedy can strike at any moment, Mario Andretti said he rarely crashes because, while most drivers panic and focus on the wall when going into an out-of-control skid, he focuses on the road, on where he wants to go. This is a great metaphor for achieving one's goals, even in the face of great hardship and potential disaster. Putting together the teachings of Toll and Hicks, we have the following strategy when bad news hits, whenever we suffer a loss, or when major disaster strikes. Phase 1. Accept and embrace loss, surrender to tragedy, which leads to. Phase 2. The power of positive doing, which leads to. Phase 3. The power of positive feeling, which leads to. Phase 4. The power of positive thinking. All four phases immediately produce a higher vibrational state within people, so they can immediately begin to attract what they want into their life. But the key is in raising one's vibrational state. Phases 1, 2, and 4 all can lead to Phase 3, which directly raises one's vibrational frequency, and in turn positively impacts one's trading. Jack Canfield, seminal works on personal optimization. According to the results of a famous NASA experiment, it takes 30 days to permanently rewire your brain. Astronauts had to wear goggles that turned everything in their view upside down. After a few days, they were able to learn their new upside-down environment so they could effectively move about. After 30 days, the rewiring in their brains became permanent so they could go back to a normal view, but then be able to put on the upside-down goggles and still move about with ease. The astronauts who took their upside-down goggles off after 15 days and then put them back on after a few days had to relearn how to move in their upside-down world. They could not just move about with the same ease that the astronauts who had worn the goggles for 30 days were able to. This proved that it took 30 days to rewire the brain permanently. The findings carry a broader message, which is that we are capable of massive change in any area we choose, but we must practice this change for 30 uninterrupted days to make it permanent. Most people do not consistently practice something they wish to change about themselves for 30 days straight, but that is what it takes. Anyone can make positive changes within themselves. if they institute whatever it is they wish to change about themselves into their lives for 30 days. Jack Canfield, author of Chicken Soup for the Soul, HCI, 2001, among many other noteworthy books, suggests focusing on your goals for 30 days by first writing them down on 3x5 index cards, visualizing the goal, going forward in time and stepping into the goal, feeling what it's like to have already achieved the goal, which has the effect of emotionally engaging yourself, and then looking back to see the things you had to do to make it happen. This is an effective way of programming your subconscious, which represents 85% of your brain power. And since your brain sends out brain waves just like radio signals, know that when you think a thought, others may be picking up those thoughts perhaps on a subconscious level. In this way, you can draw people into your focus by sending out your positive thoughts. This is why the message from the documentary, The Secret, is so powerful. When you visualize your goals and feel what it is like to have achieved those goals, you send out a powerful message to the world. The how will show up in various ways that provide the path upon which you will travel to achieve your goals. For example, not only will others pick up your positive thoughts on a subconscious level, but they will also see the change in you in your body language, your mannerisms, your energy, and your attitude, and perhaps be more likely to assist. So it is imperative that you optimize the thoughts you hold in your head. Change your thinking from negative to positive. Stop looking at negative news and drop out of the ain't it awful club. If you are around people who are negative or who constantly complain, keep your distance. Read uplifting books, biographies, and books on leadership mindsets, and don't let fear stop you from achieving your goals. Embrace the fear and do it anyway. Interestingly, Dean Radin, a well-regarded scientist who was interviewed in the documentary What the Bleep, spoke of how he has observed that people's thoughts could affect the outcomes of computerized random number generators to a statistically significant degree. In his experiments, a group of people in a room together focused at once and in unison on either of two numbers, A0 and A1, that would be randomly spit out by a computer. If the group focused on zeros, the computer would spit out zeros with greater frequency and in a manner that was statistically significant. Thus, if people's thoughts can have an outward effect, much like radio waves permeating the atmosphere even though we cannot see them, and influence the numbers being spit out randomly by a computer, this is further evidence for always keeping one's thoughts positive. Beware of negative thinkers and the energy they emit. Psychological checklist, questions to ask yourself. As we continue to move ahead, it can be instructive to create psychological checkpoints to ensure progress. Certain questions should be asked, and even creating a daily or weekly to-do list can be beneficial. Here are some questions and daily exercises that can help one stay on track and remain in an optimized state. Abundance versus scarcity. Those who smile inwardly at the misfortune of others come from a mental state of lack. Envy is born from this state of scarcity. Renowned philosopher Ayn Rand wrote in her essay, The Age of Envy, The Objectivist, 1971, that the culture in the United States is one of envy where people love to marry the rich and famous to scandal. The misery encountered often gives such people a feeling of comfort and satisfaction. People should honestly ask themselves if they come from a state of scarcity or lack, or a state of abundance. To find the answer, people should ask themselves if they feel even a hint of satisfaction when someone more successful or wealthy than they takes a fall. This is not to be confused with a healthy drive against a competitor. If you come from a state of abundance, you should honestly feel happy at other people's success, wealth, and riches. If you look up to their achievements in your own goal setting and set your goals accordingly, then this is a healthy indication that you are coming from a state of abundance. You see the world as providing limitless opportunities for yourself, so that the world is indeed yours, whether you are seeking adventure, accomplishments, wealth, or rewarding and mutually supportive personal relationships. Confidence versus insecurity. It is a commonly held belief that being smart, being right, or displaying wealth means commanding respect and influence. Others strive to look as good as possible by wearing the best clothes, obsessing about their bodies, and undergoing cosmetic surgery. While there is nothing wrong with looking good and being proud of one's accomplishments, or sharing the news of these accomplishments with others, people must ask themselves if they are crossing over the line by doing any of the above to show off, or so that they can secure bragging rights. All of this is nothing less than a form of an unhealthy, oversized ego or superiority complex. Bragging about one's car, one's house, one's bank account, the number of shares bought, one's grades, one's clothes, or one's physical beauty all could imply insecurity and a lack of confidence. Likewise, an inferiority complex is just the reverse of this, but also presupposes a person who lacks confidence. Truly enlightened people do not need to be respected or loved, or need to practice such bragging rights, as they know that on a cellular level everyone is one, everyone is connected, and they are connected to their infinite potential and stillness and infinite depth at all times. Life's purpose. On a daily basis, affirm your goals, affirm your talents, practice giving thanks for all that is good in your life, meditate to clear your mind, focus on how you can both evolve yourself and evolve others, focus on the good you can do, have fun with everything you do, even if it may be a task that is normally dull or unpleasant, by reframing your perspective of the task, and get into the habit of asking yourself the questions: how can I help? How can I be a positive influence on others? And how can I use part of the money I make in the market to help others and help my favorite charities? Even a word of appreciation or a devoted glance is often all it takes to lift another person's spirits. This is real power. Real power is power that cannot be taken away from you. Wealth, status, physical beauty, these can quickly vanish. Spiritual beauty, on the other hand, is yours and yours to share forever. All of these practices will not only serve to raise your vibrational frequency, but will also create strong, positive, empowering neural connections within your mind, so that you can achieve your goals as you uplift others around you. When you encounter a negative event, especially if it is one of great loss or tragedy, use the event to surrender as prescribed by Toll, so you gain inner peace, that quiet, comfortable space around you, that inner stillness. Inner peace is far greater and deeper than happiness, which is just a temporary state. Your inner peace manifests by your connecting deeply with your deep pool of radiant energy, and will result in being your most effective, so that you can create the best outcome as the universal energies work in your favor. Parallels between teachings. There are beautiful parallels between Ed Seykota teachings and the teachings of those who are not necessarily focused in the world of investments, including notable authors like Eckhart Tolle, Esther Hicks, Jack Canfield, Bob Proctor, and Wallace D. Wattles, whose books we have read and put into practice. Documentaries such as The Secret, What the Bleep, and Moses Code also make excellent resources. These teachings are not about proselytizing others to your worldview or your way of doing things. In fact, proselytizing has no place here, since that would be about converting someone to your belief system or faith, and telling people what they should believe. These teachings are not a belief system, but a process to help people reach their highest potential and to develop their own beliefs. To the extent that the teachings themselves become a belief system, and people try to convert others to it, these teachings no longer serve their original intention. That said, we have all seen ludicrous amounts of advertisements and spam that promise to make people rich or fulfilled through various techniques. The best techniques give honest, useful advice. So if readers have not read any of the books or visited any of the websites mentioned in this chapter before, then they should read works by some of the authors mentioned in this chapter. The key is to put the learning into practice. Don't fall into the trap of becoming a book and seminar junkie. Some people love buying and reading these books because they make them feel good, and they love going to the seminars where they can be inspired. Yet for some reason, they are often not much better off in the future, financially, emotionally, or spiritually. We remember a William O'Neill Plus Company, Inc. workshop that we were conducting with Bill O'Neill in New York City, back in 2001. We thought to ourselves as we scanned the audience, which numbered about 800, that probably only a tiny handful would make consistent and diligent use of this information. To make proper use of the information we were teaching required learning, doing, having discipline, and being diligent, not just for a few months, but indefinitely. Most people fall short of this. The key is to take consistent action permanently, not just over the short or long term, by putting the knowledge to good use. It can be easy to make big commitments at these seminars when energy levels are running high, but the real test is in the months and years that lie ahead. In conclusion, we are all on an evolutionary path, not just as traders but in a larger sense as human beings. Even though most of us may not be truly 100% enlightened, Just as it may be close to impossible to trade flawlessly, life is a learning and growing process where we evolve and help others to evolve. The benefit is twofold, since by elevating others, we raise our own vibrational state, which in turn brings us closer to our goals. In our own experiences, there were times we have learned more by teaching others than by learning directly from the masters such as O'Neill. We found that teaching was often a way to solidify the concepts, in addition to the benefit of feeling good about helping another person understand and make profitable use of a concept. In a larger sense, just as finding one's true passion in life is paramount, those who also find a cause that resonates deeply within themselves where they can take action and make a difference, generally leading more fulfilled lives. Trading is life, and life is trading. Like life, the markets will throw a variety of situations at you. Like life, the markets will try to throw you. What can make the difference between fulfillment and emptiness, success and failure, joy or frustration, will be your ability to remain in the present as you calmly assess the situation, free of the egoic mind, and effortlessly react to the situation at hand as it is unfolding. In this way, you will grow and evolve, not only to help yourself, but to become a positive influence and shining example to everyone you encounter.